Apple, Amazon, Netflix, Alphabet, all down. Not dramatically.
Well, you put the kibosh on Netflix when you said that people like to go to the movie theater.
What do you mean? Yeah, right. You just pointed out that it's a different experience.
You kibosh.
Yeah, I don't think Netflix is going to suffer from the idea that people might want to go see a movie once a month.
But look at that. Carl, look at these stocks. Every day, what happens, I've been talking about the...
What's up, everybody? So turning on the CNBC first thing in the morning, and feel like Jim Cramer is in prime mid-morning material already. I don't know what the heck he's talking about. He's like instantly getting on making fun of these FANG stocks.
I'll tell you what,
Just
keep an eye on names like
anyway,
Peloton for sure, Jim.
you gotta love guys like Jim Cramer on TV. Anyway, so interesting day today. Sorry for getting on for a few minutes after the bell rings, but the overall markets last night looked amazing. This morning they looked terrible. But as I was saying yesterday before we got off, today's like prime, ready to go for AMC. Like OMG AMC. It is like perfect storm, ready to go. And if the rest of the market's down, it actually isn't a terrible thing, I don't think, for AMC. So we'll see, because it makes people want to put their money somewhere. They want to put their money somewhere that's going to go up. So AMC opened up really high. You can see right when it first opened, it went up to 14.52, which it closed at, what did it close at yesterday? 13.5. So almost a full dollar up just from close yesterday to open today, which is amazing. So lots of good stuff going on with AMC today. I'm expecting it to have a great day. It's currently kind of up and down after that spike. Early it's at 14.23, up 5% already. GameStop, I was hoping GameStop would follow suit. Right now it looks like it's falling 208, but it might turn back around. If AMC spikes, GameStop will as well. It might not spike as greatly. And then you might see the same from Cost Express and a few of these others. I'm going to put it here on the little screen, Naked Brand, see what's going on there. 0.92. I would love to see this thing get back to $2. If it gets up to $2, I'll sell what I've got. I still have quite a few shares. I have a standing seller in here, $2.59. But again, if you haven't been following, for Naked and for Cost, I am 100% in the free money category because I've made so much money on those last time. So we are in free money category with those two stocks. So I really don't care what they do. I've got my sellers in, and if they go to the moon, great. If they end up not, I really don't care. that's my thoughts on Cost and Naked Brands. But I do still have a pretty good amount in AMC and in Express, and I actually feel great about those. At least I feel great about Express in the long term. And it looks like it's moving. It's moving. Express is moving. 503. It's up above 5 for the first time in a few days. I would love to see Express take off. It really might. AMC is still kind of just messing around over here. Not doing anything special. I thought that it would be ready to go, primed with fuel in the pump, and ready to take off, and it's not. Let's see what else we got. As the markets first open, let's see what we're looking at. Looks like right now the Dow is slightly up, which is good. It opened down, but quickly went up. NASDAQ opened down and is still down, 1.27% down. S&P opened down and is slowly crawling its way back up. Let's see what else. Oh, Bitcoin. Look at it. What happened to Bitcoin? Holy cow. Man, just in the last hour, it's gone from 58,000 to 54,000. Holy cow. I have no idea what just happened. Literally just happened. Look at the chart. Can I pull up a Bitcoin chart for you? I've never done that. Maybe USD. I think it might work. I've never tried this in Thinkorswim here. I don't think this really tells me what I want to see, but Let me look at Greystone, Bitcoin, Grayscale. I don't know why I call it Greystone. Greystone, Bitcoin, Trust. And I'll go to the 1 minute. And look at this drop off here on the Bitcoin EFT. Look at this ETF from 52 quickly down to 51. Something's going to be over at Bitcoin. I know over at Bitcoin like it's a company. But Ethereum has dropped slightly, not as bad. And then Dogecoin has dropped a ton. Again, also in the last hour, from 58.58 cents to 0.54 cents, nearly the same percentage drop as Bitcoin. Very, very interesting. So we're gonna have to keep an eye on that. What's going on? Looks like the Treasury yield's up a ton, up another 6% today. Holy cow, man! 1.742%. So they are they're reacting. The Treasury yield is reacting, I guess, positively for the Treasury yield based on what Powell said yesterday. Although I think everyone was expecting it to not do that, which I think is going to drive some of the overvalued tech stocks down. Zoom's already down 4%. Let's see what else is really fun. I'll bet you know what? I'll bet you MicroStrategy is getting slow. And so is Rock Blockchain. Let me see. Actually, they're not. I mean, they're both in the red for the day, but not crazy. Riot's down 4%. But I just thought that with this, not only the drop in Nasdaq stock prices, but in the drop in the Bitcoin price, I thought it was going to go down a lot more. So we'll see what's going on with Bitcoin. It looks like it bottomed and turned a little bit north, and now it's at 55,186. That literally just happened in the last hour. Very, very crazy. From right about 58,000 to 55,000 in 1 hour. So quite a bit of a drop. So let's see what else happens. We've got Kodak is quickly shooting north, open low, and he's quickly going north. So that might be on a rocket ship. Game Stop, you can see it going down slightly. And I just realized my computer's not plugged in. Battery's going to die on me. There we go. Express still climbing. I mean, it's kind of up and down right now, right around 5. So I would love to see Express take off. Holy cow, I would love to. If it gets up to 6, I'm going to be super happy. Costs kind of up and down overall so far in the first few minutes. Look at this very tiny volume in the overnight trading, which, I mean, it's cost. Let's not get too excited, but look at this good volume over Express. Express now has more volume in the last hour than it had at any point all day yesterday. Something's going on for Express. I don't know what it is, but I like it. EXPR, let's check the news, see if there's something over here. Nope, no new news from Express today. It's just having a good day. Up now 6%, 5.12 is where it's sitting right now. GameStop up very slightly. It's just up and down right now. AMC, we're going to put AMC back on the big screen. AMC. And man, AMC just it's in a failure to launch type of situation right now. Just hovering there a little over 14, which is fantastic, but it is not taking off. I would have expected AMC to do kind of what Express is doing in there today, where it's just sort of going up, 5%, and really good graph so far. But it's not doing that. It started really high, so it's 3.72% up because it opened really high. So it's very interesting. And I don't know if I can watch these guys. I love Jim Cramer, but it's almost too much banter, like debate. I guess it's too much debate rather than information. So, but let's listen to it. Why not? I usually don't have them on first thing in the morning, but why not? Let's do it.
It would do very well.
What's our ticker? Mad?
Yeah, mad.
Yeah.
Yeah.
How are you in
that
ESG?
says a lot of things.
How are you in ESG?
How are you on it?
Are you gonna
What's
like
your carbon?
I think you're going to put me in. You're ESG-ish. You have me in Ben Hur. You put me in one of those,
Chariots?
No, in the ships where you're like.
Oh, okay.
Yeah, and you'll say that Jim will be the morale. The beating will continue until the morale improves. That's your motto.
Thank you. I appreciate you.
Right?
We'll lead with that in our S1.
Thank you.
The beatings will continue until the morale improves.
Guys, breath on the NDX, not so good. A moment ago, there were 4 green NDX components. We'll continue to watch that. Let's get to Rick Santelli this morning with rates still the big story. Hey, Rick.
Oh, yes, big story. They've been the big story. And I think one of the main reasons it's a big story, because how small of a story the Fed seems to make it. Look at a 2-day of 10s and 30s. If you look at the high yields in each today, 251 was the high yield in 30s. That was up 9 plus. 175 was the high yield intraday for 10s. That's up 11. They've eased back just a bit, but still guns hot. If you look at what's going on the long term, open the chart up to January 1st of 2020. That's the last time 10s were closing at this level. July of 2019 is the comp for 30s closing at these lofty yields. And of course, the spread is going to be widening, and indeed, just shy of 160, 10s minus 2s, now at the widest since the 4th of July of 2015. And it doesn't stop there. We keep gaining on overseas markets like sovereigns in Europe, boons, and even though their rates are going up, for example, minus 26 basis points in a boom, but their cycle high yield, which is a smaller negative, is minus 23. Why is that important? Because they haven't even traded higher in yield than their current cycle high, whereas treasuries on the long-dated side are just flying through them like a hot knife through butter. And if you look at 10s minus boons, they are now separated by almost exactly 200 basis points or 2% of yield. And of course, that is the widest since January of 2020. We'll call it 13 months. And finally, the biggest tell I've seen in a long time, the way the dollar fell out of bed, is Mr. Powell started to speak, and that is a good tell. And another good tell, it's crossing over the creek, as you see on this 2-day chart. Once it gets back to announcement Powell levels, what that tells me is the dollar is going to be hooked more into the higher interest rate movement. Carl, Jim, David, back to you.
All right. Thank you, Rick. We did get a Dow record high a moment ago, thanks to the banks in part. Let's get to Bob Pisani.
Yeah, I don't want the Dow to be high near the banks. I want the banks to be a little lower, not extreme knee-jerks, which helps the tech stocks, eases into the recovery stocks. But, it is what it is. And so good thing that we have a few things that are in the more recovery sector. I'd like to free up some cash, though, to put more money into something like Florida Norwegian cruise lines, which I don't currently have as much in those. But, I'm looking at right now, my focus right now is on these guys, AMC and Express. Express is still been doing really well. 515 keeps going up and keeps wavering up and down. We'll zoom out a little bit, but it is overall doing really, really well so far, 7%. Nothing going on over at Make Brands. Let's see what Genius Brands is looking like. Also nothing going on over there. So AMC, I need AMC. Come on, AMC. Jesus. Opened up really high, and it is just fizzling. Still holding on above 14, but man, come on, let's take off. This thing's ready to go. I would at least love to see that sell number that I have at 14.99 hit, because then I know it's at 15, which is great. And then keep going up. I'd love to, of course, get to the $25 to $40 sell order I've got. We'll see. Now, I mean, if you see a downward trend in some of these, if you see all of these tanking today, that is not the worst news, because then that means people are, hopefully that means retail traders are putting the money into a more safer, secure thing, like some high growth tech stocks, for example. But with the treasury yield bouncing as high as it is, that's going to be tough. Those guys, super tough, which is very, very frustrating. I just don't want the knee-jerk reaction. I'm not doubting they go down, but the knee-jerk reaction of them shooting down because of the interest rate shooting up, that's what gets people burned. Really, really burned. Luckily, I'm not really leveraged into the market, which is good. I do have. I really wish I could have sold more of Zoom right after the earnings report. I mean, I should have. It's not even a matter of like wish I had. I should have. It's dumb not to. Because it's it hit what 420 something. I can't even remember. It was awesome that evening after their last earnings report, maybe 2 weeks ago. Let me go back a month. Was it 412 or was it really? No, I don't think it had an earnings spike. So first, was it really a month ago? Let me see if I can find the date of when that happened. Because some weird things happened.
All right, Bob, thank you for that. Bob
Because then
Finney.
also the
Bob,
CEO of
before
Zoom
I got a bunch of all-time
sold a
highs
bunch
in the
of
bank here,
shares or
JPM
gifted
going
a
to
bunch.
the
I don't
open
know what he
index
did.
low. Not too many
And then
candidates
their
for the
earnings
green.
come out and they were
GM
amazing
all-time high today.
2 weeks
Back to
ago.
normal.
2 weeks ago. So what happened 2 weeks ago? The last day must have been the one on first or second spike. 412, I think overnight it was 420, 425, something like that. So literally $100 more than it is now. It's just massively frustrating that it didn't sell when I had that opportunity because it was right after that when the market just really had that first big crash 2 weeks ago. And I own 26 shares, right? So 26 shares times $100, it's $2,600 that I could have gained by selling it had I sold at that time. So super frustrating because not that I want to get out of Zoom. I think Zoom again, great stock, but I would have loved to have gotten out, freed up cash, let it drop down to the 300s, bought back in maybe at like 10 shares, and then spent that cash on something else. But anyway, it is what it is. I always say that there's shoulda, woulda, couldas all over the stock market, and we can't worry about that. But Express still moving Express up to 5.3 high, and then it's back down to 5.23, but it is moving. I might have to replace Express up here on the top graph today on the main screen, but AMC is turning back north. So let's get AMC turning back north, and maybe we'll get somewhere today. Cost is just not doing anything great. Neither is Game Stop for that matter. Let's see how Tesla's doing. Let's put him over here on the small screen on the bottom left. Ooh, Tesla's down. To me, Tesla is kind of like Zoom, where it's I still believe in it wholeheartedly, but I think in Tesla's case anyway, it's a little overvalued, and I would love to buy in more when those go down. I've got to free up cash. I got stream bombed by my son, wanting me to show him his cool exercise. That was funny. Oh, you gotta love the CNBC commercial breaks. It's just silence. Hey, by the way, I would love to put music on, but like 4 out of the last 7 live streams have gotten demonetized. Not that I even am in monetization, but they've been pre-demonetized. Even in the future, they won't be monetized should I ever get there because of some BS. And they did some stupid deepfake meme on CNBC for 10 seconds yesterday on an 8-hour stream, 10 seconds worth of them playing I Don't Want to Give You Up in the background of some goofy ass video, demonetized the entire 8-hour video. And I could have sworn they used to have this situation with Google or with, no, no, what the hell? It's the same thing. Oh, mother of God, that's exactly what I'm talking about. Okay, I muted it. It got me like half a second and I muted it. So F my life. When I play this crap, it gets fucking demonetized. Sorry. I didn't get demonetized with me saying the F word right there. It's such crap. Oh, that's terrible. But I could have sworn that last time when that happened to me on my other channel, I was able to go into editor and actually delete that section of the video. And it didn't give me that option yesterday. I was looking all around. 25 minute video. So it's, I don't know if there's a way to do it. I really don't, which sucks. So an 8-hour video is completely demonetized because of 10 seconds worth of shitty audio. I don't even know. So come on, YouTube. Like, there's a way you can fix that. Give me the option to delete that portion of the video, because I do not give two fucking craps about. I don't want to give you up in some stupid deep fake meme that they're going to show up in the corner just for fun. And CNBC has the license to that music. I don't. Come on, let me cut that crap out, or let me use it as a fair use, which I probably could. I can make a fair use of it. And if I cared enough, I did. If my channel was monetized and I was making a bunch of money, I actually would. But it's just such crap. You got to do better on your system. It's got to be better than that. Man, come on! What is up with this CNBC bullcrap? They'll come back for like 30 seconds. They came back literally just to show that meme and then talk about it, and they're back to the damn commercial. What the world? Okay, we're gonna screw it. I don't care. I'm gonna switch back over to TD Ameritrade TV, because they don't cut out for. We talk more about stocks, obviously, than other BS in the mornings. And it's like literally a morning circus show on CNBC in the morning, which I love Jim Cramer, but the show is just kind of a morning circus. Where TD Ameritrade really talks about stocks, and they actually play their own commercials. The problem, I guess, with playing their own commercials is the commercial has some monetizable audio or demonetizable audio or licensed audio that might get demonetized anyway. So, also, this kid looks like he's about 13 years old. He looks like the kid that, he's like the overdeveloped football player on the freshman team that, like, he's only like 14 or 15, but he kind of has a little bit of a what do I say, like a little 5 o'clock shadow. So, Nick Shields, I've heard good things about Dollar and Dollar Tree too. I think discount retail is going to be actually good for multiple reasons. First of all, Dollar Tree, especially Dollar General, are more rural areas, so more people are moving to rural areas. More people would rather go to Dollar General. There's not that many people. At Walmart, where there's thousands of people. So I think there's actually a good, just strategic move for a company like Dollar General, for people that actually do want to go to the store and shop, not people that are going to get stuff shipped to them or do curbside pickup at the grocery store. Dollar General is not a bad place. Plus, pro tip, if we ever run short on toilet paper again, go to Dollar General. Go to Dollar General or Dollar Tree. One of those. Most of them had toilet paper during that shortage last spring. Just pro tip. Anyway, we'll turn this up. Listen to them. They know what they're talking about.
Now, is those shares have been a little bit more stable here?
Well, from what we're hearing, it did take quite some time. I believe it was 2015 when Dollar Tree acquired Family Dollar, and Family Dollar was really kind of the opposite of a store footprint wise of what we saw from Dollar General. Really urban based store footprint, and a lot of deferred maintenance on some of those stores, which the stores were just not aesthetically pleasing enough to drive this sort of foot traffic that Dollar General was accustomed to, or even some of those other names we talked about like Aldi and Lidl. Or even Five Below, which is a bit of a different concept, but still was seeing solid foot traffic growth. It seems as though, from what we're hearing and the people we're talking to, and then also just the figures they're posting publicly, Dollar Tree is sort of putting the worst of the Family Dollar acquisition behind it. They've been sort of renovating those store footprints to drive foot traffic. Obviously, part of this is a temporary pandemic-based blip. But structurally, it took them a few years, but it does seem as though they're sort of putting the worst of that behind them. There might still be other synergies to be realized there, but just overall, it seems as though it took them 3-4 years now, if not more, but they've figured it out, so to speak, if you will.
Okay. All right. So a little bit of kind of shifting leadership and advantages maybe in the space here. Nick, thanks for the details. We're going to do a little trading here. Nick Shields from Third Bridge with the fundamentals. Thanks. Let's check out the options. All right, Tom, let's trade this thing with a little bit of a bearish kind of perspective then first. I know you got 2 trades here. One is a way to buy the dip on the stock this morning, but what about one that does capitalize if it continues to slip?
Yeah, and I think we saw that from a lot of retailers post-earnings. Even if they provided great guidance and blew out numbers. Nick mentioned that the 12.7% same-store sales comp in Q4, it's a positive, right? But guidance is weak. So how do you take advantage of that in maybe a short-term trading type of environment using options? So I went out to the April 9th weekly series. So you've only got about 3 weeks until expiration here, and I'm buying a skewed put butterfly to take advantage of maybe a little consolidation here, maybe a little bit weakness down to that maybe support level around 175. I'll buy the 182.5 strike puts, which are in the money, and then selling 2 of the 175 strike put, and then buying 1 of the 172.5 strike put, creating the skewed put butterfly. I'm buying a bearish put vertical, the 182.5, 175 put, and then I'm selling a neutral to bullish $2.50 wide put vertical, selling the 175, buying the 172.5. So this skewed put butterfly is just a combination of 2 verticals. If I pay roughly about a $2.70 debit, Oliver, it might be a little bit higher because the stock is down to 178.50. But if you pay $2.70 debit, that's your risk on this trade. And I'm profitable everywhere below 179.80 on the downside here. Anything below that is profit. Right, the apex of my profitability, though, is at that short 1-75 strike, which is near-term support level. So this might be the way to play at a low-cost entry point to a slightly bearish to neutral type stance here in Dollar General over the next 3 weeks. So limited risk, pretty decent risk-reward ratio, but you're profitable everywhere below basically 179.
Okay. All right. So looking for some continued weakness from here, and you do have about a buck and a half to where this can still be an okay trade as long as we don't get a major bounce back. When we opened up, we were at 182, which was still a big drop. So I mean, we have extended it here from the open. So look, as long as there is some more weakness, and you're good to go on this. What about the other side, Tom? Let's give folks an option if they think that Dollar General is a discount here. How do you buy on the dip?
Yeah, we've got that implied volatility getting crushed today because the report's out, right? We have that event risk gone. So how do you take advantage of this? Well, you give yourself probably some more duration because stimulus checks just went out, Oliver, and one of the big proponents of this is probably going to be Dollar General over the next couple months. So I looked at the May option series here. So you're giving yourself just over 2 months until expiration on this, and I'm going to buy an at-the-money call vertical to take the assumption that, hey, if you think that Dollar General is going to rebound, remember, this stock was just above 225 a few months ago, Oliver, so it has that ability to go back to those all-time highs again, right? So if you think that way, how do you take advantage of it? Buying a May call vertical might be the way to play it. As far as a risk-reward bias goes, if you think it's going to go maybe back to $200 a share over the next 60 days, and buying the 180 strike call, which is basically at the money, selling the 195 strike call, you're paying roughly about a $5 debit for this $15 wide bullish call vertical. That means you're risking 1 to make 2 on this particular trade. And with a lower implied volatility environment, buying verticals might be the way to play it if you're bearish or bullish on this name over the next 2 months.
Okay. All right. Tom, I like it. 2 different approaches here, of course. 1 up, 1 down. Everybody's happy, no matter which way you want to trade this thing. Tom's got the way to do it. Okay, appreciate it. Whitey, when we come back, we're in hour 2 of Morning Trade Live. Right now, the dynamic is still the same as at the open. Bonds are down. Tech is down. We'll talk some Nike here. A longtime winner of the quarantine trade and the comeback story. The stock has been well above its pre-COVID highs now since August. And as we push back towards those records, we'll take a look at what might be around the corner when we have earnings this afternoon.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. The Platform Demo webcast series is designed to help you broaden your knowledge of tools and resources available from TD Ameritrade. You'll learn tips and tricks to help navigate TDAmeritrade.com, thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
"24/7 access to diverse global markets. Right here."
That's why I added stock index futures to my trading strategy. Now when I see ups and downs coming, I'm ready.
Well played.
Feel that? That's the beat of global markets, the rhythm of the world. But to us, it's the pace of tomorrow. With ingenuity, technologies, and markets expertise, we create the possible. And when you do that, you don't chase the pace of tomorrow. You set it. NASDAQ. Rewrite tomorrow.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now.
Welcome back. We are in hour 2 of the show, 30 minutes into trading. More of the same, bonds near the lows of the day. NASDAQ is struggling. Here's what we've got coming up over the next 60 minutes. We'll talk some more retail, but brand specific next. Nike's got earnings this afternoon. Company has been a big winner throughout the quarantine trade since August. We've been looking at highs in Nike. So what do they need to show and what they need to deliver on a business that has been focused on e-commerce, direct to consumer? Is this a reopened trade too, though, as people need to buy a new gear for the next stage? All right, it's getting warm out too. At least Chicago had a little bit of a setback here this week. We don't need to talk about that too much. Bottom line is companies like Nike have a pretty good outlook. The question is, will they say that in the report? Then we're going to talk some home builders. We've heard the bull cases for these groups. Michael Shawool from Market Field, Mark Dow at Behavioral Macro, both saying to hold on to home builders. And Lennar absolutely blew up the market yesterday with the huge rally and sent ITB to a new high. So the home builders need a check-in for sure. Chartmasters got some analyst moves. So we'll look at the technicals on Clorox, Intel, and Lumentum. Right now, let's go to Ben. Let's talk about commodities, Ben. We haven't talked crude yet this morning. Definitely we need to discuss it as we're down 2.5%. What gives here? Because a lot of the stock market today is concentrated on some of the reopened stuff that looks to be in favor, but crude's just really getting blasted.
Yeah, well, there's been a few things weighing on crude this week. For one, Oliver, that dollar, which has been firming up just a little bit recently, the volatility we've seen there, some IEA comments, and well, I think what we're seeing in terms of the indices to the downside oftentimes weighs on energy products. Let's take a quick look at the move up that we've seen recently and how we traded to, well, just shy of the $68 level, the run up that we had seen not only into the end of the year, but really it started to build momentum throughout the beginning of the year. And then there you can see the March highs as mentioned here to just shy of 68. Now, if you take a step back, I want to just, well, also take note of some of the selling that we're seeing here come into play and how we're just now starting to take out a key low here that we posted again recently. I do want to point out, if you take a step back from this intraday look, though, you've got crude holding up above the 50-day moving average. The reason I think, Oliver, it's important to look at crude, for one, is if lower today, it looks like 5 days in a row to the downsides, just kind of feeding into that narrative in terms of what we've been seeing as far as some of the recent selling. But also earlier in the show, we were talking about the U.S. dollar. We were talking about rates on the rise and the impact that that has on some of the trends we've been seeing. This is one of those trends. Oliver, we were also talking about inflation. So crude prices, again, to the upside feed into that narrative and kind of support some of what we were talking about as far as rates to the upside. But if we start to lose some of the momentum, we've been hearing a lot about these commodity super cycles, Oliver, and the twist in terms of rates. And, again, these aren't just dance moves. These are references to price activity that we're seeing here. Ultimately, I also not only in terms of crude as far as commodities go, but I've got my eye on copper as well, Oliver. You can see how both are holding up above the 50-day moving average. So both have lost some of the momentum to the upside that we had been seeing as of recent. But ultimately here, Oliver, again, this is why I've got my eye on these products. For one, because they're very closely, directly tied to the indices. We want to see that momentum to the upside continuing in the ES. So ultimately, we're talking crude. We want to see it to the upside there as well. And also copper. These are very closely tied products. And then, hey, again, they tie back to that inflation narrative as well. So prices to the upside are kind of, supportive of two narratives in many ways.
Okay. So copper, crude, we can see softness, we can see some slowdown in this trend and have the trend still intact is kind of what I see there, Ben. But to your point, for copper in particular, it does kind of look like we are having a little bit more trouble sustaining that momentum, right? For crude, maybe this kind of slight rollover. Look, when we broke out of 60, that was a push out of that long-term downtrend. So, maybe we could go to 60 and test it, see if it was for real. For copper, it just was this powerful momentum trade, and that kind of looks like we hit a wall a little bit more here at $4.12.
Well, in theory, Oliver, that makes a lot of sense. I mean, when you're talking about the move up in rates, the impact that could have on housing, demand in general, that is a little bit different than what we're talking about in terms of crude oil when you talk about that, economy's getting back on track kind of trade. Keep in mind, copper saw quite the run up and had been trending prior to some of the movement that we had seen in crude. As you just mentioned, though, the recent highs were posted in crude as copper lost some of the momentum up to the upside. But I think what's happening here, Oliver, again, is it feeds into the narrative in terms of interest rates, the impact that they're having, and really the impact that they're having on the housing market, more so than you can see the impact that that demand narrative as far as the reemergence trade is having on crude.
Okay. All right, Ben, thanks for the update here as crude really getting hit. Rates are also picking up some steam, and after yesterday's big jump in the home builders, they are giving some of it back today, 2.5% lower. Seems like the grind can still happen for the home builders, but in the commodity space, those are having a little bit more issue. We've also got that firm dollar too, to your point here, as we were talking about. So some complications for some of these commodity trends. Thanks, Ben, for the updates. Let's bring in Pat Mullally. Let's talk some stocks. We've been discussing retail this morning, Pat, but from the discounter perspective, let's talk Nike, which has been really proving itself as a big e-commerce giant during the quarantine period, still able to find demand, crossed into records in August, but things have kind of tapered a little bit. I know we're sitting below the highs, but we've been here a lot at $145 since this year began.
Yeah, that's an important point, but it's interesting, when we hear things about the e-commerce giant and all these different things. We look at some comparisons here in a minute, but Nike, that's the big question. Are they going to bounce back quickly, or are they going to come driving into the bucket? So those things that we want to listen for is exactly what you said earlier. How are they doing? How are they doing out there? What's their growth? What's happening out there in Europe? Now, as far as expectations go, that's what everybody's going to be looking at, not so much as the numbers, but those expectations for EPS are going to be 75 cents with $1 billion in revenue. Now, that for some folks has generated about $173 price target from some analyst out there. So you can see here, last quarter there was 78 cents. Their estimate was 63. So they've been coming in and beating, and that's the interesting thing. That's what people see. They see that they've been continuing to beat those estimates. When we take a look though at like gross profit margins, when we see what's been happening over the last quarter, they've been drifting a little bit lower. Revenues growth has been moving higher, and that's the big thing that people are basing their analysis on, is that they are continuing to beat on those EPS numbers. But that revenue growth has been at a slower pace than what we saw in the earlier quarters last year.
Okay.
So that's the big. Go ahead.
No, I was just going to say. I mean, this is continuing to just show major top line growth, right? It's pretty hard to come by for some of these specific retail brands.
Yeah, so so how is that growth, and what kind of growth do we expect? So that's going to bring in three questions actually: Europe, China, and the United States. So European growth in question because why? You're shut down for 3 months, and we're going to see that in the charts here in a second. 3 months shut down. So are we going to see Nike their discussions on going forward, how they expect that growth to accelerate? China, they expect strong business growth coming out of China, and will they be talking about a comeback here in the United States? Now, when we take a look at the industry group, Nike, this is very interesting because it probably has a lot to do with what happened in Europe. If we look at a comparison chart of Nike and some of the others in its group, Nike and Adidas have been in the bottom two stocks out of the 10 that are in that footwear group, and that's over the last 3 months. So that's probably has a lot to do with what's been going on in Europe. So when we listen to what they have to say, their digital space, which big expectations for that e-commerce revenue to exceed 50% again, and if that's the case, Nike might be set to maybe start to overcome some of this, some of their lack of price movement in the stock that we've seen over the last 3 months. So you can see here Adidas and Nike, Skechers sitting down there, Crocs, toss that one in. But Under Armour, that's another company they've got to go up against with their upping their game with endorsement deals with Steph Curry and Joel Embiid. So again, it's expectations. It's what they say, going about what they see going forward. And if we look at a chart, you were talking about the chart, the banging up against that 145, 148 area, it's been, and what a lot of chartists are going to look at this as a very solid pattern, just kind of coiling up and holding in there at, near those highs. So we've seen some pretty good volume. If I took that volume over the last 5 or 6 days and I separated up volume from the down volume, most of the volume we've been seeing over the last 5 or 6 days has been up volume, barring day before yesterday's, pullback from that 148 level. So if I look at what the analysts are saying at $173, and I look at this price, these technicals, and I do a projection based on the technicals, the technical target, possible technical target, is going to be about 166. Again, analysts are have a little bit brighter idea that we're going to get up into the 170s.
All right, that wouldn't be a bad little move there if we finally do break that. Pretty clear to your point, though. I mean, very clear. Range that this thing has been in, and if we do, that little W turns in to a breakout and looks like a V, then a little price target action for us. Appreciate that, Pat. Nice thoughts here on where it could go. Let's bring in Scott Bauer. Thank you, Pat Mullally, our contributor on the network. Let's do some trading. CEO of Prosper Trading Academy, back with us, Scott. All right, you like Nike? Look for a move higher, get ahead of it.
I do, and I agree with many of the points that Pat made, especially from the technical standpoint of this, this range of 145, 147 that it's been buttoned up against. I think it's due for a breakout. Now, is it going to matter what the numbers are? Probably not. It's going to matter what they say, pretty much what Pat was talking about. And I really think that we're going to get a good look. This could be a massive proxy for what the economic recovery is in Asia, because we're going to see what they say about, what their growth prospects are. We know that, the last quarter probably wasn't great. That's not going to matter. Has Asia started the recovery? And if they have, this stock is going to break through these recent all-time highs, and I see new highs coming up here. So I'm playing it that way going into the print, Oliver. And what I'm doing here is a strategy that's called a diagonal. It's not so complicated, so let me explain it. I'm good at geometry. Perfect. I'm selling this week's, so expiring tomorrow, the 155 call. I'm buying, going out a few weeks, April 9th, the 152.5 call. Okay. So what a diagonal allows me to do is it buys me time. So it's like a calendar spread. I've got 3 weeks of time, but I also have a vertical or a bullish spread on, because I'm buying a 152.5 and selling a 155. So I'm combining that bullish bias with buying some time. Trying to do that for about $1.50 or so. Any breakout here to the upside, and this thing is going to skyrocket.
All right, guys, let's do a little bit of an update here. We're nearly an hour into the market. Overall, let's look at the overall markets. Dow was up this morning, but that's about it. It's kind of the same. Dow was barely green this morning. Nasdaq and S&P are down. Nasdaq is not only down, but still trending down. S&P is slightly trending down. Bitcoin, whatever the heck happened this morning, a glitch in the system or something, sent it from 58 down to 54, and it's right back up to 57 right now. That all happened in a matter of two um, 2 hours. So very odd that happened. But hey, you were able to get in that little dip. Then good for you. That's interesting. I'm not sure how or why that happened so quickly. Treasury yield still climbing very slightly. It opened really high this morning, 6.5% higher than what they were, so 1.749%. That's the current rate. So not great for interest rates or people wanting to get loans for interest rates. So homes, cars, businesses, things like that, not looking super hot. When I look at some of the meme stocks that were falling, Express is still the darling this morning, as you can see there on the screen. It is up now nearly 14% and nearing another session high, 5.48. So I'm loving to see that. I would love to see Express get at least a 6 or 7 today. Fantastic. I was absolutely expecting AMC to go to the moon. It still might. Don't get me wrong. Still now it's climbed up to 1444 and did hit a session high not long ago, 14. So it's maybe just priming the pump here and fueling up the rocket to get off, to take off here. You're seeing GameStop bottom out. Maybe it's going back up. Cost bottoming out a little bit. It's going back up. Even Tesla. Look at Tesla here just in the last. Tesla's not a great day today. Just right here, kind of taking that same trend from the past. It was at 912 and now it's 920. So about the last 10 minutes, a lot of these guys have turned north, which is fantastic. Hopefully we'll see that trend in the entire market. Let's see what the Nasdaq is reflecting that same thing. It is very, very pretty, very slight, not to the uptick that we're seeing on these stocks here. So I'm not sure if that's a completely global thing or just a little bit of a trend on those. But we are seeing other stocks like Ford and GM doing really well today. So it's likely looking like one of those days where the recovery stocks are going to make a difference, and the Nasdaq and overvalued tech stocks are going to be the dogs. So it's unfortunate because that's where I think we all have a lot of our stocks right now. I need to reset this graph. It got all jacked up. Give me 1 second. Let's go to 1. Let's go a little. There we go. But yeah, look at Express still flying. Another new session high of 5.56. It's backed off a little bit. It's going to go up, back off, go up, back off. If that keeps going, that's amazing. 14% already today. If it gets up to, 20, 30% up, that'd be amazing. I'd love to see it hit $6 today. I really think it can. Definitely can, but I would love to see it actually get there. Again, it opened at only 4.84, which was a really high open, and it's already at 5.5. So a huge increase already. So I can see it definitely getting up to 6 today. AMC, I can definitely get up to 15 today. If we can get past those thresholds, that'd be huge for those two stocks. Nothing else too exciting going on with some of the ones we're watching. Tesla's trending up slightly over the past 10, 15 minutes, but nothing too exciting. Nothing I would say is really taken like things did after Powell spoke yesterday afternoon. It looks like after he spoke and then everyone slept on it, all it did was just jack up in interest rates, which hurt some of the. So yeah, that's unfortunate. The market right now in this highly volatile market is the interest rates are directly driving what the equity prices are pretty much globally. So if one thing happens, everything reacts, or the other way around. So if the other thing happens, the other thing reacts. It's actually kind of annoying, but we're living with it. And the good news is that it makes it slightly more predictable, and so we can possibly play the game if you're a day trader, play that game really well, and make a bunch of money. Let's let them talk about it.
For having me, Oliver. No question the housing market is on fire. I think demand is pretty much as strong as it's going to get. Up to this point, we really have not seen any impact from higher rates in terms of weakening demand. But probably the biggest challenge for the builders right now is they just can't build homes fast enough. And I think we're starting to see a lot of the supply side pressures actually start to put a cap on how many homes can be sold, which, you're starting to see some growth rates decelerating, but it has nothing to do with weakening demand. It's entirely a supply story.
Okay, so the idea here is there's still not enough homes, correct?
Yeah, no, absolutely. I mean, when you look at where demand is, builders can't build them fast enough, so there's not enough homes. There was a shortage coming into this, although I don't think quite the level that some people believe there to be. So a lot of the excess demand that we've seen over the last year, I think, could be some pull forward from people that would have bought over the next couple of years. They're getting pulled into the market by low rates, perhaps the situation being trapped in an apartment. So you have seen some pull forward of activity there as well. But no question, there's definitely more demand than there is supply today.
Now, what are we using to measure when or how close we are to an equilibrium there? The new home sales have been just cranking higher. We've seen some pretty incredible numbers that suggest to some degree some of these this level of buying hasn't been seen in over a decade plus. So from that perspective, it looks like a lot of people relative to history do have homes, but the idea is that even more want them. So what is going to be our sign if historical levels for some of these indicators are not going to be it?
Yeah, I mean, I think inventory is the number one sign right there. Right now, on both the new home side and the resale side, there's very little inventory available for sale. I think as the year goes on, some of those constraints should get alleviated a bit, at least on the new home side. Builders have been buying a ton of land, and they're going to be opening up a lot of new communities as the year progresses. So if the builders are able to maintain the sales paces that they're experiencing today as more supply comes to the market, that would be incredibly bullish. I also think on the resale side, with as much home price appreciation as there's been, it's possible you see some people decide to make a move and put their home on the market. But the real tell is going to be inventory and how quickly that inventory is absorbed once it does come to the market later this year.
Right now, we've also got a big influx of money coming into the economy through stimulus. Personal incomes have been climbing over the past year despite the virus. Savings are very high. What role will that play in determining how much more is still to come? If we see savings rates and incomes slow, then is that a negative sign for the trend in housing?
Well, interestingly, if you look at the stimulus last year that was kind of thrown into the economy, there were very few places to actually spend the money, and housing was one of the few that consumers actually could go out and put money into their homes. This go around, there's going to be a lot more options. There's going to be vacations. There's going to be going out to eat. So while the stimulus that's being thrown out is certainly incredible in terms of the magnitude, there's going to be more areas where that money is being spread apart. So as far as housing is concerned, we think housing is going to get its fair share. You're going to continue to see repair remodel activity at quite high levels, and you're going to see probably people taking advantage of that to make down payments on homes and potentially make a move. So it's definitely something that will continue to boost demand, at least for the next several quarters.
One of the things that your team measures is the percentage of communities where sales by home builders have been intentionally limited. I think this is very interesting, right? I mean, obviously, it's been climbing here. The latest read as of February is 45% of the areas that you survey for the team at Zelman Associates shows that home builders are limiting those sales. Now, is that clearly that means there's a lot of supply sort of limitations? Is that because they don't have the ability to build these homes given the prices for input costs? Is it just because they can't build up to the demand? Because there's two sides of the equation there, right? If say they don't have enough material, or if it's too expensive at the time, then is some of this on the home builders where they could ramp that up and fill this gap?
Yeah. It's really, it's multifaceted. So land is the biggest constraint right now. So if you go back to when COVID really began, a lot of the builders reacted by kind of just pausing new land acquisition. They didn't know how bad things were going to get. Obviously, everybody was caught by surprise about how quickly and dramatically things accelerated. So builders had to jump back into the land market as quickly as possible. But because they took that pause there's a little bit of a void in terms of new communities that are ready to open up. And at the same time, they're closing out of communities a lot faster. So if you look at the public builders, their community count was down about 7 to 8% year over year in the fourth quarter. And that's probably going to continue here in the first half of this year. So the last thing the builders want to do is sell out of a community and not have a new one to replace it. So that's one thing. Labor is a big piece of it as well. You know, you just have a lag in terms of when builders can sell a home and when they can get that home started. There's not enough labor. So the last thing a builder wants to do is sell a house that they're not going to be able to start for 2 or 3 months because they don't know how much it's going to cost to build that house. They don't know how much the lumber is going to cost. They don't know how much the labor is going to cost. So what they're doing is they're actually capping the number of homes they're willing to sell right now. So if they have a community where they were selling 6 or 7 homes in a month a few months ago, now they may only be selling 4 because they don't want to burn through that project too quickly before the next one is ready to go. So the 45% you mentioned, 45% of the communities that we track in our private home building survey every month, and it's a big sample size. It incorporates over 15% of national new home sales. 45% of those communities, builders are intentionally capping how many homes they can sell. 2 months ago, that number was in the 20s. So it's really accelerated sharply.
Are there particular companies, home builders, that are having the most difficulty reaching that demand? I imagine if one views that as a good thing, then this would be a decent proxy for finding the home builders that are the strongest.
Yeah, so I mean, I think in this environment, what you'll see is the larger builders will really outperform. They've got the access to the labor, they've got access to land. Not to say that all public builders don't have an advantage over, say, smaller custom builders, but even within the public universe, there's a pecking order. And you know, thinking about Lennar, thinking about D.R. Horton, those are 2 builders that really have well-oiled machines in terms of starting homes on a consistent cadence and selling those homes. So I think what you'll see as the year goes on, builders are going to have a number of headwinds. I think you'll likely see some delays on deliveries. You could see some cost pressures that disappoint on gross margin. That's probably more of a 22 story. But I think Lennar and D.R. Horton are 2 builders that are definitely in a position to hold up better than others.
All right, Alan, really like the details. Thanks for the commentary here. They are under pressure today, but seems like the fundamentals very well intact. Appreciate you being here.
Thanks for having me. Take care.
Alan Ranners, Managing Director of Home Building Research at Zelman & Associates. Home builders with so much demand, they have to intentionally limit what they can supply. That there is the bold case even in a rising rate environment. There's still so much need for housing that they can keep on building. When we come back, the Chart Master is going to take a look at 3 very different companies. We'll check in on Intel as one of the semiconductor stocks that's been holding up through some of the weakness, though today it is down as the overall group is under pressure. We'll look at Clorox, the one-time winner of the quarantine trade. I guess we should all feel better that this stock is trading back where it was the first week of April.
Feel that? That's the beat of global markets, the rhythm of the world. For most, the cadence of today. To us, the pace of tomorrow. It's people and machines uncovering opportunity. Cloud computing providing endless capacity. Blockchain making transactions safer and faster. New markets born where they weren't before. With ingenuity, technologies, and markets expertise, we create the possible. And when you do that, you don't chase the pace of tomorrow. You set it. NASDAQ. Rewrite tomorrow.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now.
Welcome back to Morning Trade Live. Ben Watson, the chart master, looking at the technicals on 3 very different companies here, Ben. Let's start with Clorox, where, hey, if you're a bull in the stock and you've been holding it, it's not a fun one to look at. But for the rest of us, thinking about its connection to COVID, it might be kind of nice to see this thing trading back to where it was in April last year.
Yeah, and I think a lot of perspective fits with that idea, right? That this has been moving in a downward trend as cases have been going down. I don't know necessarily the need for sanitation that they provide through their products has gone away, but at the same time, we've been seeing the price of the stock moving in this intermediate to long-term downtrend. Now, something interesting, Oliver, is really starting to happen here. It broke this support at the 193 mark. It made a higher low. It made a new lower low, and then it's now rallied back up and retested that 193 from below, and it's building a couple of things here. It's giving us the possibility of this inverse head and shoulders as a potential for reversal. So on this gap down sell-off on the downgrade, that takes it just near that support level that created the left-hand shoulder. We might see this become a right-hand shoulder if it reverses from here. If it doesn't, we might see this back down into that 177 level where that head is, that lower low, and then continuing to move in the downtrend. So it's kind of on that, in that point where it could go either way, but long-term sentiment flat down and oversold, intermediate term sentiment though reversing out of overbought. I think in the near term you still see this maybe down on 177, continuing the downtrend before you see this reverse back to the upside, Oliver.
Okay, so Ben, it seems like we are under pressure and it's not relenting.
Yeah, at the moment I think you're right. I mean, I think you see the gap down, that sell-off from the downgrade, you see that selling pressure, you see it in the intermediate term sentiment as well. There is the possibility that this creates a little bit of a possible reversal. This is how those reversals get built, but it's not there yet.
Okay, Ben, so Clorox making new lows as we speak on the day, down about 4.5%. D.A. Davidson downgraded it. They say it's no longer a buy. It seems like it's been that way for a while. Price target of 189, which is where they have moved it to. Point being is that the trend has been so clear in this thing now, despite that, when we had the last big move in Clorox, that was a little bit late to the show when the winter COVID cases had been surging. So even though it made that big push, as soon as it started to give back up, it seems like that was a major tell that this thing was losing its favoritism on the street.
Yeah, and I think it really is, a scenario here of what have you done for me lately, right? I mean, I don't know that necessarily the fundamentals have changed. They've worked out some of their supply chain issues. Revenue streams are good. People are still buying their products. It's just a matter of, is this related to the current narrative and story that's going on with the pandemic?
Okay. All right, Ben, so Clorox right now down and looking at 180 as the previous level this thing was at is potentially another price to revisit here. Ben, let's go over to tech companies. You got 2 of them, different in nature, but Intel is the one I want to start with. Lower by 1.5% today, but just down from making a new 1-year high yesterday, as the stock has been more like the Micron, Western Digital, the used to be out of favor, now in favor chip makers.
Yeah, absolutely. And one of the things to remember, and as I was putting this chart together, looking through some of the news that's out there and some of the co-branded products that they have with Micron that they're co-developing and some of the changes there. So it's not unusual to see them gaining some of that momentum as well. But intermediate term uptrend here, breakout of this ascending triangle under the 64 and a quarter resistance. That breakout target, coincidentally, is right about those January 2020 highs. So a little bit off of the 1-year time frame, but that's up around that 68.50. That's where I've got that dotted line, not that far away. We see a little bit of a gap down into a sell-off today, but I think that may bring it back down as a potential bounce up off of that 64.25 mark. If it does, we see it bounce up to that 68. If not, watch the 62 level. That's that little bit of a support level that we can see underneath that horizontal. Combined sentiment, though, is clustered up and overbought. That's a possible short-term reversal signal. I think it may reverse back to the support and bounce, but it may also break down through into that 62 level, Oliver.
Okay. All right, so Intel making a little bit of a move, trying to break out, but the $60 area that we have been pushing through perhaps still kind of beckons for potentially a test if we do see any weakness emerge. You've got a price target hike over at Citi on the stock, and I do think that there is still just a lot of analysts that are not on Intel's side. They don't think the stock is belongs, in a market with NVIDIA and AMD that have really been chipping away at their, industry, of course, no pun intended there. So, Ben, it seems like right now this thing is definitely, for the most part, building momentum against kind of that consensus.
Yeah, and I think that momentum will continue if, in fact, this does make a bounce here, if it comes down to that support at 64 and then it rallies up from that level as maybe a next leg on that upward movement. If it doesn't, then I think it's confirmation of kind of this longer term, if we look at this in the longer term perspective, sideways movement that Intel has been making and really oscillating from those lows all the way back up to these highs and back again.
All right. Now let's do one more. Let's go over to Lumentum. Let's talk some of the 5G tech and infrastructure that has had a very volatile chart, Ben. When we think about the telecom space and the geopolitics involved, Lumentum has always been a stock that kind of gets stuck in between U.S.-China relations stories, but there are many who make the case that with the continued 5G build-out, this is a great place to be. Only catch is it's been very choppy compared to a lot else out there. At $87, it's up from the $60 of a year ago, but small gains compared to some of the other stuff out there, and it's pulled back from the highs pretty steadily this year.
Yeah, still overall, I think a long-term uptrend, but in the intermediate term, a little bit more complex in terms of what's going on. We see a breakdown from this head and shoulders pattern that it created, that neckline sitting right around the 94.5. Now we get this little downward channel. Now it's on its way, I think, towards that pattern target down around the 79 mark. That's that dotted line that I've got there just below where price is. But what's happening also is that it's getting this bounce down from the channel top. It's staying within this downward channel. And today we get a little bit of a gap down rally at that mid-channel support that's bouncing it back up towards the top of the channel. So this could have the makings of a potential reversal. If it turns and moves higher here, that's going to be a higher low, which it hasn't yet made, and that could be a change. What you see, though, is long-term sentiment deep down and oversold, not really turning yet, and intermediate-term sentiment rejecting that overbought line and turning lower. That suggests there might be a little bit more downside momentum here before it finds a stopping point, and that stopping point may be that pattern, that pattern target down near that 79.
Okay. All right, Lumentum trending lower. That seems to be on the mind of the downgrade by the analysts today. And the stock, which is now 1% lower, it may not be huge, but when you combine it with a bull turning to neutral, that's the Rosenblatt analyst, price target to 97 from 105, technically still would be a buy at 87, but essentially what they're saying is the bull case is no longer compelling enough to pursue this. So, Ben, do we have an idea in mind of where this channel takes us next?
Well, I think since it's sitting right at or bouncing up off of that mid-channel, you might see this retest that mid-channel, that channel top. If it bounces, then look for this back up in that 91 level. If it breaks down through that support level, then I think you got to watch for this to be down on the bottom of the channel somewhere around the $80 mark.
Okay. All right, Ben, thank you. Chartmaster, little heads up here on Lumentum. but maybe also a heads up to the upside for Intel if it can hang out above 60 still and extend for a real breakout. Ben Watson, Chartmaster. When we get back, it's market meetup time. Nothing's changed since we opened. NASDAQ down, yields are up, bond prices down. We'll discuss with our guests next about what to look for here until the end of the week.
Many option traders tend to focus on price and direction, but implied volatility can also be a big factor in options trades. In the Options for Volatility course, we explore what implied volatility is and how it can potentially affect the price of an option. For example, let's say an option trader wants to take a bearish position on a stock, but isn't sure whether to buy a put or sell a call. Both strategies are bearish, but looking beyond direction to consider the impact of implied volatility could help the trader choose between them. We also introduce strategies designed to harness changes in implied volatility. For instance, time spreads like calendars and diagonals are designed to benefit from increases in implied volatility. Iron condors, on the other hand, are designed to benefit from falling implied volatility. After learning about the strategies, you can take the final assessment to test your knowledge. Head to the Education tab on Thinkorswim for the full Options for Volatility course and a whole lot more.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now.
Feel that? That's the beat of global markets, the rhythm of the world. For most, the cadence of today. To us, the pace of tomorrow. It's people and machines uncovering opportunity. Cloud computing providing endless capacity. Blockchain making transactions safer and faster. New markets born where they weren't before. With ingenuity, technologies, and markets expertise, we create the possible. And when you do that, you don't chase the pace of tomorrow. You said it. NASDAQ. Rewrite tomorrow.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now.
I'm Maria Schrader. Here are a few stocks moving this hour. A JP Morgan analyst expects the recovery in Disney's parks division from COVID-19 will be faster than its recovery from the financial recession in 2009. She says Disney is optimizing the period of closure and limited capacity by making advancements in operations and consumer experiences, suggesting the segment could ultimately emerge stronger than it was pre-pandemic. JP Morgan has an overweight rating and $220 price target on the stock. Shares are down over 1% today. Jefferies lifted Kohl's price target to $71 from $66 and kept a buy rating on the shares. The analyst said after speaking with some of Kohl's executives, she had greater confidence in a pathway towards superior margin mix, cross-channel benefits, and a more cash-productive business. She also sees intriguing tailwinds, including stimulus, Amazon returns-linked customer visits, and pent-up demand for full-price fashion. Shares of Kohl's are up around 2.5%. A Morgan Stanley analyst said he believes investors are beginning to witness the most transformational chapters of GM's strategy, and the company is far from satisfied with the $60 per share price target. He keeps General Motors as his top pick for autos and has an overweight rating and $80 price target on the shares. Shares are up over 3% today. This has been your TD Ameritrade Network Market Update. Now back to Morning Trade Live with Oliver Reddick.
It's time for the Market Meetup panel. Let's talk about bonds connected to stocks, connected to crude oil, and more. Stephanie Lewicki joining me, as well as Nick Theodorakis this morning. Guys, happy Thursday. We've got a little bit more of the same. A little reminder here that stocks are still stuck to bonds. And let's start, though, with something different. Steph, let's go to crude oil. Ben and I talked about it this morning, that crude was under some pressure. Dollar firm, but man, 4% down now. We haven't seen a sell-off in crude like this in a long time. We got to go back to like maybe August for a move of this, maybe even further.
We can go back to November, Oliver. That's the last time we saw a move this big.
All right, thank you.
We're pretty much have erased all the gains since that OPEC Plus statement a couple weeks ago that they weren't going to increase production. And I think what we're seeing on crude oil is there's still really supply and demand issues. And I think with the rising COVID cases in Europe, I think that's mainly really what's worrying crude right now is cases in the U.S. are decreasing, but Europe is still struggling with the coronavirus. And then you're hearing too, there's some China, maybe in Asia, lower demand there. So as crude was approaching up to that 67, 68, and the indices were kind of wavering at that time. I mean, we're back at record highs for the most part besides the NASDAQ. Crude just kept taking off, and we had mentioned that, talking the divergence we were seeing between the equities and crude at the time. And now, this move back, again, I think it still is showing maybe we're not out of the woods yet. The crude yesterday, it was a build of 2.3 million, I think, and that was right in line. But that followed a couple really, really big bills at 13 million the prior week, and I forgot the one the week before, but it was big. So again, like you said, the dollar could be putting some additional pressure on, but I think this is something definitely to watch.
So maybe I remember when we were talking about that breakout beyond $60, that long-term downtrend of the highs and lower highs for crude going back a long ways to 2008. That breakout above that kind of generational downtrend. Maybe we're just testing that. I mean, Nick, when you've got something trending one way for a long time and then suddenly you push up against that trend, maybe we need to see if it was for real.
Yeah, I mean, you heard people a few weeks ago, Steph, talking about oil back to 100, and I do think that when it's run that far that fast, remember it was negative, right? This is close to $100 rally off the lows from the pandemic. I mean, if you really take that front month expiring contract into account, so the recovery is unbelievable. So it's taking a bit of pause, and I think I love what you said. I was going to bring it up at some point here, Steph, about the idea that Europe is lagging, and there's this sort of deviation between what looks like a really strong recovery in the U.S. now, with a lot more stimulus put on top of that. But that's not what's happening around the rest of the world right now. There's a bit of a lag, and then you take what Powell said yesterday about keeping rates low through 2024. Are other countries going to be able to maintain that and then see that growth back? So I think this is a bit more of a global demand issue than it is just a U.S. issue. And then couple it with what you said, Oliver, on we've run so far so fast. You hit up against some resistance there, and I think that it all kind of says maybe a little frothy in that rally over the last, call it, 3 weeks, and then, a bit of a pullback. But still, you look at where it's come from, and is this a buy the oil dip scenario today, or is this something that's really going to break down? I think demand is certainly set to grow in the U.S. for sure, and then obviously internationally as well. So it's just a matter of, is this a little bit of a pullback, or is there a bit further to fall before we kind of step on the gas again? No pun intended. And you guys all know my super long-term oil theories, so I won't get into that. But I think in the short term, there's going to be pent-up demand for sure.
I will say that speaking of stepping on the gas, it's kind of been a back and forth session so far for the things that require crude. Airlines, cruise lines, some of the auto cyclical plays, they are generally firm on the session, but we kind of opened up strong on some of the airlines and then faded it. Now we've regained our footing and they're higher, but so far the market has been very clear in its message on tech related to rates. It seems, Steph, on the other side, the reopened trade, it's better, it's firmer, but even there, we've seen if the selling gets too intense at Apple and others, then it's hard on some of these days to get the other group actually going up. They have almost never been down as much as tech on these types of days, but it doesn't always necessarily mean they're ramping higher.
Yeah, you have Tesla down over 3%, Apple down almost 2%. I mean, those have to be on your watch list right along with all the indices.
Yeah.
But yeah, yesterday you kind of really got the green light from Powell, but bonds kind of gave the red light or a caution sign as we saw rates on the rise. 175 or 174 got up to on the 10-year. So the market is still closely watching that and trying to digest that, and it has been hurting the cyclical, the mega tech stocks really the most. It's not surprising, but you're seeing the Dow with the financials and the industrials that are doing well here. But yeah, I think we're all still keeping our eye on that, watching tech to see if, because the market, I don't think we can have that big of a divergence between the NASDAQ, the S&P, and the Dow and the Russell for that long without something, someone's got to meet somewhere. So is it the market going to fall with tech, if tech keep falling, lagging, or is tech going to catch up and everybody's going to be okay with this? And I think it's still, we got to watch rates, and if they're going at a slow pace, I think that's fine, and the market will be okay with that. But it's really the velocity of the move, and if we get any big snap, then you can see some worry in the market.
What I've been looking for is if we can finally get a day in which yields are meaningfully higher, and the NASDAQ is too. To me, that's kind of like the holy grail that bulls should be looking for, where if that happens, Nick, and we do break away from this relationship, then it seems like there's really nothing left to get in the way of bulls, right? I mean, this is kind of like the last bear case, at least unless you have a fundamentally negative economic view or you just think that froth is going to roll over, but good luck timing that. To me, it's like rates are the last potential hurdle, and it is creating a bit of an issue for tech, but there's a lot of people who come on here and say, look, this is only a brief moment in time while yields are spiking. Once they calm down, tech's free to run. But I don't know. It doesn't look like yields want to calm down, Nick. Okay, there's the Oliver question that you love. It's not really a question. Go.
The statement question. Very good. I tend to generally agree with you. And we've talked about it a little bit here, right? The Fed can only control the extremely short end of the curve unless they change their policies and change their buying practices. And we heard yesterday that, ultra low end, right? Ultra low end, ultra short-term rates are going to remain low, and that's what's directly in their control. But they didn't say they're really going to change their buying behaviors, right? They're going to continue to buy, but I think the market's saying, look, it's bigger than you, right? It's bigger than you. And you look at the financials today, you got Goldman Sachs up 3% on no news, right? Well, the news is that the yield curve is steep, and these banks do really, really well. And you kind of put this all with the pandemic sort of style of altering your business model, and we've proven that we can work from home, right? We've proven that we can adapt in all these different industries. And now you steepen the yield curve. These banks are going to do really, really well in that time. So yeah, it could be room for tech to run. But as rates go up and other industries perform well, like financials, are people going to pile back into tech if there's other alternatives? And I think that's a real question to answer. So yes, if the curve It doesn't have to flatten necessarily from here, but if the curve stabilizes from here, you're going to have people saying, okay, I can go back into tech because I know now where rates are. But if it ends up being really volatile, you're going to see people jumping into these other industries that have been beaten up that are going to benefit from a steeper curve.
Okay. All right, so a steeper curve could be good for some things, and certainly they are doing all right today, as we do have banks up 1.7%. Definitely a notable move there. Energy stocks, though, are down as crude gets hammered. Thanks, guys, Nick and Steph. Good stuff. Really good panel here, connecting the dots. Alex Coffey is preparing for Fast Market with his co-host, Kevin Hanks. Alex, what's up today?
Well, good question on what's up. Looks like the dollar's up, but as far as what we're covering on Fast Market, we're going to be talking some earnings in terms of Nike and FedEx, and then you can't really talk FedEx without talking UPS, so we'll round out the conversation, trade UPS at the end of the show.
All right, makes sense. FedEx, UPS, and Nike, the shoes and the stuff that ships them to you. Thank you, Alex. Fast Market's up next. I will see you this afternoon. Market on close at 2 p.m. Central Time, 3 p.m. Eastern. That's an hour before the close.
Many option traders tend to focus on price and direction, but implied volatility can also be a big factor in options trades. In the Options for Volatility course, we explore what implied volatility is and how it can potentially affect the price of an option. For example, let's say an option trader wants to take a bearish position on a stock, but isn't sure whether to buy a put or sell a call. Both strategies are bearish, but looking beyond direction to consider the impact of implied volatility could help the trader choose between them. We also introduce strategies designed to harness changes in implied volatility. For instance, time spreads like counters and diagonals are designed to benefit from increases in implied volatility. Iron condors, on the other hand, are designed to benefit from falling implied volatility. After learning about the strategies, you can take the final assessment to test your knowledge. Head to the Education tab on Thinkorswim for the full Options for Volatility course and a whole lot more.
Feel that? That's the beat of global markets, the rhythm of the world. But to us, it's the pace of tomorrow. With ingenuity, technologies, and markets expertise, we create the possible. And when you do that, you don't chase the pace of tomorrow. You set it. NASDAQ. Rewrite tomorrow.
Good morning and welcome to Fast Market. It's Thursday, March 18th. I'm Alex Toth. Let's take a quick look at where things sit. Now that we have the Federal Reserve in the rearview mirror, at least for this recent meeting here, got a little bit of a mixed market here, but primarily to the red, with the S&Ps now down 19, the NASDAQ down 209. That's 1.6% to the downside. The Russell 2000 down about 0.5%, in line with the S&P 500. You have the Dow Jones up 0.25%. The price-weighted 30 stock index is up about 90 points here. So take that with a grain of salt based on the calculation, the number of stocks in that. You can see it shrug off some weakness in the general market with a couple names able to buoy it. 10-year yields up almost 10 full basis points to 1.73. So they are screeching higher here. The dollar higher as well. Crude oil plummeting down 4.4%. To help me break down this action and more, let's welcome in the co-host of Fast Market, Kevin Hanks. Good morning to you. And Joe Mazzola, Managing Director of Trader Education at Charles Schwab & Co. is joining us as well here on this Thursday morning. Guys, I don't know if it's just me, but this feels like it is the slowest week of history. I mean, I've been off by 1 or 2 days, I feel like, all week long, and it is just crawling at a snail's pace. And I don't know if it's we've gotten accustomed to fast-moving markets and it's been a slower market or what, Joe, but is it just me, or is this the slowest week ever?
Well, you had, the FOMC meeting Tuesday and Wednesday, and you had St. Patty's Day yesterday. So come on, you had all that build up, and then this is the crescendo afterwards. So, I mean, Alex, you're right. It's, I think it's more than just this week. I think if you look at what the market has done, literally the past month, it's been a 37.50 to 39.50 with a day or, a couple hours or two, I guess, above that 39.50. But we've been in a fairly tight range. The VIX has indicated that range is tightening as we go. I mean, here we are basically at 20, which has been the bottom end of the range, and it seems like we're finding a new home. It's just we've been talking about this for a while. Like, what's the catalyst? So everybody thought, okay, maybe yesterday's a catalyst. Fed Chairman Powell comes out and he basically threads the needle. In my opinion, he did a pretty darn good job of quieting some of the concerns about the inflation in the market, at the same time saying, look, even though there's average inflation targeting, that's not credible unless you have realized inflation. And I thought that was a pretty important point, that, even if the average inflation is above current targets, unless you have that realized inflation, and we talked about kind of the realized yield on the 10-year, I mean, that's actually negative at this point. So we don't necessarily have this launching point, even though the Treasury markets might be pricing in right now, in his mind and in the mind of the other governors, that dot plot, everything is a 2023 target, and it seems like we have some room to go until we get there.
Well said. I want to unpack that further here, but let's get Kevin's opening thoughts here. Kevin, oftentimes after the FOMC, it's not uncommon within 24 to 48 hours, in this case, even a little bit quicker, you undo a lot of that move. It's a quick reaction, and then we kind of see the market ease back, whether that's a sell-off or a rally. In this case, a rally, and now a bit of a selling of the rally.
Yeah, yesterday to start the day, yesterday to finish the day, this morning to start the day. There's a lot of price discovery going on in not only bonds, but the dollar, crude oil, stocks, when it looks at the NASDAQ versus industrials and financials. So there's a fair lot going on here. And Joe said it about as clear as you can say it, which is Jerome Powell was able to walk up the expectations for the U.S. economy. He walked up GDP from 4.2 to 6.5. He walked down unemployment to 4.5 without scaring the children about inflation. Now, the bonds are soft this morning and rates are higher, but Jerome Powell basically said inflation is not a problem and their asset purchases are going to stay as is. So, he was able to do that, and the market reacted very positively to it. Now, much like you just said, the market has reversed a lot of what happened yesterday, but this day's not over yet. And a lot of these markets, NASDAQ, S&P, they're all off their lows of the day already today. So, buying the dip, which worked yesterday, right? Jerome Powell comes out and speaks. We have a nice end of the day rally. Now we'll see what happens today and if there's a trend forming here, as try to sell them off in the morning. And then it's kind of a heavyweight battle to see who wants them and who doesn't. So there's a lot of price discovery going on is the theme to my speech here.
No, and I think it's well said, well delivered. Joe, I want to unpack the Fed a little bit further, because while I agree with both of you, and I do not envy Jerome Powell's role as Federal Reserve Chair and the constant kind of tightrope that he must walk, I do agree that he did a decent job in terms of not really rattling the market, but I'm not sure that he eased fears if you're in the camp of inflation being a problem. And so let me kind of see it laid out with the risk of oversimplifying things here, Joe, and please correct me or agree or whatever you see in terms of trying to get to the bottom of this narrative. I see it as there's kind of two camps. There's one that's very, very optimistic about a recovery, and that needs the economy to get back. We're on the trajectory. The policies are helping that. Inflation is not a worry. The other camp is, well, there's a lot of this in the future. Inflation is a worry, and this policy could make it worse. What I heard from Jerome Powell was, we're not going to take action until we see it. So to me, if I'm worried about inflation, I just got confirmation that they're going to be late to the game in terms of doing something about it. And they also use the word transitory quite a bit in terms of if we see it anytime soon. So it sounds like we've already laid out the narrative to excuse any near-term inflation. And if we do see it, we're going to be late to the game to combat it. But at the same time, because of that, if I'm in the other camp, I've got a lot of reasons to be optimistic. Monetary policy is going to remain easy, and I've got confirmation about that now.
No, look, I think you're spot on, and I think I would look at it from this standpoint. There's two mandates for the Fed, right? Price stability, and then jobs. And right now, I mean, they're currently in the camp of promoting job growth. I mean, we had unemployment today come out and kind of miss the mark again for weekly unemployment claims. I think 770 versus the 700 expected. So, it's a move in the wrong direction. The Fed sees that, and they said, look, we are willing to let things run hot on the other end a little bit because, as I mentioned before, the inflation that we see kind of hitting right now, is it realized, and will it stick? And I think that is the point that they're making, is that the bottom line is what we're seeing right now, while it is above average, it's not something that they see credible for realized inflation over time. And what they'd rather do is they'd rather overshoot and adjust those targets upward and then deal with it later on down the road. Now, what you said is spot on, because just because the Fed says that doesn't mean the market believes them. And I think that that's what you're seeing, today with the 10-year yields at 1.73, is that the market says, yeah, sure, you can jawbone all you want. But at the same time, we see what's happening in the markets right now. Even though CPI, PPI, PCE, a lot of those aren't showing sustained inflation, in the immediate term, we can feel it, right? We can feel it with energy prices going up. We can feel it with food and cost of inputs. You see it when housing. I mean, that's something that I mentioned in my notes, is that, really keep an eye on not just the fact that the rates could be kind of slowing down the permits and the refis, but also take a look at some of the input prices for lumber and some of these other goods that builders are going to have to pay for. And it's causing them to slow down a little bit as well, too. And what's really important about that whole construction sector or industry is that is one of the few industries that's actually ratcheted up higher than pre-pandemic levels. So that's something I think you absolutely want to keep an eye on.
Good stuff. And hey, Kevin, last kind of thoughts on this. I think it's an important conversation. I want to round it out here. A big kind of theme of Jerome Powell's press conference and the question and answer session was, focus on actual data, actual outcomes, not necessarily expectations. However, there's a lot of talk of, hey, we're in a different inflation regime. And I think there is credible information they use to support that thesis. But it sounds like, what we're supposed to do is look at data in the sense of any of our expectations, yet we're supposed to take a lot of their kind of thoughts in terms of their projections for inflation as credible. And not to say that they don't have information and that they're right or wrong, but and not to sound like Chicken Little, just want to be balanced in this. It sounds like a lot of this time is different. And whenever I hear that or I read about that in history books, it doesn't tend to end well. Isn't the greatest risk right now in an economy that's putting itself back together inflation and economic kind of stalling out or even going the other direction?
Well, it's certainly what can stall this recovery is inflation for sure, because of what we went so low in terms of rates and the overall economy slowed down. What we've got right now is we're approaching a target with our foot, our pedal to the metal in terms of revving up the engine of the U.S. economy. The problem is, can we slow it down when we get near the target, right? I mean, hopefully we have good enough brakes or a braking system to moderate as we get closer to the target, not just blow by it. and then have to lock up the brakes later, because that would be the the not ideal outcome. But what really makes me chuckle about these press conferences and everything is everyone's focus on the guidance going forward and the projections going forward. And there's Jerome Powell saying, no. If we've learned anything over the last years, right? Forecasts mean so little, right? And Jerome Powell basically said that yesterday. He goes, I've got the economy, or I've got the rate on a dial, and I'll move when I see it, not when you guys predict it may come in the future. So, yeah, Jerome Powell is basically thumbing his nose at forecasts and seeing them, but saying, yeah, but that's not here yet. And so, yeah, I thought Jerome Powell, he's really grown into this position. He's really an excellent orator when he's up there on the stage. And the market reaction yesterday, I think, proved that, guys.
I agree with you, and I thought it was an important statement in the paraphrased way to basically emphasize that, guys, in terms of, hey, we're going to focus on the outcome of the data, not the actual expectations. You know that they have their own expectations, otherwise they couldn't do that. And so they still, and many of them are projecting that this isn't going to be an issue, otherwise they would be taking a different stance. But they're willing to be nimble and hear things out when they see it. So I think that was the big takeaway. And the market yesterday loved it. Today, easing back towards where we were, kind of a nothing outcome, at least so far, about almost 24 hours into it. But let's do some quick trade management, and then let's move on here and talk some Nike. Discount retail, Kevin, 5 below. We sold the put vertical. The stock has remained stable enough. Pretty sizable open profits on this one. It's 10 cents. Pretty easy trade management. Take this one off as far as I'm concerned, unless you want to try to squeeze out those last few pennies on that one. We also looked at Dollar General. And Kevin, this one's looking pretty nice too, because if you recall, we did the double calendar, but we gave it some attitude, and we gave it some attitude to the downside, and we got a downside move. So it overshot our strike, but it's looking pretty nice still. We're long 2-to-1, the 180 put calendar to the 197.5 call calendar.
Yeah, exactly. Remember what we did. We weren't sure. We weren't willing to be sure that the stock was going to go down, but like Folio's data was kind of bearish or less positive, and that turned out to be like Folio's data. Let's give them a little tip of the hat. It was spot on in terms of what they were looking for, and the stock has gone a little bit past our strike, but we're still in a nice profit zone. And we took that double calendar, our unwillingness to say it's just going one direction, and we gave it a little attitude by doing 1 call and 2 puts.
Well said. And so, Kevin, what I did here is I went ahead and I'm working our put calendar at $1.25. It's a little bit above the market. You probably need a rally in the stock to get that price, but it's now front of center, front of mind, as it's in our order book. The call calendar side, because it's quite substantially out of the money now, I can look at where it's priced, but my assumption is that it's probably not a lot of value left in this side here with just a couple days to go. So let's see, and it looks like 7 cents. So you could maybe salvage those 7 cents if you were able to get filled there, or you kind of look at it as, that's kind of an upside, almost like a free play, a free option in a way that, you just have 7 cents in risk. If the stock were to meaningfully turn around over the next week, that could potentially, expand, and you could kind of win on both sides. Probabilities of that probably pretty low, but again, it's 7 cents. So for each, person at home looking at a position, and whether it's in Dollar General or a different name, those are the kind of conversations you have with yourself. Are you willing to risk that 7 cents for a low probability outcome, given that you already have a pretty sizable gain in the overall position? In this case, I think we'll go ahead and leave that part, and we'll work to sell out the put calendar. Joe, let's talk some Nike, though. Kevin and I always say on this program that Nike kind of, for us, thematically represents almost the end of an earnings season. So it's always kind of a sad day when we're talking Nike, but it is a late earnings season name. But this has been a powerhouse of a company for many years, and really ramping up last year as it's really focused on its direct-to-consumer and e-commerce arm, trying to cut out the middleman, work directly to the consumer to get the product out there at a cheaper price, but also higher margins for the company. And they couldn't have been more prepared to do so in a time where it was very necessary to have that all built out?
I mean, remember, they started building out some of those supply chains way back in 19. Once we were smack dab in the middle of the Chinese trade war, so they already started to make some of those movements back then. It's interesting because as I was looking for a trade setup for this, I was kind of looking at what Nike's tend to do or has tended to do over the last few earnings cycles, and we went back, I think, 37 quarters here through MT Newswire. And you're not going to like to hear what I have to say, but basically what it says is it kind of mostly favors narrowing or reversing its post-market earnings trade. So basically, wait till the next day, kind of see what happens, and then you can kind of fade the move. But I will say this. You got a company, they're expecting about 76 cents of earnings per share versus 78 cents a year ago. While it is a powerhouse, we basically had flat earnings and sales for the last 5 years. So you haven't seen a lot of growth. The stock is trading in a range between 130 to 150. We're kind of at that top end of that range right now. We're above all the moving averages. And the implied volatility is in its kind of 64th percentile. So to me, that says, okay, I've got elevated implied volatility, which makes sense, kind of heading into earnings. So, you guys had looked at some calendar spreads early before on the trades you were just showing. I believe you called them was aggressive. So I don't know how aggressive we're going to get with some of these trades, but what I will look at is either, if you guys want to look at a double calendar, I think that's fine. Or, I had a setup for an iron condor kind of skewing a little bit more towards the downside. I'd probably be looking to maybe sell the 155, 160 calls on the 26th, so not this Friday, but the Friday out. Or if you wanted to skew that a little bit further down and make it a little bit more of a downside play, you could sell the 150s and the 155. But if you kind of want to keep it equidistant, I think the 155, 160 versus the 135, 130 put spread, you'll take in, my assumption is you're taking about $1 on this. So you'll take in $1 to have $4 at risk. The 145 straddle right now is pricing in about a 5% move, so around $7.25. And, as I mentioned when we were kind of setting up this trade, remember, there's a good percentage of the time, it's right around, 57% of the time that the stock tends to reverse its after hours move. So I would look at this trade like this. If you get that move that you want initially in the morning and as you're sitting at the desktop waiting to make that trade, I would take one of those legs off fairly aggressively, or at least pare it down a bit if you're putting a couple of these on, because there's a good chance that this thing might start moving in the other direction based upon past history.
See, I love that insight that you bring, because it's one, refreshing new information for some of this, but it helps you structure a strategy. It's not a guarantee by any stretch, Kevin, but if historically, again, you can't take historical data and project it on the future, but it is information that we can use. If historically you see those moves narrow post earnings the next day, well, that favors a strategy that's playing for a range-bound move. And so $1.05, $5 wide, that leaves $3.95 in risk. Break evens 156.05 and 133.95 here, Kevin. How much of that narrowing and maybe the inside kind of a move comes down to something you talk about a lot, Kevin, which is float? I see 1.5 billion shares outstanding. It's hard to move this stock.
Right, exactly. I mean, this is not a small company, especially when you compare it to some of its competitors. So, and Nike is, I'll stay on a theme when I talk about Nike and from March Madness, and that is rebound, right? Nike is rebounding from last year and getting their numbers back up where they were and pushing digital forward and pushing direct to consumer, speeding up the pace to direct to consumer. All that's going to show up very well. They're going to show growth in China. They're going to show recovery in the U.S. and in Europe. So the news is going to be pretty good, but the stock is up near its all-time high. And like Joe said, this move one way and then move the other way might turn out to be a big nothing burger, and that sets up for a range-bound strategy, which in this case is the Iron Condor.
Joe, not often you can say rebound with a stock that's almost 50% higher than where it was prior to the crisis. So it's rebounding well, and there's a lot of optimism going forward internationally as well. But kind of final thoughts here on the market as a whole before we say goodbye. We'll go ahead and send that order out. Joe, I want to give you one last thought.
Yeah, I think we're just in a market that is still in a wait and see. I think that the VIX 20 is a good indicator of that. This market has to wait for that next move, that next catalyst. We're out of the earnings season, as you mentioned. I think Nike is one of the last big names to kind of pull forward. So it just seems like this is going to be a grind it out for the next few weeks. And one thing I would say is, hey, enjoy March Madness. It starts today. So if you get a chance, watch a little basketball. Go back to Kevin's rebound idea right there. Enjoy the day, and hopefully everybody was safe last night. And so enjoy a little basketball. That would be my thing.
Good stuff. One eye on the computer, one eye on the TV with some March Madness. But the 155, 160, 135, 130. Iron Condor here. Next week's expiration, Kevin, we're working at 105. We'll do 3 of those. Again, $105 per spread is the max profit with $395 in risk taking place on an outside move outside of our long strike. Joe Mazzola, it's always a pleasure. The managing director of trader education at Charles Schwab & Co. Look forward to talking to you again soon. All right, Kev, let's take a short break. When we get back, we're going to talk some shipping. We're going to talk some FedEx. We're going to talk some UPS. FedEx earnings coming up. Stick around. We'll be right back.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Looking to improve your portfolio management skills? Our Portfolio Management webcast series breaks down key concepts like retirement planning, income generation, ETFs, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
This is my headquarters. This is where I trade and manage my portfolio. Since I added futures, I have access to the oil markets and gold markets. Okay, I'm plugged into equities, trade confirmed. And I have global access 24/7, meaning I can do what I need to do. Then I can focus on what I want to do.
Visit your online broker today to learn more.
Welcome back to Fast Market. I'm Alex Coffey, joined by Kevin Hanks. Kevin, quick check on the markets. You have the S&P is down 16. That's about 0.4%. The Russell's bounced back towards unchanged, only down 1.5 points now, so under 0.1%. The NASDAQ, however, has widened its loss, so it's down 234. So while on balance with the S&P 500 here, Kevin, we don't really see a big move from where we last checked on it, maybe a slight rally, but you're seeing that divergence, that rotation express itself even further here as relatively the Russell gaining some momentum on the NASDAQ as the NASDAQ continues to drag on the market.
Yeah, I mean, it's NASDAQ negative, Dow positive, S&Ps, only down less than 0.5% now. So, and the Russell, trying to make a comeback here. So, like I said, this is a heavyweight battle going on in terms of rotating out of some of the NASDAQ stocks, buying some, Boeing opened down. It's now up on the day. So industrials, financials having a good day. Really, really fun trading day here.
And Kevin, if you wanted to order some Nikes, you'd probably have to get them shipped to you. So let's talk some shipping. To help us do that, I want to welcome in TD Ameritrade Network contributor Jenny Horn. Jenny, of course, FedEx with its earnings release here in the next 24 hours. But you really can't talk FedEx, I don't think, without talking some UPS as well. Both the charts look a lot alike in terms of the shape of them. FedEx has outperformed those since 1/1 of 20. It's up.
Come on, Express. Jeez. Just been watching it over there and hit 6.34, which is awesome. It's dropped back down below 6, but still having a great day. Come on, Express, up 23%. Let's make that 50%. AMC just failure to launch, man. It's just going sideways after open great. Up about 6% now, but geez, come on, man. You guys can do this. GameStop at least is green now. Tesla's down, 3.5%? So, come on, AMC. Let's do this. Let's do this.
Air freight. So they are different in that sense. Now, of course, like you mentioned, FedEx has earnings today post-market. And to really, paint a picture of the scale and how much they've grown over the past year, analysts are expecting, or over the last 2 quarters, they're expecting to have earnings of about $9.55 a share, which will be more than their whole fiscal year 2020. So that is crazy. I mean, they have really been a beneficiary of course, this heightened demand with online shopping and more people getting things shipped to be more contactless. And for the third quarter, they're expecting earnings of about $3.21 a share on revenue of just over just shy of $20 billion in sales, which will be a significant rise year over year. Now, last earnings report, they reported a pretty significant beat on both top and bottom line, but the stock sold off about 6% following this report. So there is that concern of, like you mentioned, this volatility. Now, what everyone's sort of wondering is, will their pricing and profit margins be sustainable into, of course, 2021? Now, you look at a UPS, which reported the first week of February. They report again not until May, so a little bit of time there. They have seen this similar range-bound activity to FedEx, but like you mentioned, they're not really seeing this spike pop that FedEx saw. However, UPS continues to have a higher valuation than FedEx due to the fact that UPS is just better at generating profits from its revenue. Now, of course, we have to discuss when we're talking shipment spaces is the great disruptor that is Amazon. Now, they actually just had news this morning. They'll be expanding some of their tests with their delivery vehicles with their partnership with Rivian to San Francisco. So now they're pushing into this sort of EV space. They actually invested about $2 billion in the startup Rivian to expand their electric vehicle delivery. Now, of course, they're just in tests right now, but that does give FedEx and UPS investors alike some concern, which brings me actually to our tweet today, which says, I am thinking that Amazon will also be challenging FedEx and UPS in the next 2 years. Now, Kevin, I thought that Jerome Powell had this really, really great statement yesterday when he spoke, and he said basically, the forecast, not that they're meaningless, but it all comes down to the data. It's not so much about the forecast, it has to do with the actual numbers we get. So although, there is this concern that Amazon is coming for these two companies, it hasn't yet. I mean, and I think that with this surge in demand for e-commerce and online shopping, I don't see why the three can't benefit from the fact that there is just such a demand issue right now. There was actually so much demand that the three couldn't get their packages delivered on time, which isn't necessarily the worst problem to have.
Yeah, the worst thing you can do, Jenny, and Jerome Powell mentioned it pretty clearly. A lot of people trade off expectations, right? Mm-hmm. And if you trade off expectations, then when Amazon bought Whole Foods, by expectations, Kroger was going to go out of business. Remember the 2 days Kroger sold off an unbelievable percentage during that time and came all the way back. Why? Because here's my question. If someone would tell me, oh, Amazon's going to hurt FedEx, I would answer back, do you think FedEx is not going to compete? Do you think they're just going to sit there and take it and oh yeah, well, we'll get hurt and we'll go out of business? FedEx is going to compete. They're going to reinvent. They're going to adapt to any new environment like they have here. And so, the biggest thing that FedEx can cheer for or look forward to is business to business recovering. And that will, remember, FedEx was hurt during trade wars and lack of what you mentioned, Jenny, overseas deliveries, right? UPS is more domestic. FedEx is domestic and overseas. So much like Uber and Lyft, it's just a different kind of company between those two. So I think, FedEx is talk about an overall improvement in what they're doing. B2B volumes, I think, are important. Price durability, the impact of the vaccine distribution. Remember, FedEx is helping with that. So there's a lot of things going on here that are good news for FedEx. It ran up to $305. It's eased back to now $267. But their numbers are going to be gaudy, mainly because they're compared to last year when the numbers were horrible, guys.
Yeah, I think it's well said. I think there's a couple things to unpack here, too, in terms of there's overwhelming demand, as we know there has been over the last year as a result of the pandemic and a kind of a forced adoption of more e-commerce and more shipping. I'm probably not going to, as the average person, I'm not going to stop ordering something online because a shipper I don't like is the one that's going to deliver it. If I want a product and that's my only choice, I'm probably going to still get the product. And if it takes a couple extra days, it takes a couple extra days. And so I think some of the execution woes of a company like FedEx have been masked because, hey, we just need people to deliver items. And right now, that's really benefited both these companies. But Jenny, great setup for us as always. Thanks for joining us, Jenny Horn, TD Ameritrade Network contributor. As we say goodbye to Jenny, I want to welcome in Landon Swan, the co-founder of LikeFolio.com. And Landon, probably the most interesting thing here, and this is where we tip our hat to you at LikeFolio and your data, is how slow the market was to realizing, how strong these companies really were as a result of the pandemic.
Yeah, it was. You're right. I mean, it was a huge shift in everyone's behavior. I think a lot of people who are used to buying things online just started buying them online and more in bulk, and it's no big deal. But there was also a lot of people who did not buy online that started to in March, April, and May, and there was a massive spike in people talking about shipping. And of course, there was all kinds of delays. I mean, Amazon went from a standard 2-day to, 2 or 3 weeks sometimes. And FedEx and UPS both had a lot of trouble. In fact, when you look at complaints, people talking about whether or not they're happy, I mean, it was incredible how much it went down during that period. But it was a behavior change. And that's what this chart points out. I mean, you can see that people talking about getting things online, buying e-commerce, pretty steady, and you get a little spike around Christmas every year, and then you've got this massive COVID bump. And what's interesting is look at how much bigger this holiday season is compared to the previous. So yes, we're still in a little bit of a pandemic. There's still some shutdown happening and people have to buy online more than they did in the past. However, it's not nearly what it was in March, April, May. And now you've got a much bigger peak when it comes to the holiday season. Even if you compare it to the baseline in October, there's a much bigger peak. So this was a behavior change where I think it's just moving more people into e-commerce. And of course, companies like FedEx and UPS are going to benefit. However, they did struggle with execution. And you look at the happiness of these two companies. UPS started around 60%. If you go back 3 years ago, that's kind of their baseline, 60% happy mentions. During the pandemic, they dropped down to 50, and now they're back up in the high 50s, 57 or so. So, a little bit of a dip, but pretty strong. But if you compare that to FedEx, they started lower. They're around 55 or so. During the pandemic, they got as low as 37%, which is incredible. That's almost 2 out of 3 people talking negatively about their shipment experience with FedEx, and they haven't really recovered. It's bounced back up to 40 now, but it is, people are less happy with FedEx overall. And I know, obviously, LikeFolio data focuses on B2C. It's all about the consumer. So we don't have a lot of B2B data. And I think that's we've got to put a big asterisk on top of all of our data because of that. However, Alex, to your point, if you're shopping at a store and you want that product online and you buy it and whoever ships it, I agree with that. However, if you're the business owner and you're constantly getting people complaining or talking about how late their product was, you're going to consider switching from FedEx to UPS. And I think that is a big indicator for future revenue for these two companies. Long term, I think it's very bearish for FedEx.
So, Landon, I think you're touching on a lot of things. And I think the biggest thing that you're touching on is, and we have a lot of, this is a big discussion about FedEx and UPS, but the biggest topic and the thing that should resonate with everyone is the fact that behaviors as we know them have changed. And they've changed to and people's lives are easier because they're getting their box dropped at their door. Now, sometimes it's 2 days, sometimes it takes longer, but make no mistake, that thing that you order is still getting dropped at your door. And somehow, if you're not happy with a package being dropped at your front door, you don't have to go get it. You don't have to, figure out where it is. You don't have to drive to the store. It's being dropped at your door. This is a big change in people's behavior that I don't feel is going away. Now, there's still a lot of things that could affect FedEx and UPS's stock, like a trade war that affected it in the past. That being said, the behavior that has changed is never going back to where it was. It may go back small percentages, but this sea change in the way people get goods and products is never going to go back. It's only going to go further and further that way. I don't think it's going to drones dropping boxes off, but I think delivery trucks outside your house is never going away, guys.
Yeah, I tell you what, I agree.
And Landon, if I'm looking,
let me
go ahead.
I think that there's a bit of a stand-up routine in there. If you could talk about how lazy or how, Americans and their expectations, how they can complain about a box being dropped at their door. You're absolutely right, but the expectations are just getting higher and higher. In fact, if you look at people talking about same-day shipping, there's a 55% increase year over year about people who are expecting same-day shipping, and free shipping mentions are up 73%. I think people would rather pay $50 for an item that has free shipping than $40 plus $8 shipping. It's just the sort of a mentality where you don't want to pay for shipping. Of course, they're going to pay for it one way or the other, but expectations and demands of consumers are going up, and there's just e-commerce is booming, obviously, which is going to deliver more people into the hands of FedEx and UPS. You can see that on our chart here. People talking about using these or getting packages from these companies. Now, I will say there is a lot of negative sentiment baked into these purchase intent mentions. So these are people talking about receiving products or using FedEx. And a lot of the time they are complaining, as we talked about earlier. It's about 60% of the time, if they have a positive or negative opinion, 60% of the time it's negative. And so FedEx has a happiness problem that I think they've got to correct, but they're definitely getting a lot more packages out the door, a lot more packages delivered because of the e-commerce boom.
I love the point about, spending 40 plus 8 versus, buying something that's 50 with free, because how many times have you, been on a site or something and say it's like spend over $100, you get free shipping, and you're at like $70. You're not paying for the shipping. You're going to go find something else, get yourself over that $100, and that benefits the company, and it obviously benefits these shippers as well. But Landon, the biggest point, I think this is what Kevin was getting at as well as what you're underscoring here, is that the pandemic forced adoption of many new participants in the world of e-commerce. And like many things, once you do it that first time and you realize, it's not as scary as it seems, it's not as difficult as it seems, and quite frankly, in many ways, it's easier than going to the store, finding the item, waiting in line, driving there, taking an Uber, whatever it may be. There's a lot of new participants in this new kind of world of commerce that are not going back to the way they were before. Doesn't mean they're never going to shop in store. But if it's something easy, they know what they want, why would you drive to the store if you can just wait an extra 24 hours and you don't have to do anything?
Yeah, as long as you can wait. And I think that's the key. If you're shopping, in that Christmas season, or if you've got a birthday or some kind of occasion coming up where you've got a hard deadline, that is one of the reasons we saw curbside pickup booming with companies like Best Buy, Target, and Walmart, because it's 30 minutes down the street, you pick it up and you're home in an hour with the item, and you don't have to stress about it. If you're thinking about a gift and you're one of those late buyers on December 21st or something like that, you're not counting on that 2-day shipping, especially if it's a FedEx company or company that uses FedEx. So yeah, I think that's really important. And I agree. If you've got patience, absolutely go for it. Take your time. And it should be a good weekend, guys. I tell you what, I'm in a Calcutta. I've got Loyola Chicago this year. Very happy about that. I'm not sure how you guys feel, but Sister Jean's going to take us home, I think.
Good stuff. We'll look forward to all the basketball over the next couple weeks, particularly this first weekend. Landon Swan, have a great weekend. If we don't talk to you tomorrow, and we'll talk to you again soon. Kev, let's talk some more shipping here. Let's talk some FedEx. I think Landon's point about unhappy customers can put pressure on the business itself to ultimately change those shipping partnerships. But he also made the good point of it's a long-term kind of a trajectory. That's not something that's going to happen in necessarily an overnight. But hey, if those negative complaints start rolling in, that negatively reflects on their business, they might make that change. So that is something to be worried about long-term if you're a FedEx.
Yeah, I agree. I mean, FedEx, there is competition. There's competition for FedEx from UPS. There's competition from Amazon, right, to deliver its own products. I agree with all that. So, but there's still, remember, Amazon is a big, massive company that is going to deliver a lot of products. But so does every other company out there. There's still a lot of companies, a lot of e-commerce. And though Amazon is a behemoth, it's not all of Amazon or of FedEx's business. So I think that the future is still bright for, frankly, both these companies. But for earnings, again, going back to the Alex, of a strategy that's worked during this time, I want to stay with the double calendar and give myself a chance, because I think that FedEx's numbers will be gaudy, right, this year over last year. I mean, the earnings per share looks like it's going to be up like 137%, but that might not necessarily be bullish for the name as some of the other metrics come down. So, Alex, we're going to go with the 1 week double calendar, 282 on the call side, and 252.5 on the put side. Is trading about 226, relatively small for a double calendar of this, with a $260 stock. So, the double calendar with, the peaks around 252 and 282, really equidistant on the Delta page, Alex.
So the interesting thing about this trade is, one, the price, as you point out, and kind of what we're hoping will happen, but is that tomorrow is expiration day, or at least, the final trading day of these options for this week that we're selling. So this risk profile, which tries to, theoretically post what your profit and loss would look like in different scenarios on expiration day, this is, we're far closer to this tomorrow than we are and typically when we put these on. So an unchanged move may look okay, as volatility will plummet in those options that we're selling, the strangle we're selling, and a move towards the peaks could be very interesting tomorrow if we got a move in either direction. Kev, what we're going to do is we're going to work 3 of these. The debit spent on the trade is the risk on the trade. It looks like right now the midpoint is 232, so we'll work that there. 696 is the risk. For 3 of these, the double calendar for this week and next week, 252.5, 282.5. Kev, we're going to take our final break of the program. When we get back, we're going to continue the shipping conversation. We're going to talk the other name that we were just talking about, which is UPS. No earnings, but it may move on FedEx earnings. So stick around. We'll be right back.
Why did I add futures to my trading strategy? 24/7 access to diverse global markets, like wheat. Can you say growth opportunity?
We should probably harvest that. If you have questions about retirement planning, then you don't want to miss Investor Education Day hosted by TD Ameritrade.
It's a full day of free insights from TD Ameritrade education coaches and experts who can tell you all about honing your retirement strategies. And the best part, it's all online. So technically, you can enjoy the webcast from the comfort of your retirement pants, also known as sweatpants. Register for Investor Education Day at tdameritrade.com/education day.
Many traders may be willing to take on additional risk in pursuit of aggressive growth in their portfolio. More power to them. But if you're looking for a less risky alternative, you might want to consider checking out our income investing course. In the income investing course, you'll explore investing strategies designed to generate regular income and preserve capital. First, we'll delve into risk and return preferences. You will learn about the different ways to allocate a portfolio and create a payment schedule. Then we'll take a deep dive into the assets commonly held in income portfolios: dividend stocks, bonds, equity REITs, and cash. You'll also learn about routines for managing a portfolio over time. Along the way, you'll watch videos, take quizzes, and perform paper trades to practice your new skills. So if you're looking for an edge, consider your education. Head to the Education tab on Thinkorswim for the income investing course and a whole lot more.
Stephanie Lewicki here with your TD Ameritrade Network Market Update. Shares of Seagate Technology are down 5% after being probed for allegedly selling hard drives to Huawei, according to the Washington Post. The U.S. Department of Commerce is investigating Seagate for potentially violating the sanctions against supplying to Huawei without a license. The Commerce Department tightened the Huawei restrictions last summer, barring Huawei from obtaining foreign-made chips that were developed or produced using U.S. software. A UK regulator said people should continue to get AstraZeneca COVID-19 vaccine, saying that the benefits of the vaccine in preventing COVID-19 far outweigh the risk. The UK regulator said, following a rigorous scientific review of all the available data, said that the available evidence does not suggest that blood clots in veins are caused by COVID-19 vaccine AstraZeneca. And Google plans to invest over $7 billion in offices and data centers across the U.S. and create at least 10,000 new full-time Google jobs in the U.S. this year, Google CEO Sundar Pichai said in a blog post. The plan includes investing in communities that are new to Google and expanding in others across 19 states, and to add thousands of roles in Atlanta, Washington, D.C., Chicago, and New York. This has been your TD Ameritrade Network Market Update. Now back to Fast Market with Alex Coffey and Kevin Hinks.
Thank you, Stephanie. I'm Alex Coffey. He's Kevin Hinks. This is Fast Market. Kevin, on the opening day of March Madness, at least the opening day of the many games that will take place here going forward for the tournament, it's kind of a quiet morning for equity. So maybe a lot of people turned off the machines. They're looking forward to some basketball because we really haven't moved much. Only down 15 points for the SPOOs. NASDAQ down 233. The Russell down about 1.5. The Dow, though, has remained fairly strong on a relative basis, up 170. But Kevin, we've talked about this many times on the program. When you look at the Dow Jones, the first thing you're going to notice is it's very few names. It's only 30 names. And because it's counted on, or it's calculated on a price weighted basis, it doesn't feel the impact the same way that these other indices do when a name like Apple or a name like Microsoft underperform. They just don't carry that same weight because it's not market cap weighted.
Yeah, let's do our quarterly public service announcement, Alex, and say for our viewers out there, if you're looking at the Dow, that is no longer the benchmark for the U.S. stock market and trading. Use the S&P 500 as your benchmark. That's the best indicator in a day where NASDAQ's down 1.7%, Dow's up 0.5%. What's the real market doing? Real market's down about 1/3% in the S&P 500. Make sure you're paying attention to that one other than just the headline, which is the Dow Industrial Average.
I appreciate the the public service announcement, because it's something that I think is, very, very important. Yeah, I think the Dow Jones has its place, and maybe I'm a new school guy, so I don't focus on it as much. But the S&P 500 is the U.S. benchmark for a reason. A lot of names, is market cap weighted, a lot of different sectors, a lot of good information you can take in terms of U.S. equities from that index. But 10-year yield important nowadays as well, about 9 basis points, 1.73. A 30-year Treasury futures down 109. So about 1 1/3 points, Kevin. The gold is bouncing back. It's up $1. The mover of the day, though, is crude oil. Crude oil, and this is where we can kind of transition back to the shipping conversation in UPS and FedEx. Kevin, crude oil is down a huge amount today, 4%, under 62. But given its run, I mean, at some point, that's going to weigh on the margins of these shipping companies, right? I mean, gasoline more expensive. You're driving trucks. You're flying airplanes. Isn't that just logic?
Yes, but the also logic, and Alex, you're exactly right. I mean, the opening of the U.S. economy is going to bring in more demand for crude oil. That's why crude oil has rallied to here. What we're not talking about is supply. And eventually higher prices are going to just naturally bring in more supply as we get over people's break evens and as we get to more and more profitable levels for pumping oil. So I would expect eventually more supply to come on this market, and that heavyweight battle between supply and demand and your economics 101 book will continue to rage on. But I would expect this is probably some supply coming back on the market concerns, Alex.
Yeah, and when we're looking at UPS, the interesting today, down 89 cents, about 0.5%. So it's basically in line with the overall market. FedEx, though, we just talked about, was up slightly here ahead of earnings. So maybe some pre-earnings excitement in FedEx. Hey, there's a chance that a company that is closely tied in the same industry will potentially move a little bit post-earnings. And the interesting thing, I think, is you actually see a market maker move showing up here for UPS. 228, Kevin. As the near-term volatility is elevated slightly based off the FedEx news.
Yeah, and you're welcome to take advantage of that if you want. Now, FedEx and UPS, they are similar but not identical, as you know. UPS focuses a lot more on domestic. And by the way, U.S. domestic package segment for UPS down 5%. 5.5% in 2020. So not perfect situation. That being said, what UPS is really good at is creating and maintaining positive cash flow. And they've got, this is a company that generates cash flow. 4.1 million in 2019, 5.1 million in 2020. I mean, they are still a well-balanced company. Now, we're going to get a little more break away from a little fundamentals because you pointed out, Alex, UPS doesn't have earnings until April 27th. So next quarter, this quarter's earnings have already come out. So we're going to trade this a little bit differently and get very technical. If you put up a 1 day, 1 year chart, Alex, you can see that this 155 level in UPS has been an extremely strong support level for this stock. Once it got up to 178, it's come back down. So what we're going to do, we're going to go out to the April 1st expiration, and we're just going to sell the 155, 150 put vertical. And it's a little inside the expected move. It's right on the expected move of 8 days, if you notice, at about $4. But if you go out 14, it's a little further. We're going a little inside that expected move. And so we're going to get a little more premium in our trade. So upwards of 90 some cents. So we're going to use that 155 level and really make a stand there in terms of selling our put vertical and see what happens. Even if we get a little sell-off on FedEx's earnings or a rally, obviously a rally would do extremely well, but we've still got plenty of room on the downside to still be profitable, Alex.
So, Kevin, this one's right now unlocked price, the midpoint, 88 cents. So if that was the fill point, it'd be a 154.12 break even with $4.12 in risk taking place below 150 at the expiration, where assignment and exercise would basically fulfill that outcome. Kevin, my question to you is we know how this strategy works. It's a neutral to bullish strategy, one that takes advantage of time decay and really is more about where I'm willing to take risk than what I think may happen. And so in this case, I'm willing to take downside risk if I put a trade like this on, and I'm hoping for kind of just to hang out, hold this support level, as you put it, around 155. My question to you, because it is not an earnings trade, you have a potential catalyst for maybe a little bit of a move, and you're looking at this trade over a little bit longer duration. Is this one where Kevin Hinks considers, say he wants to get to 5 or 6 or 7 contracts, he starts with 1 or 2 and he scales in based off what the price does, and if you get a bounce post FedEx, you do have open profits, you still have 1 or 2 on, that's okay?
Yeah, this is a really good discussion topic to end the show. And the answer is I always scale, Alex. I'm always willing to scale because I'm not sure that I'm right at any price point. I feel good about the strategy and the level, but I'll still scale into just about every trade that I do to try to get just a better price if I can, Alex.
Good stuff, Kevin. What I'm going to do is I'm going to work this at $1.10, $1.90, 2 times on each of them, and we will see if we're able to get a fill. Kevin, we're out of time. Check out Kevin later on this afternoon on Midday Trade, and stick around for your first trade with Scott Connor. That's coming up next. Thanks for tuning in, and we'll see you tomorrow.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Futures to my trading strategy. Now, I have 24/7 access to diverse global markets, including crude oil. Like I always say, leave no opportunity untapped. I'll just sign that. Yeah, got it.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now.
Welcome to your first trade. I'm Scott Connor, and it is Thursday, March 18th, the day after the Fed speaks and the market is reacting. We're seeing different directions of the 4 major indices, but before we get that, later in the show, we'll be talking about a couple different things. One, we'll be joined with Pat Mullally. We're going to talk about calendar spreads, diagonal spreads, and how they can be combined into one trade. Also, followed up, we'll look at an example trade in Apple, a very widely followed stock. We'll look out 3 or 4 weeks and put on an option strategy for that. And finally, we'll wrap up by going back to the Thinkorswim platform with Mike Follett and talk about risk profiles associated with the different option strategies. So, got a lot to cover today, but let's kick it off with the 4 major indices. And as I mentioned, they're going in different directions. Let's start with the S&P 500. It's down about 0.3%, or about 12 points, and that puts the S&P 500 at 39.61. Now the Nasdaq is the heaviest of the four. It's down 1.75% on the day. That's a loss of about 232 points. That puts the Nasdaq right around 12,968. Now the Dow Jones, like I said, going in another direction, it's up almost 0.6% on the day. That's a gain of 192 points. That puts the Dow at 33,207. Now the Russell, virtually unchanged on the day, down less than 0.1%. It's only down 1 point, and that puts the Russell at 2335. Now, interestingly enough, the VIX, the fear index, which we've seen sitting well above 20 for quite some time, is still holding below 20. It's at 1987. Now, that's up about 64 ticks on the day, or about a 3% move to the upside. But remember, it closed about 1920 yesterday, so it's still holding sub 20, that important level. Now, let's break down a little bit further and go into the sectors within the S&P 500 and see how those are faring relative to each other. And as you can see, a little bit of a split, like the four major indices themselves, but way out in front, let me highlight this, is financials. They're up almost 2.5%. Now, we'll be talking about the 10-year yield rising in a minute, but that's what you're seeing play out here, with financials up, industrials up about 1.25%, materials up about 0.8%, and healthcare up about 0.5%. Now let's drop down where we see some weakness. Communication services down about 0.8%. Same with consumer discretionary. Real estate down about 0.9%. That would make sense. Energy down 1.3%. And finally, the weakest of all the sectors is the information technology. It's down about 1.75% on the day. So definitely you can see sectors going in different directions today, depending on what's happening with their underlyings. Now let's jump into the Visualize sub-tab and look at the heat map, if you will, of the S&P 500. And you get right away the sense that the left side of the heat map is where we're seeing the red, and the right side is where we're seeing the green. Now what we've learned is when this is the pattern, it's the techs under pressure and the financial stocks moving higher. And that's what we're seeing. Look at the techs. Microsoft down about 2% on the day. Apple down 2%. Alphabet down 1.5%. Tesla down 3.75%. Amazon down almost 2%. So again, weakness in the FANG names. To the right side, we'll take a look at financials. Look at some of the bank stocks up 5%. We've got Bank of America, JP Morgan up 4 and 5% on the day. Well, rising interest rates tends to be good news for the financial sector, and that is definitely playing out today. Healthcare showing a little bit of green as well, but we talked about industrials, and they are also showing some strength. So that's the heat map, the breakdown of the U.S. indices. Now let's see how markets were doing internationally going into the open of the U.S. markets. And we'll start off with Europe, and Germany was up about 1.3%. Pretty solid gains. Now remember, they were coming off the reaction or the announcement from the Fed of holding rates steady. So they were a little bit to the upside. France up about 0.3%, and the UK up about the same, close to 0.3%. Japan up 1%, Hong Kong up 1.25%. So we saw some strength in Asia even before the European markets opened, and Dow Jones Shanghai was up about 0.5%. So pretty much up across the board. And again, U.S. markets, what did they do? Well, they all opened down and then have gone different directions since then. Well, let's talk a little bit about what's behind the markets and what we're seeing so far today. And to do that, we're joined by your First Trade contributor and education coach, Scott Thompson. Scott, coming to us live from Salt Lake City. Scott, good to have you here on this Thursday. The post-Fed day, I guess, is the way we have to look at this. And I was just mentioning to our viewers that all four U.S. indices opened lower, right? They all gapped lower. But boy, Scott, from there, it was different. The Dow Jones rallied up. The Russell's unchanged. But the Nasdaq was under pressure, and it's still there, down like, what, 1.75%. So, Scott, is this pretty much kind of a reaction from the Fed? And is this the market just digesting the announcement from yesterday, Scott?
Yeah, that's exactly what I think it is, Scott. You mentioned kind of digesting the information. It seems like it takes a few days to try to figure out what the Fed actually said or what they mean. We got that normal, I think, kind of knee-jerk reaction on the open this morning with the 10-year notes being up there higher this morning. But we saw the rally off the lows. And even though the Nasdaq's getting hit pretty hard, we're still seeing a little bit of a rally, at least a few minutes ago. So the other thing that I think is really interesting is the VIX is still quite low. We're not seeing some of those kind of fearful spikes in the VIX that we've seen with some of these other, new highs on the 10-year. So it's just interesting to me. I think you're exactly right. We're trying to digest this information, see what's going to happen, see if the Fed's going to change policy or change their reactions. Scott, back to you.
You know, it is interesting, Scott. I'm looking at a chart here of the 10-year yield, and you can see the spike or the gap higher today up to that level of, I think it got up to 1.76 at one point, Scott. That's a tremendous jump for going back to the beginning of the year when we were under 1%. But this gain, now it's come off the highs. As you can see, I'll highlight basically the area we're looking at. So it's definitely come off those highs. It's down now to about, 1.73. But this is a big jump, Scott, in interest rates. And it is interesting that the markets, even in spite of the reassuring language from the Fed that they're not looking at raising rates anytime soon, the bond market looks like they had a different idea here, Scott. This is a continuation of a pretty big move we've seen in interest rates, right?
Yeah, and the pre-COVID levels were up about 1.8 or so. So it's kind of interesting where we are right now. And last week when I was with you, we talked about, kind of the markets overall, maybe some optimism about the future and kind of gaining some comfort level with where these rates are. And so maybe that's coming into play a little bit today as well, where we saw the gap up in the rate, but not so severe reaction from the market. So I think that's still playing out, and it's yet to be seen what will happen in the future, Scott.
All right. Well, Scott, we'll keep our eyes on interest rates. I guess one thing that we can all assume is, or maybe verify, is that it seems as though the NASDAQ is allergic to higher interest rates. I think that's a good way to phrase it, because every time we see these rates pop up, that's the sector that's under pressure. And that's the one, Scott, that just has not been anywhere close to setting new all-time highs, as the other indices are doing along the way. All right, well, Scott, we'll keep watching interest rates, like I said. Let's talk a little bit about some of the economic data today, because we did have the jobless claims number, which is one we follow very closely week to week. That's kind of our gauge, Scott, for how employment's doing. And again, these are claims for first-time unemployment insurance. So this is a number we don't want to see go higher, right, Scott? We don't want to see more unemployment claims, but that unfortunately was the case today, right?
Yeah, the numbers came in higher than expected, 770,000 new initial jobless claims. The forecast was in closer to that 675 range, 700,000. The prior number was 725. So, higher than expected, the highest level that we've seen in a month, going the wrong direction. And it might be unusual to see the market react as it has. Maybe we would expect a little bit bigger drop than we've seen in the S&P, and the Dow, like you said, was up. Continuing claims, however, are the continuing claims are continuing to go down. We're coming in there at 4.1 million or so on the continuous claims. It dropped slightly from last month, but that was still above expectations. And another thing that's really interesting about that is we got to think about the people that have been unemployed for a long time. One of the other data points was about 41% of the unemployed have been unemployed for 27 weeks plus. So it's, at some point, I think people get frustrated and stop looking for work. So it's kind of interesting as we look at those numbers, Scott.
All right. Well, unfortunately, that wasn't going in the right direction, but let's watch. I always like to keep my eye on the 4-week average, and that actually ticked up a little bit, too, to 746,000. That's the number I think we're trying to bring down over time, because you can get some pretty big swings week to week, Scott. All right, well, let's move to another one that I think was a little bit different than the jobless claims, a big swing or surprise, if you will, to the upside. And this is the Philly Fed Manufacturing Index, and this number was really strong for February, and I think not many people were expecting a follow-through like we got. Now, this is kind of it gives us an idea of general business conditions in the Philadelphia Fed district, and it sort of gives us an idea, like I said, trends in manufacturing. But this number, I think, was pretty strong, Scott.
Yeah, absolutely. This one came in at 51.8 with a forecast in that 23 to 24 level. Biggest jump that we've seen in this in over 50 years. I read in one of the posts. Wow. They're starting to show some strong growth activity with new orders, shipments, employment. All those numbers are increasing, which is a good thing. And yeah, big jump on this Fed Philly report. Scott.
Got it, Scott. Well, let's look at one more that's, I guess, somewhat similar to the manufacturing index. And this is because it's also a forward-looking composite of, I think it looks at 10 different components. But again, it gives us sort of an idea of the general economic conditions looking forward. I mean, it looks at all sorts of things, Scott, building permits, factory orders, unemployment, all this stuff. And again, it's kind of a big number looking forward. And January was a good number, but it looks like the February numbers that we got today were pretty much in line. No big surprise there, right, Scott?
Yeah, the leading index number came in at some growth at 0.2%. The forecast was 0.3%. Last month, we were at 0.5%. So, you know, the interesting thing about this is that they're expecting continued growth throughout the year as some of the vaccinations start to take effect, as more and more states and countries start to open up a little bit with some hopeful expectations with COVID cases maybe continuing to drop and the vaccinations taking a bigger effect. Scott?
Got it. All right. Well, we'll continue to watch these leading indicators. You got to remember, they're like what we call soft data, right, Scott? They're kind of opinions and outlooks, but not like jobless claims, which is a hard data number we can look back on. But again, I like to watch those numbers as well, Scott. Let's turn our attention to a couple stocks that you have on your radar, a couple of symbols that caught your attention. One of them is Teladoc, symbol TDOC. The other one is one we spoke about recently, Lyft, but I guess both of these are back in the news, Scott. What caught your attention here with these two symbols?
Yeah, let's start off with Teladoc. Teladoc, we can see there's a huge drop from the February highs. They missed earnings severely, and I think the forecast was about a loss of 25 cents, and they actually came in with a loss of $3.07. And not only did they miss their earnings, but their guidance for the future wasn't very strong. And that dropped it all the way back down into this really strong support level that we see about 174.50. It'll be interesting to see. I think, you know, they had a lot of great growth because of some of the COVID expectations and people not wanting to go into the office. But they just fell short when it came to revenues and that information. The other one that I thought was really interesting was Lyft. You know, I used to use Lyft all the time when I was out traveling, and obviously we haven't done a whole lot of that in the recent past. And as expected, Lyft got hit really hard back in February of 2020 as COVID came up. I think they came down and had a low of about $14 back in March of 2020. And then we've seen this huge spike. Now, honestly, I thought this was a little interesting because I didn't expect to see the stock rally as strong as we had since November. And a couple reasons for that was because of the number one, is the self-driving cars. Lyft is starting to participate in that particular market, and they're forecasting some additional or growth in the ride-sharing industry. And I think the most important thing to keep an eye on here is our previous highs back in July of 2019 were about $68.33. We're getting very close to that resistance level. So it'll be really interesting to see what happens up here, Scott.
Got it. All right, Scott, I'm looking at the one-year charts going back. Teladoc up about 35%, but you're right, it's really come down from its recent highs. Lyft, on the other hand, pretty much on an upward trajectory, up 320% since those March lows of last year, Scott. Tremendous move. All right, well, we're going to have to wrap it up there, Scott. Thanks again for bringing our attention to these two stocks and helping us break down the economic data behind what's driving the U.S. markets today. Take care, Scott. Look forward to seeing you again on Your First Trade. Now, coming up next, I'll be joined by Pat Mullally, and as I mentioned, we're going to look at two of the basic building blocks for all option strategies, the calendar spread and the vertical spread, and what happens when they're both combined. So stay with us. We'll break that down in just 2 minutes.
This is my headquarters. This is where I trade and manage my portfolio. Since I added futures, I have access to the oil markets and gold markets. Okay, I'm plugged into equities, trade confirmed. And I have global access 24/7, meaning I can do what I need to do. Then I can focus on what I want to do.
Visit your online broker today to learn more.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. The platform demo webcast series is designed to help you broaden your knowledge of tools and resources available from TD Ameritrade. You'll learn tips and tricks to help navigate tdameritrade.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today. Technical traders, the chart master is in the building. Trends, support and resistance, key patterns, and technical indicators. The chart master has your live technical analysis throughout the trading day, only on the TD Ameritrade Network.
Welcome back to Your First Trade. I'm Scott Connor. Since our last check, it looks like the four major indices trying to make a little bit move to the upside. Let's see where they stand right now. The S&P 500 now down less than 0.2%. That's only a loss of about 7 points. NASDAQ down about 1.4% with a loss of about 186. Dow Jones up about 0.6%. Now that's a gain of 194 points. And finally, the Russell has moved in to the positive side. It's up over 0.1%. That's a gain of about 3.5 points. So markets trying to move higher off those opening lows. VIX right now holding 1969. All right, well, let's turn our attention to today's topic. As I mentioned, we're going to be looking at calendar spreads and vertical spreads and what they are when they're combined. Well, so what we'll do is examine the characteristics first of the calendar spread and then add in the vertical spread. And these are both, as I mentioned, two important building blocks for all complex option strategies. Now, you'll learn the mechanics of the calendar spread. We'll start there, and then how it aligns with different directional outlooks. Then you'll see how the risk profile of that calendar can be tweaked by adding or embedding a vertical spread into that calendar spread. And ultimately, you get a diagonal. Now, joining me to discuss modifying calendar spreads is Your First Trade contributor, Pat Mullally. Pat, welcome to Your First Trade. I think we're covering an important topic here today by looking at these two building blocks and for make sure our viewers understand that when they're combined, you sort of get a unique sort of a version of a calendar spread that we call the diagonal. And again, the terminology here, Pat, might get a little complex for some of our viewers, but again, I think we're approaching in a way that's kind of easy to follow and understand, because obviously these two important building blocks are key to going forward. So why don't we start off by defining for our viewers the calendar spread, and then we'll build from there, Pat. How's that sound?
And these are the building blocks. There's only two types of options spreads in reality, and that's going to be calendar spreads and vertical spreads, which then we can use to manage our options portfolio. So a calendar spread, Scott, it's going to be a defined risk option strategy that's going to be constructed by buying and selling the same strike options, calls or puts, but at different expiration dates, versus a vertical, which is different strikes at the same expiration date. Now, it is often going to be referred to as a time spread or horizontal spread. And typically, a longer dated option is going to be purchased and a shorter term option is then going to be sold. Now, depending on the strike selected, a calendar spread can be either bearish, bullish, or neutral, Scott.
Got it. All right. So starting with one of those basic building blocks, the calendar spread, I think the key takeaway there, Pat, is you're buying and selling either both calls or both puts, but different expiration dates.
All right, boys and girls, I am going to go to lunch. Take a lunch break. Let's see what we got real quick. Express is going back down, but it's going back up. I don't know what the hell was happening with AMC, but it would not go above 14 all the way across for like, what is that, over an hour. And then it just fell back down. And now it's making a couple runs. Who knows? Most of the markets are down today, so that's a bummer. But I don't know. Hopefully we'll get something moving here in the afternoon session. But for now, I am going to actually going to be gone for maybe like an hour or two. So I'm going to actually sign off. Actually, you know what? No, I'm not going to sign off. I'll leave this rolling. We're going to let Jim Carrey take over. Jim Carrey's right over there. He'll take over here for the next maybe hour and a half until I get back. So until then, guys, adios.
Spreads are going to be more sensitive to
And I'll
that
put on
change in
CNBC
volatility
guys,
than the shorter dated option. Now,
PayPal.
I just don't want them to play that.
Yeah, PayPal is one of our biggest holdings and has been for years. And if you think about what people are going to do with their $1,400 stimulus check, I think they're going to spend money. And a lot of them are going to spend that money using PayPal or Venmo. So it's not as if this is a company that has slowed its growth and it was just during COVID. That growth was accelerated and brought forward, and it will continue at the rates that people had expected because PayPal is here to stay and they're an innovator. And this is where transactions are going over time. So yeah, I mean, it got a little ahead of itself, and that happens with growth companies. It happens all the time with growth companies, and you can look at the history of Amazon or Google or Facebook, you know, any of them. Go back to, you know, Cisco in the, you know, in the 80s and 90s, and, you know, they get ahead of themselves and people are enthusiastic, and then there's some reason where they correct. And so, you know, PayPal's having a correction, but I wouldn't sell it because if you sell it, how do you know when to get back in? And that's always a very tough choice. Plus, people have to pay taxes on the gains.
That
so,
goes to the,
you know, I would agree with Josh.
That goes to the sort of own
Definitely
it, don't trade it kind of mantra that Cramer always talks about, at least, you know, as it relates to Apple, but maybe it has wider spread meaning as well. Let's bring in our headliner today. Sonal Desai is the Chief Investment Officer with Franklin Templeton's Fixed Income Group. It's good to see you today. Welcome to our program.
Thank you so much for inviting me.
So what's happening, do you think, in the market today? Is the bond market overreacting to what the Fed said yesterday, or is the NASDAQ overreacting to what it thinks the Fed is going to do or can do?
So, you know, the interesting thing, I've been listening to your experts, and I actually have a slightly different view in that I don't think this is the bond market believing that the Fed can't stay on hold. This is a different loss of credibility. This is the bond market thinking the Fed is going to remain on hold, but we are going to get more inflation than they think. Because they're looking, look, by the end of this year, they're telling us they think that unemployment is going to be at 4.5%. Growth, we're going to be up in the 6s. This is the Fed. I think it's going to be even higher. But somehow, next year, it's all going to be fine. Growth will come down. The unemployment rate won't continue to plummet, and inflation will calm down as well. I think actually this is a different loss of credibility. This is the bond market saying that the Fed will do what the Fed needs to do, but long-term rates and the Fed can anchor the short end. What it can do at the long end is going to be far more interesting if the market decides that, in fact, it's inflation that is coming back into the forefront.
We're assuming, as you say that, though, that if inflation rises, that the Fed can stay on hold. I mean, the Fed may want to stay on hold, but I think you could make a credible argument today that the bond market is questioning that.
I think that's the interesting point, isn't it? The bond market is either questioning whether the Fed will remain on hold, or it's questioning whether inflation is if the Fed does remain on hold, like they promise us they're going to do, that inflation is going to be a lot higher. Keep in mind, every time we talk about average inflation targeting, well, yeah, it's been 10 years, right? That inflation has been just about a little below target. So is this the Fed setting us up for a protracted period of inflation For the longest time, the only thing anybody in the bond market has been talking about is deflation. I never bought it over the last 10 years. I'm certainly not buying it now. I do think this is the bond market coming to terms with the fact that inflation might be happening, and it might be coming because the Fed is assuring us that they can live with inflation. And that to me means you get curve steepening. Now, I'm not going to talk about whether the NASDAQ's right or wrong in this picture, but I look at where the bond market is. I just noted at the beginning of the year, I spoke to Barron's, and for me, it was 2.5. That was when rates were at around 92 basis points. I thought we could go significantly higher. I actually do think we can go higher. I'm not saying it's happening in a day. Certainly, these types of moves are dramatic, and I don't think it's going to be week after week, but a slow grind upwards. We do have to think that is a real possibility.
Sure. That's the key. That's the key, I think, at the end of the day, the speed. Sonal, thank you so much. Sonal Desai, Franklin Templeton joining us today. We'll talk to you again soon. Coming up, we have a bullish call out on Intel today. Shares are up 30% this year. We're going to debate that, the rest of the semi-stocks as well. Dr. J's got unusual activity still to come as well. And a reminder, you can always watch or listen to us live on the go on the CNBC app. We're back after this. All right, we're back. Let's get to Kayla Tausche. She has some breaking news right now on travel restrictions. Hi, Kayla.
Hey, Scott, we've learned the Biden administration is eyeing mid-May as a potentially suitable time frame to begin relaxing restrictions on non-essential travel, both at the land borders with Mexico and Canada and for inbound international travelers coming in from the UK, Europe, and Brazil. This, according to two sources familiar with the matter. Just this morning, the Department of Homeland Security renewed for one more month the ban on land crossings with Canada and Mexico until April 21st. So they're taking that on a month-by-month basis as they grapple with the COVID situations both in Mexico and Canada and the influx of migration coming in from Mexico. We've also learned that Canada has raised concerns about the accessibility for its population to get vaccines, and that Prime Minister Trudeau has stressed that he does not want more travel to happen before that population can get vaccinated. So for land crossings with Canada and Mexico, they're taking that on a month-by-month basis. International travel by air, I'm told the interagency committees working on that are taking it on a week-by-week basis. The public health officials have raised concerns about the spread of potential variants in communities that are reopening very quickly, while economic and other officials have suggested that because international travelers must test negative before they get on a plane, that the risk is low, but that they've agreed to table that conversation and revisit it on a week-by-week basis. The White House did not respond to a request for comment before we went on the air. Officials in Canada and Mexico have also declined to comment on this front. But according to a senior administration official I spoke to today, Scott, there will be a sea change in this policy beginning in mid-May when vaccines for U.S. citizens are more widely available and the administration feels more comfortable relaxing some of these restrictions. Scott?
Yeah, Kayla, good scoop from you. Thank you for bringing it to us. And you can see those stocks are on the move. John Najarian, you own the Jets ETF.
I do, Scott. We had unusual activity in that one, along with a number of airlines, most notably Alaska Airlines and United Airlines. So, yeah, happy to see it moving a little higher today and intend on holding it.
Jim Lebenthal, Alaska, maybe not getting as big of a spike as some of these others, but that's the one you own.
It is, and it's my combination of safety within what is arguably a speculative area, because its balance sheet is just so much better. But I think the speculative nature of this actually decreases over time. Carrie was mentioning comparing it to 2019 valuation metrics, or rather income levels. I don't think that's wrong. I think we are looking at, when you get to the back half of this year, you take the permanent cost cuts that have been made, you take inflation in airline tickets that's likely to come, you're going to have a very profitable airline industry when you annualize the second half of this year.
Josh, Trip, and Expedia, I know you like those names. To best of my knowledge, you don't own them yet, but I know you've been watching those. And by the way, since we're having this conversation too, New York City's talking about concerts coming back. I think it was April 1st is what they said. Live Nation was a spike on that, yes, which you've talked about, Josh, specifically on this show, along with Madison Square Garden. You can hit all of these kinds of stocks. They all sort of play into the same thing.
Dude, Governor Cuomo needs a distraction. I'm surprised he's not announcing gladiator fights in the Coliseum at this point. But yeah, we should get concerts back. I also would like to see a baseball game in person before I die. So these are all good things. Live Nation, I'm long. Expedia, I'm a schmuck because I've been saying it's a buy since 160 and I'm still watching it. And I really like TripAdvisor's story. They're doing something very innovative. They're trying to build the Netflix of travel with this new subscription service where members are going to get access to all kinds of discounts on flights, on hotels. I don't know the details and I don't own it yet, but those are two names. If there's a pullback in travel because like the South African strain appears somewhere or whatever, like those would be the names that I reach for before the airlines. Although I do agree with what Jim had to say on the airlines. I think they're going to be, it's shocking, but I think they're going to be in a position of serious pricing power this fall.
Yeah, I don't think there's any doubt about that. I mean, you can already see some of the price inflation that you've gotten from some of the airlines. What about the retail stocks, right? I mean, it's, okay, it's not a travel-related thing, but nonetheless, these stocks have ripped.
Simon.
They've ripped.
Simon, listen to me. Listen to me. Buy Simon Property Group. It's 116. The all-time high is more than 100% higher than this level. In what they've been doing, what they've spent the pandemic doing is completely reflating their liquidity. They have access to $10 billion if they need it in the form of cash and revolvers, et cetera. They've reduced the cost of their debt. They've restructured. And in addition, they've bought out a lot of the ailing retailers that were occupying their stores. And keep in mind, Simon's not B and C malls. It's A malls that aren't going anywhere. And not only is it a play on retail because they're turning these chains around, but in addition, it's a play on the suburbanization of America. And all these people that left the cities and bought houses in the suburbs, they don't just move back after they get their second round of the Moderna shot. Like, they have changed their lives, and Simon is right in the wheelhouse of the place where people will go to spend. I don't think these are just retail. I think these malls are the town squares of America, and I think the stock has serious upside as a reopening play, in addition to just being like a play on, in-person retail. So
Yeah.
I really like SPG. And while you wait for my vision to play out, they're paying you 4.5% dividend yield.
Yep, seeing that stock get a nice lift as we're talking about it. All right, up next, John has unusual activity. Plus, March is Women's History Month, and we're spotlighting some of our CNBC contributors. Here is Requisite Capital's managing partner, Bryn Talkington, with advice from some famous Texas women.
Ann Richards, former governor of Texas, used to say in a crowded room that Ginger Rogers did everything Fred Astaire did. She just did it backwards and in high heels. Beyonce. She always says, never let success go to your head, and more importantly, never let the failures go to your heart. And finally, some dime store advice from me: work smarter, not harder. Most important, believe in yourself, because if you believe, you will be believed.
Welcome back. I'm Rahel Solomon, and here is your CNBC News update. We do want to warn you that the images in this first story may be disturbing to some. The FBI has released new video of the Capitol Hill riot and is asking for help identifying 10 people that it says were involved in violent attacks on Capitol Hill police officers. So far, 65 people have been arrested for assaulting law enforcement officers during the riot. An Indianapolis man has been charged with 4 counts of murder in the killing spree of 3 adults and a child. Police say that the suspect was arguing with his girlfriend because he wanted a share of her stimulus money. The European Union's drug regulator says that AstraZeneca's COVID vaccine is safe and effective, and that the benefits of using it do outweigh the risks. The European Medical Agency says that it found no evidence of increased blood clots among vaccine recipients. And Americans drove 11% fewer miles in January than they did in the same month last year. However, miles driven rose about 1% from December levels on a seasonally adjusted basis. Scott, I'll send it back to you.
All right, appreciate it. Rahel, thank you. All right, it's time for Unusual Activity. Dr. J, John Najarian, what do you got for us today?
Well, Scott, one of the ways, as I said, that I sort of insulate myself a little, the portfolio, from rates going higher is owning banks. I also own the TLT puts, and I've owned those since the index, that ETF, was about 157. I added to that today, Scott, because they came in big numbers, bought about 15,000 of the April 1st expiration 133 puts. That was with that index at 133.64. So in other words, a little more push to the downside for those TLTs, which means rates a little bit higher. Second trade, Scott, take a look at Pagseguro, PAGS. This is microfinancing, and they help out small businesses. They're out of Brazil. This is a 18% decline over the last month. They came in betting that by September, this one sees much higher numbers. They were buying the September 55 calls with this one at about $48 this morning. Lastly, Nike. Prashant asked me to take a look at Nike. We've had two very large trades in here over the past 10 days. Both of them are now deep in the money, Scott, because they were buying with the Nike at 136. They were buying the 140 calls, the 145 calls, but that's about as high as they've gone. They haven't really extended a lot higher, even though Telsey has a 175 target, KeyBank has a 180 target, but all good news for Nike. It's moved up from 136 to 145 over the past week.
All right, good stuff. Doc, thank you. Up next, Ask Halftime. Send your questions by video. We'll play them on the air. Email us, askhalftime@cnbc.com. Plus, the CNBC Inclusion Forum examines strategies and initiatives for organizations to create equity for all, and that begins today, 1 p.m. Eastern. You can register now, cnbcevents.com/inclusion. We're back after this quick break. All right, let's answer your questions now. First up, Farmer Jim, it is a question for you. I bought some Cisco lately. I really don't like it this high, only because I don't like it this high. Do you still own it?
I don't still own it. Here's my comment on Cisco. The last 5 years, its forward multiple has been between 12.5 and 17.5. Right now, the forward multiple is 15. You're not going to get much from Cisco. You don't see big earnings growth here. You're not going to get an earnings multiple expansion. So maybe you get a few percentage points a year in price appreciation and the 3% dividend yield. But that's it. This is not the tech darling of 20 years ago. This is kind of like Verizon, almost like a utility in your portfolio. It dampens volatility. If you want it for that, go ahead, but it doesn't excite me.
Okay, Josh Brown, a video question for you. Let's watch and we can answer on the other side.
How's it going? My name is Brandon Bonomo from Long Island, New York, and my question is for Josh Brown regarding Restoration Hardware. Can their momentum continue despite their recent run-up since the home building and home improvement trends remain so strong? Thanks.
All right, good question. Josh, what's the answer for Brandon?
That's a great question. Thanks, Brandon. I like the stock. I think it's going higher. Warren Buffett just added to his position by 41%. We found out in the fourth quarter. We found out a few weeks ago. And you can see why. This company is basically growing its cash flow year over year by about 40%. They are one of the defining companies in terms of experiential retail. You go to their stores, which we'll be able to do pretty soon, and there are cafes. It's just like a very high level furniture and home furnishings. And now they're getting into two other areas. They're going to do residences, like literally they're going to be in the home business, and they're going to do hotels. And I just think this brand has a ton of potential. So if you're long, I would stay long, and has a lot of tailwinds at its back.
Nice gain today, better than 6%. All right, Dr. J, have a video question for you now.
Hilly from Atlanta. John, we love you. Our bank account loves you. You mentioned a few weeks ago about Vail. The numbers are looking good. They're up. What do you think about it now?
All right, Doc, looks like you're making some money for Hilly in Georgia. What's the answer now?
I'm delighted for you, Hilly, and thank you for that shout. I like it, and I think this one obviously is a play for infrastructure, Scott. So what I'm looking for is that bill is going to take several months to work its way through. So either if you own the stock, I would be writing calls in the short term, meaning the next 2 or 3 months. And if you own the calls further out, I would be selling short-term calls, because then you can capture that time decay, because I think it takes at least 3 months before we can get to an infrastructure bill. And I think that'll really spike Freeport, Vale, Cemex, a whole bunch of the infrastructure plays.
All right, Doc, thank you for that. Carrie, lastly to you, Rushy in San Francisco. What should we expect from Netflix over the summer? Is it going to endure competition from Disney? I mean, that's where the battle is, right?
Well, I'm not sure that I can pinpoint what happens this summer, but we know that Netflix has treaded water for 8 months now. I mean, the stock is totally flat if you look at the chart. Disney stock's up 127% year over year, so it's outperformed. Netflix is the leader in streaming and will remain the leader in content development. There can be two players. There are always going to be two. Netflix is the leader, and Disney is obviously going to be the number 2 in the space. If you look out 2 years, the price to earnings multiple of both companies is 30 times in 2023. And so we think that Netflix has an opportunity to start to outperform, which it hasn't, as the reopening play. And Disney is both a reopening play and it was a stay-at-home play. So it had the best of both worlds. And it makes sense that it's outperformed recently, but we think that Netflix can come back and can start to be a strong stock again.
Okay. Oil prices are falling for the 5th straight day. We'll find out how the futures traders are playing that move, and we'll do it next. It's time for the futures outlook. Crude oil getting crushed. Let's bring in Brian Stutland for the trade there. I mean, this is not that complicated, right? Inflation expectations up, rates up, dollar up, oil down. Is that how it's going to stay now for a little bit?
It might. I mean, look at the trade has been in the past to play oil. When we got the announcement by Moderna and Pfizer on the phase 3 success of their trials, oil really took off in this up channel. And like you mentioned, now we have these other factors now adding headwinds to it. And I think oil got a little ahead of itself, Scott, when we saw it sort of jump a few weeks ago. But then the Saudis, by the Saudis saying basically we're not going to increase supply, that doesn't mean the Russians aren't or the U.S. producers aren't going to increase supply. So now I think we're seeing it sell off along with these other factors you just mentioned. And if I'm long energy names, which I've added to in our portfolio in our mutual fund, I've added to energy, but maybe I don't want to sell those names and have a taxable event. So instead, what I'd like to do is play the futures market here in oil. I can short a crude oil future looking at around 61.80. I think that's a good level to sort of get into the downside with the target of 60. I think it looks like we're going to trend back towards that level on the downside. And if we rip back to the high side, I have a stop. I take myself out of this trade at 63.20. So I'm basically risking 1,400 to make 1,800. Kind of hedges my energy risk if I've had that on in my portfolio, or if you want to just take a short bet. I think the channel is still to the upside here, Scott. So I'm not ready to get out just yet, but this is a great way to play to the short side. Take a little profit off the table after a huge run.
All right, Stutz, appreciate it. We'll talk to you again soon. Brian Stutland, we have final trades coming up next.
Missed the show? Don't sweat it. The Halftime Report now has a podcast. Market-moving interviews, call of the day, unusual activity, and of course, Ask Halftime. Look for us on Apple Podcast or your favorite podcasting app and subscribe to the Halftime Pod today.
let's do final trades if we could. Carrie, you're up first.
Schwab. We think they benefit from higher interest rates. The stock's been a good one. We think it can go higher as integrate the TD Ameritrade purchase.
Okay. Farmer Jim?
The defense stocks, as I mentioned earlier, have been really left behind. Northrop Grumman is my top pick because that's where incremental defense spending is going to go.
Okay. Doc?
Jim had me at spending, Scott. MasterCard, we see unusual activity in this name. I bought it during the show. Obviously, some of those stimulus dollars are going to be pouring through this plastic card.
All right. Josh Brown?
People are finding out it's difficult to actually mass produce electric vehicles, and the money continues to gravitate to the company that can, which is General Motors, staying long.
All right. Good stuff. Thank you. The exchange is now.
And the exchange does begin right now. I am Brian Sullivan in once again. Thank you, everybody, and welcome. The tech treasury battle continues. Investors fleeing high valuation names as yields jump a lot. Who will win this tug of war that literally has trillions of dollars on the line? Baseball, Moneyball, and Bitcoin. The Oakland A's becoming the first Major League Baseball team to accept the crypto as payment. We'll speak with the team's president about that bold move and why they're doing it. Some big money going after Kohl's. They say it's time for the retailer to refresh. But Kohl's is telling them to hit the road. We'll talk about this brewing, retail, brouhaha. All that ahead, plus continued good news on vaccinations and hospitalizations. They are dropping across America. We'll get to all that over the next hour, but let us begin, as always, with your money. As rates rise, they continue to pressure some technology stocks, and I assume, Dom, that is why you are looking at some technology stocks.
Absolutely right. So you can see here the underperformance is still happening with the NASDAQ composite down nearly 2% right now, 1.75%. We're just off of the worst levels of the session so far, but the Dow Industrials continuing to outperform, triple-digit gains there. For the S&P 500 on a more kind of balanced basis, we were down 5 points at the highs and down 31 at the lows. So you can see tilted more towards the lower end of things in that range today. Still, though, a bit of a mixed market, value outperforming. Interest rates, a key part of that story. We've shown you over the past several days the 30-year long bond, the 10-year Treasury note, all of those yields coming into play. Well, here's the difference between shorter-term rates on the 2-year Treasury and the 10-year Treasury longer-term rates. You can see over the last 6 years, they've been pretty much in decline. But just look over the last several months here, that sharp move higher. This, by the way, puts this difference in yields between long-term and short-term interest rates at the highest levels going all the way back to 2015. That's been beneficial for certain parts of the market like the banks, but certainly not, Brian, to your point, the big cap technology stocks. Look at Apple, which is down about 2 1/3%. Microsoft there down about 2%. Amazon down 2%. Alphabet nearly down 2% as well. Collectively, Brian, these particular moves are the most important because these 4 stocks make up 36% of the NASDAQ 100. So if you are invested in QQQ, that ETF, 36% is driven by these 4 stocks. That's why they're important. Valuations matter, especially with interest rates, Bri. I'll send things back over to you.
We're not done with you yet, Dom, because actually there's something I think occurring in the markets which is kind of important and maybe kind of cool, and it was a worry years ago, and I will admit that I was one of the guys that was, it's hard to say, wrong about this. I didn't think the market could go up if those and a few other big cap tech stocks went down. Because as you noted, their weight in all the major indexes and the ETFs is so great that if they were down, no way the others could pick up the slack. I'm happy to be wrong. It's kind of cool, Dom, that the Dow is up. Not a lot, but it's up lately, even as Apple goes down. Maybe there are other stocks that can pull the cart.
Not maybe. There are other stocks. One of the interesting parts to look at, and the broadening of the rally is something that a lot of experts have been weighing in on. They're actually saying it's healthy for the market when it's not just 10 stocks that determine the entire outlook of it. If you look at some ETFs that track the equal weight index of the S&P 500, the RSP, that's the ticker there versus SPY, it shows you that on an equal weight basis, the entire S&P 500 is actually doing better if you strip out the negative effects of just those mega cap tech companies. So that rotation towards value stocks, that tilt towards beaten up names, this broadening out of the base for the rally may actually indicate, perhaps to some folks out there, that this has legs because more types of companies are participating. It's not just those handful of stocks that have been darlings for, I would argue, the better part of a decade plus at this point, Bri.
I'm looking now. Throw up a year chart of Goldman Sachs. We probably don't have time. GS, Goldman Sachs is up 150% in 12 months, Dom. Printing money for investors. JPM and Goldman leading the Dow. Look at how good you. I say it and it happens. You're
right
like,
there.
You're magic.
153% over the last year. And by the way, JP Morgan Chase not too far from a record high right now as well.
Big banks and oil and gas stocks leading the market in 2021. Who'd have thunk it? Dom Chu, thank you very much. All right, so as Dom said, the stock market and your money out there really kind of being controlled by the bond vigilantes right now. Bonds move and so do stocks. And despite all the moves, though, Fed Chair Jay Powell made it clear yesterday he is not ready to step in. Here's what he said to our own Steve Leisman about the rise in rates.
We monitor a broad range of financial conditions, and we're always attentive to market developments, of course. We're still a long way from our goals, and it's important that financial conditions do remain accommodative to support the achievement of those goals.
All right, let's now bring in Rick Santelli. And Rick, I kind of semi-jokingly tweeted out yesterday that unless Powell and the other Fed chairs are going to work at a vaccination clinic and literally put the jab in people's arms, I'm not sure what monetary policy is going to do. We don't have a financial crisis like 08. What we've got is a pandemic and 30 million or so people that don't travel, and hospitality and leisure has been completely decimated while the rest of the economy kind of hums along. This is not some kind of textbook recession, right? I mean, do you think the Fed is going to nail this one and get it right? Because they're approaching it like it's kind of a financial crisis when it's not.
No. And by the way, and I'm not trying to be overly kind because I always call it the way I see it, but Steve's three-part question actually was a good question. The issue I had was that I thought the chairman did kind of a Fred Astaire answer. He was kind of dancing around the issues. Listen, no Fed person in the world, past, present, or future, is going to be able to thread the needle on any of this. These policies are going to have costs, and these costs are going to be charged to everybody in the U.S. economy and maybe in the global economy over the future years. We have definitely pulled forward many things, whether it's activity, whether it's housing. But at the end of the day, you're correct. This is a one-off, and we're dealing with it in ways to make sure and overcompensate that we do 5 scoops too many instead of 1 scoop too less. And maybe that's the way you're supposed to think about it if you're Jay Powell or you're Christine Lagarde. But at the end of this dance, when the music stops and the gasoline starts to combust throughout the global economy with the U.S. leading the way, they are going to have one heck of a time finding enough fire engines to keep things contained.
Yeah, we're going to find out. And listen, I also tweeted out last night, Rick, that I think we'll have 5% unemployment, almost full employment by the end of the year. As long as the variants don't take over and we all get out, the economy could boom. We're going to find out. It's going to make a lot of rich people even richer over those years because of these rates. Rick Santelli, thank you.
It's not about rich or poor. You know what it's about? It's about people who haven't even been born yet, that haven't even cashed a check yet, that already have a bill. That's what it's about.
Yeah, the deficit's never been this high except for maybe a brief period in the Revolutionary War and World War II as a percentage of GDP. Rick Santelli.
Well, only as percentages, yeah. The numbers with the trillions, they're out of control. We should come up with an analogy to try to get our arms around 1.9 trillion every day so that the politicians who all voted for this understand exactly the humongous dimensions that they put the country under.
Yeah, the Fed's balance sheet is almost double the annual budget of the United States of America. 7 or 8 unelected officials running a balance sheet twice as big as the entire nation. Who'd have thunk it? Rick Santelli.
Well, I don't know. Do you really want some of the elected officials in charge of that balance sheet? Seriously.
I'm going to move on. Rick Santelli.
There you go.
All right. I try to stay out of the world of need a shower after talking politics. All right. As this tug of war continues to play out between technology and treasuries, is it a winner-take-all market, or really can both settle down and make your portfolio thrive? Let us ask two Jameses. James McDonald is CEO and CIO of Hercules Investments, and James Camp, Director of Strategic Income, Managing Director of Fixed Income for Eagle Asset Management. James Camp, I will begin with you because you're talking bonds, we're talking fixed income, you're talking rate rises, we're talking the Fed. What is that $7 trillion or $6 trillion on the balance sheet stimulus, maybe a $2 trillion infrastructure package coming in? What is that going to do to the bond market? Is there global demand for our debt so we don't have to worry about the deficit, at least not for a while?
Well, Brian, it's good to be with you. And I think Rick hit on something pretty important. If you try to figure out what 1.9 trillion means, I'll say it this way. It means that the collapse between potential and real GDP is upon us. And once you get to that point, because of this massive stimulus, you're going to get inflation, you're going to get shortages, you already have commodity prices at decade highs, and you're going to see Treasury yields back up. If the market were not arbitrating this in the form of long-term rates going higher, I would have genuine concerns. But right now, as we really forecast, because of the out-of-phase nature between Fed policy and fiscal policy, we're going to overcook it.
James McDonald, do we have to look at the market differently? Because as I said earlier, it's not a sort of a run-of-the-mill recession, right? It's not a great financial crisis. It's financial devastation for 10 or 20 million families that work in industries that have been decimated. The rest of the economy seems to be doing fairly well. Do we need to look at this very differently? And if so, how do we tweak our thinking?
These are extraordinary times, and when the paradox of the greatest threat to humanity in our lifetime perhaps came in, triggers the greatest financial comeback, and in terms of stock prices, greatest rallies on record, the paradox is unreal. We saw an alignment and correlation of deaths and rates of infection lockstep up with the S&P 500 and the Dow and the NASDAQ. We saw the risk growing and the markets growing, and there's a disconnect. And there's never been a greater disconnect, to Rick's earlier point, between Main Street and Wall Street. There are going to be consequences for this stimulus, but we had to do it. We had to come in and save the economy from going off the cliff with us not being able to operate as normal. And so we have to look at the market differently, both monetary policy, valuations, and portfolio asset construction as well. Everything is different now.
Well, and I agree with you, James McDonald. I'll stay with you. I mean, and I've actually said we should have given $20,000 checks to restaurant, hotel, travel, and small businesses that were absolutely decimated rather than sort of sprinkle it equally. But that's a whole different argument, and spilt milk under the bridge, as they say. So James McDonald, how do we look at it then? Do we look at this unprecedented intervention as just a reason to own stocks long and strong all day long?
Right. So what it's done is it's catalyzed a herd mentality. And in behavioral finance, we see patterns of people crowding into a sentiment. And it could be a bullish sentiment or a bearish sentiment. And to the earlier analysis, the FANGs and all big tech have started to come down. They just took the bull market somewhere else. The Dow is broken out. The S&P is broken out. And what we find now is a mentality that there's money to be made going long, and it's finding a home. And I think that we see pressure here on the Russell finally in the last couple of days, but the Dow broke out. People are finding areas to make money and pushing stocks or pushing areas higher. Dow transports are breaking out. It's a bull market, and that bull market is going to persist to find pockets of strength.
I guess, James Camp, you forgive me. I'm getting old. I'm like the guy yelling at the clouds, get off my lawn. I mean, when I look at double B minus debt trading at like 3.5%, I just wonder, companies that people thought were going to go bankrupt 2 years ago now have debt that's trading like their AAA balance sheets. I mean, how does this end?
Well, Brian, the triage part of the financial crisis, or the COVID crisis, the recession of choices, I think you've correctly sort of intimated, was record corporate bond issuance because the Fed opened up the purses. And in that corporate space, they have gotten very comfortable operating as triple B operators. The majority of corporate debt is now triple B. The issue is going to be all of those are not created equal. They have different leverage, they have different dividend policy, they have different balance sheet management, in fact, business operations. So when we look at income generation, triple B is not bad, but you better understand the leverage that you're taking when you're generating income, either with a debt instrument in the form of a bond or a dividend stock, which we are very bullish on. To the other James's point, the rotation is happening. The income lag of 2020, which was historic, is now catching up. And many of these balance sheets from great American companies were conservatively managed in the form of dividend policy, and that income acceleration on the equity side is going to happen.
James Camp, James McDonald, both of you kind of saying the same thing, that there will be a piper that needs to be paid, but it's not right now. James is. Thank you both very much, guys. Have a great day.
Thank you, Brian.
All right. Well, speaking of interest rates and the Fed, RBC out with a list of stocks that could be winners if the Fed lets inflation run hot. For those names, you got to head over to cnbc.com/pro. Some interesting picks there. All right. We have got a market flash for you and a big possible deal. Look at Hartford Financial jumping. Bloomberg reporting that Chubb, the huge insurance company, is exploring a deal to potentially buy Hartford Financial for as much as $21 billion. Hartford briefly halted on that report. It's trading now. It's up 11%. Chubb actually is higher despite being the reported potential buyer. Again, no deal yet, but the report is a Chubb sniffing around the Hartford. Well, watch that stock, now up 12%. All right, on deck, baseball meets Bitcoin. The Oakland A's accepting the crypto Bitcoin for a limited time to buy a luxury box. We'll speak with the team's president about the move, as well as the countdown to opening day. First, let's get a check on the chips. Some of the pain the big names have caused investors lately. If you're not paying attention, look at this. AMD down 19% from its highs. NVIDIA 15%, and Qualcomm off 21% from its high of the year. Dow's up 108. We're back in 2 minutes.
This is The Exchange on CNBC.
All right, welcome back. Well, you know that Bitcoin has been on an incredible run. You may not know how much, though. It is up more than 1,000% in the past year. It's batting 1,000. But baseball fans in Oakland are probably rooting for it to tank. Why? Well, because the Oakland A's just announced they're selling full season access to one of their luxury suites for the price of one Bitcoin. And either way, the best part is that we can go to a game, even in California, albeit with limited attendance for now. Let's welcome in Dave Cavell. He is Oakland A's president. Dave, listen, as a longtime Angels fan, I apologize in advance of how this interview is going to go. I'm kidding. Always loved watching Ricky Henderson run the bases. I'm dating myself. Why are you guys doing this? Is this some sort of a Bitcoin promo stunt, or are you guys true believers in crypto?
Well, we've had so many of our fans reach out and be interested in actually paying with Bitcoin, whether it's tickets or potentially even sponsors. And so we thought this was a good way to test the market to see if there really was the interest level in transacting in the cryptocurrency as opposed to just using it as a store of value. And we felt that a suite to the A's game for a whole season was a good place to start.
And so what would a luxury suite, I don't know if you're allowed to say this on the air, Dave, what would a luxury suite normally cost? I'm trying to figure it out versus one Bitcoin and how much you're kind of potentially losing money or maybe making money if Bitcoin soars.
Yeah, it's usually $64,000 for a full season suite for a whole year. And so the current price of Bitcoin, I think it's around $57,000. So it's at a little bit of a discount if you just paid with one Bitcoin, but it did crest 60. So you're getting a little bit of a Bitcoin discount these days. So, that's, I think, why we've had a lot of interest, over 100 inquiries, lots of folks signing up. And I think we'll probably have a transaction here today or tomorrow, the first one go.
Is it just one suite, or like if people see this like, oh man, I love the A's and I got a bunch of Bitcoin, let's do it?
Yeah, we've set aside 10 suites for this. So we have the ability to sell up to 10. And so we're hoping to see, we'd love to sell all 10 if possible. And we have between now and April 1st to actually do the transaction. And, like I said, we've been hearing from a lot of our fans that they're interested in paying with cryptocurrency. And I think if you see this in baseball, you could see it anywhere in a mainstream location. So it's an important point in seeing if this is a real way to transact in the marketplace.
All right, let's talk baseball, shall we, Dave? Because I would love to come out there to Oakland, Alameda. Maybe I'll wear the Angels stuff as long as people aren't throwing stuff at me. It's fine. You've got very nice fans. I appreciate it. What's the season going to look? All of it, California's been, sort of doing their own thing. I'm not going to judge either way. They're a little more closed than a lot of other states. What do you think the season is going to look like in May or August?
Well, we worked with the governor's office and the Alameda County authorities, the health officials, to basically set up a 20% opening plan, which starts opening day, April 1st. So we'll have 20% capacity, and that can increase as the season goes on to 33 and then potentially 66. And hopefully at some point this year, maybe by the 4th of July, we could be fully open because we feel we have a safe plan. More people are getting vaccinated. We've been working hand in hand with the health authorities, and we just want to get baseball back and people out to the ballpark having a great time.
Yeah, and we know the science is pretty settled around being outside, so I think that we've got that on our side as far as the safety levels are just exponentially higher than indoors as well. But you do play indoors. I mean, there are teams that play inside. I'm looking at you, Toronto. Have you guys had these conversations about how it may look from, oh, by the way, are you even going to be able to go to Canada to play?
Well, they're starting in Florida, in Dunedin. So the Blue Jays are not playing in Canada to start the season. So we'll see how it changes over time. Yeah. So, and I think a lot of the teams who have dome stadiums are playing with them open for that very reason, to make sure there can be, open circulation and airflow, which is really important to preventing the spread of COVID.
I'm not going to ask you to make some bold pronunciation about science or medicine, and hopefully, we'll be in a much better situation. The numbers are looking good, fingers crossed. Do you think there's any chance some point this season, I don't know, late September, Dave, or something, where you got a full stadium?
I think there is. And I think we're on that trajectory, and we want to do it in a safe way, both for our players, obviously for our fans, and for our staff. And we want to, lead with the science and ensure that we do it in a safe manner. But I think it will happen this year, and I think that'll be a great moment to celebrate getting through the pandemic and being able to go out, get a hot dog, hang out with your family, celebrate an A's win and a fireworks night afterwards. So that's what we're shooting for.
There you go. I think it's a noble goal. You're making a lot of families happy. I'm thinking about all those parents in California, especially in your area, still struggling with kids out of school. Take the kids to the ball game, buy them some peanuts and Cracker Jack. We'll sing some songs. As long as it's not against the Angels, we'll do it. Dave Cavell, we appreciate it, Dave Cavell from the Oakland A's. Really cool stuff. Best of luck Best of luck to the team and everybody this year, Dave. Thank you for joining us on CNBC.
Thank you so much.
All right, take care. All right. Coming up and staying with California, it has been a long time since any winery or wine company tried to go public, but that's all changing. And Delicious Duckhorn setting for an IPO and doing great. Remember IPOs? Well, the CEO does, and he's up next. And don't forget, if you are getting out, you can watch us on the CNBC app, maybe at the ballpark. Watch the game, watch Kramer, do it all on the CNBC app. Download it today. Dow's up 140. We're back after this. All right, welcome back to the exchange, everybody. Let's check on your money right now. And stocks, they are mixed, but it's been the trend that we have seen the last couple of weeks. You've got the boring old cyclicals, the banks, oil and gas, whatever. The Dow is up 153 points, but technology stocks, they continue to sell off. Yields rising, the 10-year yield popping today at 175 last time I checked. That is pressuring valuations on names like Apple, Microsoft, Amazon, the names you know. So the Nasdaq's down 1.5%. The Dow is up 0.5%. Industrials, financials, and materials are your leaders. As we talked about with Dom Chu, if you're not paying attention to the banks, Goldman Sachs stock is up 152% in 12 months. Goldman printing money. Technology and energy are the biggest laggards right now. You actually got crude oil is down a bit. A lot of concerns about what's happening in Europe. They're seeing cases rise in Italy and some other places. Remember, their vaccination rate is about a quarter of ours. And unfortunately, they are seeing a re-rise in cases and some new lockdowns in countries like Italy as well. So hopefully they can get their vaccination program like we have getting going a little bit faster. All right, now to some of the movers this hour. Retail and reopening edition, if you will. Shares of cooking supply company Williams-Sonoma sharply higher. Better than expected fourth quarter results. Demand for home furnishings continue to be a tailwind there. We're all locked in. We're all cooking, trying to learn how to cook, whatever in some cases. Retailer also seeing strength in stores where restrictions have been lifted. So you're either cooking at home or you're going to the mall. One of the two. AMC higher again today. The company reopening more theaters around America. Check this out. 98% of AMC's theaters will be open in some form, maybe capacity limited, whatever, but open as of tomorrow. Who'd have thunk that just a couple of months ago? And airline stocks, again, in the green. United trading at its highest level in a year. Bank of America credit card data shows people are starting to spend a lot of money on flights and tickets. Looking out at the future. All right, let's get a CNBC update now. For that, we go to Rahel Solomon. Rahel.
Hi, Brian. Hello, everyone. The Senate has confirmed Xavier Becerra as President Biden's health secretary. Becerra is now the first Latino to head the Department of Health and Human Services. A cardinal close to Pope Francis is defending the Pope's ban on blessing same-sex unions. That comes after some Catholic groups voiced strong opposition to the ban. A group of priests in Austria said that they were deeply appalled by the decree, and a Belgian bishop said that the decision is, quote, painful and incomprehensible. A weather satellite got an amazing view of those severe storms across Mississippi and Alabama. So those flashes there of lightning strikes, and they're apparently exactly what the geostationary lightning mapper was built to capture. Pretty cool. And with spring coming, scientists are setting new battle lines in the fight against murder hornets. They'll be setting up thousands of traps to catch hornet queens before they can set up new hives. And to get all of your murder hornet news, be sure to watch the news with Shepard Smith. Brian, I'll send it back to you.
Okay, Rahel, what's your take on giant bugs? Just give me your immediate reaction when I say giant bug.
Usually not my thing, but apparently Shep is very interested, and so you got to watch to learn more.
No, throw me on the Shep show. I'll tell them why you don't. You know why? Because cicada brood X, 1.5 million cicadas are going to come out of the ground in New Jersey and D.C. per acre starting in May.
You know what that is, Brian?
1.5 million per acre.
You know what that is? Random,
What?
but interesting. Mike, drop.
You're good. That's it. The RBI, cicada brood X. I love it. Rahel, thank you very much.
Sure.
1.5 million cicadas per acre. It's disgusting. All right, now for your daily vaccine and health update. How's that for a transition? And the news does continue to improve. Not in Europe, but here. In all, 74 million Americans have now had at least one shot. 40 million of the U.S. are now fully vaccinated, which of course doctors say means your chance of serious illness or death is maybe not zero, but it's darn close. In all, 113 million doses have been administered so far. Even better, 38% of the highest risk population, those over 65, are now fully vaxxed. And though cases are popping up higher in a couple of states, tip of Michigan, some others, here's the data point that really matters to most that we talk to. The CDC reporting hospitalizations are down 72% from their highs of early January. Listen to the experts and the science. Cases are key, but outcomes, hospitalizations, and fatalities are far more significant metrics to look at. Listen to the experts. All right. Still ahead, the battle for Kohl's. While the stock has dug itself out of a deep hole, now some big money is starting to circle the retailer, and they want changes. We'll speak with one of the investors about what they want from the Wisconsin company. But right now, as we go to break, it is show and tell time. We're going to show you today's chart, Ulta Beauty, and it is a beauty. It has been a rocket ship, up nearly 150% in 1 year. And a lot of that credit goes to outgoing CEO Mary Dillon. And here she is in her own words on how they managed through the lockdown.
You have to do it all. But certainly through the pandemic, we went from having, buy online, pick up in store already available to curbside. It's quite convenient in an off-mall location, right, for a guest to come in and pick up their order. So we continue to see the role of both the store, which we're going to continue to build more stores for many years to come, as well as really ramping up our whole omnichannel capability.
All right, welcome back. Well, if you like wine, you know the name Duckhorn, known mostly for their reds like Duckhorn Merlot, Decoy Cab, and Paradox Red Blend. Not that I would know. But now they will be known for something else, a stock. Duckhorn going public. No, not a SPAC, an actual IPO. Remember those? And shares indeed are moving higher with the fantastic ticker NAPA. How they got that, I have no idea. Joining us from the NYSE is Duckhorn Portfolio Chairman, CEO, and President Alex Ryan. Now, Alex, welcome. Good to have you on. Congratulations on an actual, by gosh, IPO. Big fan of your product, but maybe too big of a fan of your product, by the way. Why do the IPO route and not, like everyone else, just get in a SPAC?
Oh, well, thank you very much for having me. We're traditionalists. For 40 years, we've been building one-of-a-kind winery, luxury winery asset. And for us to control the message and control the performance, we thought a traditional route was part and parcel to our culture. So we controlled it from start to finish. We're very happy about where things are heading. And again, we're luxury winemakers, so we like control and we like messaging. We thought traditional route was the right way to go for us.
Well, it's working out because the stock, again, Napa, fantastic ticker, by the way. Not sure how you got it. Is higher. We have unfortunately seen in the pandemic and lockdowns, Alex, alcohol consumption in the home go up. It's been good for you guys probably, but we're all ready to bust out. Have you done any analysis? It's got to be probably impossible, but like what sales may look like in a year, given that a lot of us are just going to go out. Some people will be more reluctant.
I think sales are going to be good for wine. You know, we've had an opportunity to share a lot of wine with our close family at home. That's been a good thing. People have seeked out our wines, especially in the grocery premise, off-premise channel. We've had a lot of success there. We've also had an opportunity to introduce a lot of new products during this trying time. I think that's going to be really sticky. I think we've not only educated the people who love our wine, but a lot of new people have had opportunity to try our wine, working through the issues of COVID. When they break out, when we all get out of our homes and go out to Main Street, I think we're going to continue to enjoy those brands who have provided us joy and comfort through the pandemic.
You're also a travel and leisure company, Alex. You're not just a winemaker. You've got vineyards and you've got tours and you've got, destinations. And most of them, I think all of them right now, are closed. What is sort of, I don't know if you heard the Oakland A's president interview a couple of minutes ago saying he thinks they could have a full stadium sometime later this year. That's not too far from where you guys are. What do you foresee for travel and leisure and that part of your business?
Correct. We're an experience-based business, right? People like our product, but they love the experience. Everyone wants to be part of luxury, part of Napa, and part of wine. We see people coming back. They're starting to come out of their homes. They're starting to come back. We have a lot of people in California, the sunny state here. So people are going to start coming back, and I think they're going to come back and want bigger pieces of the wine experience as their lives return to some type of normalcy. So we're really encouraged by those trends you speak of.
Yeah, and we saw it with the Bank of America credit card data. I referenced, Alex, people are starting to buy airline tickets en masse, more than 1 million people traveling. Are you starting to see people call up and say, when can I come?
Yes, it's working. It's coming now. We're seeing it in springtime. And during a couple rainy spring days, people still wanted to come to the winery. They want experience. They want to enjoy experiences with their friends. And the wine country and the wine experience, there's no better way to do that with your loved ones. So we're seeing the trend begin, and we're hoping and thinking there's a good chance it will hold for the foreseeable future.
Certainly hope so as well. Maybe take a turn north if we can get out for an Oakland A's game. Alex Ryan of Duckhorn Portfolio, Napa the ticker. Investors responding positively. Alex, congrats. Best of luck to you and your team. And here's to a good spring and summer. Much better.
Thank you very much. Enjoy a glass of wine.
All right. Or two. All right, ahead. Bed Bath & Beyond, Big Lots, and now Kohl's. What do they all have in common? Well, they've all been targets of the investment firm McCallum. We're going to speak with them next about their current battle with the Kohl's board. And as we head to break, it is, of course, Women's History Month. And all month, we're spotlighting some of our CNBC contributors and friends. Here's Boston Private Chief Investment Officer Shannon Sakochia on breaking barriers.
We need to see more women in the seats that are meaningful in the corporate world. CFOs, CTOs, CEOs. And we need to no longer accept that as we break through a particular barrier, that we should be happy to be there, just happy to have a seat at the table. We need to keep our foot on the gas so that female leaders that come behind us can start from day one in making an impact.
All right, welcome back. Let's talk about the fight over the retailer Kohl's, recently saying no thanks to an investor group's attempt to seize control of the board by placing 9 members on it in late January, basically kicking 9 off, putting their own 9 in. Now, the group recently revised their portfolio last week, cutting that proposed slate of new directors down to 5. Where do they stand right now? Well, Courtney Reagan is with us and joins us with the latest with a special guest in the fight and the proxy campaign. Court, take it away.
Hi, Brian. So earlier this week, the activist group McCallum Capital Management, Legion Partners Holdings, Anchor Advisors, and 410 Capital sent their proxy statement to shareholders, including that narrowed board nomination done, quote, in absence of meaningful progress towards a resolution. The revised proxy campaign does nominate 5 to Kohl's board, aiming to unseat 5 current members, including the chair. The letter noted historical underperformance, saying it will continue unless there is a refreshed board that becomes elected. Kohl's has a website dedicated to its side, stating, quote, the activist investors campaign threatens Kohl's momentum and calls out a stock price up 170% from the time it detailed its strategy in October to early March. Further, the retailer says, quote, Kohl's board outmatches activist investors' nominees and key skills. The company points out to CNBC, S&P increased its outlook for its debt to stable from negative just on Wednesday. Joining me now is one of those activists, Jonathan Duskin, CEO of McCallum Capital Management. He is also one of the 5 nominees for the Kohl's board. Jonathan, thanks so much for joining me. There's been so much action, but one of the latest moves is a meeting I understand that you had with Kohl's CEO Michelle Goss earlier this week. What happened? Did you guys make any progress?
We had a wonderfully constructive conversation. And if I could just take one step back, Brian characterized this as a fight. It's really not a fight. We're the company's largest shareholder, and we're really here to help the company. It's a good company. We think we can help it become a great company. We have excellent nominees. We'll get a chance to talk about that. But this was a conversation between Michelle and I to spend some more time discussing our views about the business. And honestly, we have a lot more in common than we don't. And, I think it was a very productive conversation, and we really focused on the business and what we can do to make this a great company.
So if you're aligned towards ultimate goals here, Why did you then decline to meet with the board of directors? Kohl's said as much in a preliminary statement, a preliminary proxy statement that they filed this morning.
Well, that wasn't entirely accurate, Courtney. What I said was I think that the board needed to do some more work in terms of understanding what the shareholders wanted. These campaigns really come down to what the shareholders want. We're one shareholder, one of many. We're large, but obviously there's another 90-something% that own stock. And I think it was really important that the board had an outreach program to the existing shareholders to hear what we believe they're going to hear, to hear what pretty much we've been saying. And we think most of the shareholders are aligned with what we're saying. And the board had, I don't believe, done that. And so I felt like it wasn't there was a better opportunity to have that conversation a little bit further down the road once they gained some more information and some more insights about how their shareholders were viewing this. Some of the things they say about their momentum or how much the stock is up, just misleading, right? The stock is up from the absolute COVID lows. Momentum is really the economy opening. If you want to look back on any kind of time frame, 1, 3, 5, 10, even 20 years, the stock has underperformed rather dramatically, and the results have been down dramatically. EBIT down 44%. If you look back to 2001, March of 2001, the stock was at $50, give or take where it was when we launched our campaign. So we thought it was more appropriate for the board to actually do some outreach to shareholders and really hear what their constituents had to say, and then we could come back and hopefully have a more constructive conversation.
So Kohl's have said that your goals lean more towards short-termism and financial engineering. And there was also a Wall Street Journal article that sort of pointed in the same direction, saying it was short-term. So I guess in general, explain to me why that's wrong, how you intend to create value, and how long you hold a position on average before you move on, because it does seem that you're launching one of these activist campaigns about one every year or so. So is this a short-term boost for the stock price for you to make your money and move on?
That's a great question, Courtney. I appreciate you asking, so I get add a little context to that. The reality is we're a different type of fund and organization. We're more like private equity in the public markets. If you look at something like Citi Trends, we've owned it for multiple years. 2016, we've owned Citi Trends. We created a tremendous amount of value by getting appropriate skills, appropriate retail expertise in that boardroom. What was really lacking in Citi Trends, frankly, but we believe this board needs more retail expertise in the boardroom. So I don't know why they think how they can characterize us as short-termers. We make one investment per year. It doesn't mean we sell it the next year. We make one investment per year, and we hold them multiple years. And we really are here to create long-term shareholder value. I don't really see how anybody that owns 9.5% of a company can do anything on a short-term basis. We have to hold this for a long time to create value. So, many years down the road when we're exiting this position, people that we're selling to are excited to buy the stock. So I think those are mischaracterizations. I find it ironic that they're calling us short-termers when they're highlighting their performance in their stock for the last 5 or 6 months. That's obviously short-term. They're highlighting the momentum their business has, which is really the economy reopening and not so much their own business momentum. Over the last months, as and considering us short-term, I think it's a little bit disconnected.
Well, Jonathan, we are out of time for this one today, but make sure to stay close. We're going to follow this one closely. I believe a date now has been set for the annual shareholder meeting. Jonathan Deskin of McKellen, thank you very much.
It's the Battle of Menominee Falls, Courtney. Thank you very much. All right, coming up, the pandemic caused a logistics nightmare for many companies across the nation trying to move goods. Now, enter Transfix, maybe the Uber of trucking, if you will. We'll speak with the CEO about the road back this year. Speaking of trucking, transportation index hitting an all-time high today. Ryder, J.B. Hunt, American Airlines, which is not a truck, but you get it, and Norfolk Southern, also not a truck, but similar. Anything that moves things or people is up today. We're back after this. Well, 1 year after the pandemic first hit, we are still facing supply disruptions in the supply chain. Enter freight startup Transfix. Companies using technology to connect shippers with carriers to help speed things up and cut costs. Names like Target, Unilever, BJ's, and Wayfair, some of their clients as well. Joining us now is Lily Shen, President and CEO of Transfix. Lily, thank you very much. This is an industry, and I've got friends in the industry, I don't want to offend them, that was kind of stuck in the past for a long time, right? I mean, a guy, a truck, they move things around. What has changed? Where did you identify that hole in this industry was?
That's a great question, Brian, and thanks for having me on. As you said, the industry has, there's a lot going on in the industry. A lot has actually been manual and highly inefficient over time. And the role of technology and data has truly transformed the ways in which people truly think about supply chain, and being digital first has become more important than ever. A lot of businesses during COVID last year who weren't prepared to be digital did not do well, and many went under. And those who were really leaning into technology truly thrived. E-commerce, increased 44% year over year. A number of supply chain executives have also been investing in technology across the board and working with companies such as Transfix to really lead things forward.
So would you compete with a Landstar or an XPO, or would you complement that type of either trucking or logistics business? Where do you fit into your own supply chain?
Sure. So, I would say that it's both, right? I mean, I think that ultimately what we are doing is bringing together shippers and really connecting them to carriers. We're enabling carriers to be able to access freight much more dependably, much more consistently and reliably. And, we're really enabling shippers to be able to access capacity in a far more streamlined way.
We were down in the Port of Charleston, Lily, about, 6 weeks ago, showing how the container industry is just all sorts of screwed up, right? There's ships off the coast, empties being sent back. Where do we stand right now? When you see it, what are some of the problems that we are still seeing from this incredible surge in imports? In fact, Christmas items were still coming into the Port of Charleston as of a month ago. And I don't mean for next Christmas.
There's certainly been a backlog, and over the course of the last year, as you can imagine, there's been a ton of volatility. And during a year where we've also seen extreme highs and extreme lows. And the truth is, it's the nature of freight. It's highly volatile. Things are constantly changing. There is a backlog, but we're actually seeing very strong demand. And with the customers we're working with, we're continuing to see tremendous growth and projecting strong growth this year. There's a lot of optimism.
Yeah, and you know what? A big thanks to everybody on your side and in the trucks, the women and men who, by the way, when everyone was fleeing here, you guys were coming in, and these truckers, really unsung heroes that got no attention, putting themselves at risk. Lily Shen with Transfix. Lily, thank you. Appreciate it. Have a great day.
Thank you.
All right. That does it for the exchange. Power Lunch starts after this quick break. Hope you have a great day wherever you are. See you soon.
And welcome to Power Lunch. I'm Melissa Lee. It is rate shock on Wall Street. The 10-year yield hitting its highest level since January of 2020 at 1.75% as Fed Chair Jerome Powell tries to hold the line. You're seeing that play out in the markets today. The tech sector sinking while bank stocks are booming. We'll have much more on that new rate reality. And later, Shake Shack doubling down on its digital push, launching nationwide delivery with Uber Eats. CEO Randy Garutti will join us. Power Lunch starts right now.
Welcome to Power Lunch. I'm John Fort. While the NASDAQ sinks, the Dow hitting a record high. Dominic Chu has more on today's action. Dom.
John, it feels like a decade ago when we used to talk about tech and financials being the key parts of the market that really drive things. Interest rates are a big part of that story. You heard Melissa mention 1.754%. That was the high intraday so far for the 10-year Treasury note yield. It's important because you got to go all the way back to January of last year for that same level. So something to keep an eye on. That rate shock is driving a lot of action in the market so far right now. Take a look at the parts that we mentioned between financials and technology. We'll start first with what's happening with technology. Apple shares off 2%, Microsoft 1.5%, Amazon nearly 2%, and 1% for Alphabet. These are off the lows of the session so far right now. These four stocks represent a very large chunk of both the S&P 500 and even more so the NASDAQ 100. So that decrease in growth stocks and technology really driving things. Look at Tesla, Zoom Video, PayPal, staggering moves over the last year. But it's over here on this right-hand side that you're seeing some of that pullback from the highs that we saw over the course of the past several months. Now taking a look at the financial side of things. Look at these particular moves, especially in mega-cap bank-type names. Bank of America up 4%, Wells Fargo 4%, JP Morgan 3%, and Goldman Sachs 2.5%. I want to focus on these two right here. These are, by the way, record highs for JP Morgan and Goldman Sachs set so far today. And then check out the regional banks. The regional bank ETF, Melissa, John, has hit an intraday record high of its own today. That KRE, the ticker there, is up about 130% over the last year. SVB Financial, the parent company of Silicon Valley Bank, and Fifth Third Bancorp, both are some of the biggest gainers so far in trading today. And by the way, we'll put a star next to SVB Financial. Record high for those shares, Melissa. Multi-year highs for Fifth Third Bank. Watch the banks, watch the tech stocks. We'll send things back over to you.
All right. Thank you very much, Dom Chu. The spike in bond yields weighing on the NASDAQ, which is down 6% from record highs. So is it safe to buy tech or time to look elsewhere in this market? Let's bring in Yana Barton, portfolio manager with Eaton Vance, and Jack Ablin, founding partner, chief investment officer with Crescent Capital. Good to see you both. Yana, I'll start with you since you co-manage the Focus Growth Opportunities Fund. I checked out this fund. 42% of this is technology. The top 10 holdings, aside from AbbVie, are all in the tech sector or in this sort of higher valuation bucket. This is as of the end of last year. So how are you adjusting how you manage that portfolio given this rate environment, if you are?
Well, thanks for having me back. A lot has changed since year end, and actually our biggest underweight is in tech, but it's not because we don't like tech. It's because a couple of top names that were mentioned constitute almost 20% of our index. So we're actually finding opportunities in other areas of the market. And as we sit here right now, we're actually overweight industrials, financials, and healthcare. A couple of comments on NASDAQ, if I may, in this rising interest rate environment. We actually took a look at what had happened to the technology space in other previous rising rate environments. And technology on a cumulative basis actually does the best relative to every other sector. There have been 7 instances over the past 30-year period where we've seen the rates spike and technology does the best. And NASDAQ actually outperforms as well. It's important to note that NASDAQ is comprised of over 3,000 positions across $20 trillion. So again, that top heaviness that you were alluding to is what's driving the underperformance. This is the time to be active, not to go away from tech investments.
So clearly you're very active in terms of shifting that allocation within your portfolio, Yana. I want to get to Jack here because one thing stood out to me, Jack, and that was according to what you're looking at, you think rates should actually be much higher. This is the copper gold model. Suggests the 10-year should be closer to 2.7 or so. What does that mean on a practical basis? Does that mean that you think the 10-year yield has that much more to run? And how do you change your investing in light of that?
Yeah, thanks, Melissa. Yeah, I can't pinpoint exactly what the target number is. We do think it is higher. If you go back in time and look at the copper gold ratio, it really has had a great predictive power over the 10-year, not just to the upside, but to the downside too, going into 2020 and even prior to that. So I think, because that is saying 2.7, that does suggest to me that rates could go a fair amount higher, considering we're seeing this, this 1-2 punch, of, if you will, of stimulus, of pent-up demand, and cash on the sidelines will likely crescendo into a lot of growth in the second half of the year with a lot of pricing pressure. So the problem with technology, which we love, they've just become a victim of their own success. When you have, trailing 30 times PE ratios, that suggests that, if rates go up by, say, 1%, that's going to push the fair value PE ratio down from 30 to 20, which means that earnings have to offset by 50%. We need 50% growth just to keep prices where they are. So that, to me, at least in the near term, is a headwind for growth stocks, and a much easier time for sectors that have higher dividends, a much lower earnings yield, or a lower PE rate, a higher earnings yield, lower PE ratio, where most of their earnings and dividends are more upfront in the early years.
So, Yana, given what Jack just said and what you were saying about stock picking, how do you go about in your growth strategy really combing through tech? I'm looking at, say, PagerDuty, which just reported earnings last night, and there were beats and everything, but they're down nearly 5% still today. Are there certain lenses that you look at these stocks at to see if they're just getting more reasonable or if they're opportunities?
Absolutely. And I think what he is saying, I totally agree with, which is, the long-term valuation matters. And I think if you look at the makeup of the market and the underperforming cohort of the market, majority of that is in the area of the market that has price to sales in double digits, 20, 30 times sales, which we all know can't last forever. So you are seeing this reset of stocks that did exceptionally well when we had to pivot to this work from home environment, and these companies enabled that pivot. But now you have this cyclical recovery on top of the secular tailwind. So I guess the bottom line is that you can continue to ride out secular tailwinds alongside cyclical and stable opportunities. And I would agree it's much easier to do so in areas of the market that are not stretched in valuations, like healthcare, that continues to sell at 25% discount, like financials that continues to sell at the greatest discount on the next 12 months PE ratio. So I think we're in agreement, and one must be active and truly investing in these companies for the long term.
All right. Thank you both, Yana Barton, Jack Ablin. Appreciate it.
Thank you.
And despite Fed Chair Powell's best efforts to calm the markets, the 10-year yield rising today to, as we've mentioned, levels not seen since January 2020. And this morning we got strong manufacturing data from the Philly Fed, but 770,000 new jobless claims reported as well. So as the Fed balances employment and inflation, how hot can the economy get before the Fed has to raise rates? Let's bring in Steve Leisman and Rick Santelli to discuss. Steve, the Fed's hand going to get forced here eventually?
I don't know, John. I'm not thinking about raising rates, if you really want to know. Yes, I'm glad you got that joke, an inside Fed joke. Here's the thing. Fed Chair Powell, and I got to take him at his words, thinks we can get back to the low unemployment rate we had, 3.5%. And I will say that you still have some 9 million jobs that were below where we were in February. 3 or 4 million people have dropped out of the workforce. He sees the actual or real running unemployment rate closer to 10%. So wherever that point is, John, Powell and the Fed believe we have a long way to go before we get there. And they see that the issues of inflation that we see now, for example, in the Philly Fed, off the charts with the prices paid index, he thinks those are temporary and not related to a longer, more permanent and troublesome inflation dynamic, which would come from really a wage-driven inflationary spiral.
That's all nice and well, Steve. But the more dovish Fed Chair Powell is, the more he's giving a green light for the bond markets, Rick, to get the yields to go higher. We didn't see any overnight dip buying in the bond market. People just don't believe him, or they believe him to the extent that the Fed is going to let inflation run hot. It is willing to stay there in that hot inflationary environment, and therefore bond yields, they can go up, they can go higher.
Yeah, no, not only that. Once again, you really hit it, Melissa Lee. The real key is there hasn't been any major pullbacks. All the curves are steepening in a bear steepener, meaning lower prices, higher yields. Even the short-dated maturities, a 2-year note came close to 17 basis points today. That would be the highest yield close of the year, 17 basis points for twos. So it isn't only the long-dated. The entire curve is moving higher. And yes, prices paid, and Steve's right. Break-evens, 5-year break-even, crossed over 10-year break-even. These are all very important, but we can make it so much easier. Why are investors doing this? They know the Fed could ramp up 80 billion purchases a month of treasuries, 40 billion of MBSs. They could ramp it up. Think of the numbers they were buying in the beginning of the pandemic months in February, March, April. But here's the key. The key is that it really doesn't even need to be about inflation. See, it's almost that we're getting diverted to pay attention to all this and all the policy regarding 2%. And he sounded great. The issue is rates are too low. After everything we've been through and all the manipulation, they're too low. For the risk-reward parameters that equities and stimulus are flashing in front of investors. So all the rest of it is just icing on the rates are going higher, we don't care what you say cake.
So, Steve, I mean, just a few days ago, we're hearing all these investors say, oh, well, I don't think that the 10-year is going to go above 1 point, yield is going to go above 1.6 and stay there. But here we are, 1.7 plus. What if the Fed can't control this movement and we have all of this reaction from a lot of the stocks we were just talking about? What does the Fed do then?
Well, I think Powell yesterday may have given a green light for yields to run higher in really not strongly answering the question I asked him about whether or not he liked the idea of controlling bond yields, whether or not he was interested in it, and whether or not he wants to do it. He sort of, danced around it in a way that suggested it's not really going to happen and created really a one-way trade there. And I think that was part of the reason that you had this rise in yields is he didn't answer it in a strong way. He said, policy's appropriate for now. Our tools are our tools, which kind of suggested maybe he would use it. Anyway, it was kind of a squishy answer that kind of gave the green light and created a one-way trade there. I think there is a level, John, that brings the Fed in. I don't know where that level is. I think it's somewhere north of 2%. I will say this, though. If you have an economy that's going to grow 6.5%, has strong economic growth, a massive amount of stimulus coming out, it would be really weird if bond yields weren't higher. So there's a piece of this that makes absolute perfect fundamental sense.
Yes, that is true. Rick Santelli, we on Fast Money had a really interesting conversation with former Dallas Fed President Richard Fisher last night, and he made this point, which I thought was really interesting, regarding transitory inflation, the notion that inflation can be transitory. And that is, when companies have inflation, they have inflationary pressures, and we're seeing it every day. 3M just said this at the Bank of America conference yesterday, that they're seeing the cost of goods like materials, et cetera, rise 2 times faster than expected. When we see those kinds of moves, companies raise their prices. And do companies take back those raised prices? Do they say, you know what, no, we're going to cut the price by 5% because materials have gone down? Unlikely. So the notion that inflation can be transitory may be a little misguided here. I'm curious what you think, because the implications for the 10-year yield could be pretty large.
Well, I think there could be some transitory issues in the measurement process that the Fed uses, but I completely agree with the context and the texture of Richard's comments, because what he's really saying is that from a business perspective, if you're monitoring all your big purchases, if you're monitoring lumber prices in a house, if you're monitoring how crude oil is affecting plastics and textiles, those prices will stay up. How they figure into the ultimate calculation of the Federal Reserve, there's where your transitory issue is. I do believe that prices are going to be firm. There won't be any takebacks. but we shouldn't put that as the lead issue. I still contend that, Steve, couldn't agree more. The economy's hot, hot, hot. Rates are going to go up, and that's why the Fed is between a rock and a hard place, because he can't say anything when something is occurring that is a natural occurrence. Go on.
We pay the Fed, Rick, to be between a rock and a hard place. Real quick, Melissa, if companies raise prices and get to a certain level and they stay there, that's not inflation. That's a rise in the price level. Inflation is the rate of growth. If they keep raising prices, that's inflation. So you could have a one-time rise in the price level, and that's not inflation. That's one of the transitory things Powell's talking about.
Okay. That's
let's put that to a poll to the American people and see what they think about
when you
it.
gotta
When
pay
their
more,
car goes up from 30 grand to 40 grand.
All right.
Right. If it doesn't go up anymore, we're all good. Yeah, I agree with you, Melissa Lee.
All right. Steve and Rick, thanks so much. Coming up, Goldman Sachs at a record high as rates move higher. And while the SPAC boom is good for business, it is hitting employees hard. We've got a special report. Plus, Shake Shack saying it will deliver nationwide in a deal with Uber Eats. And so far, its digital push has paid off. That stock is up 80% in the last 6 months. We'll speak to CEO Randy Garutti later this hour. Much more Power Lunch straight ahead.
Welcome back. Rising yields have pummeled growth in tech stocks, but are driving bank stocks higher. Financial sector at all-time highs, with 27 components hitting 52-week highs today. But as bank stocks rip higher, junior analysts at Goldman have complained about a crushing workload, thanks in part to a boom in SPAC deals. Analysts are quoted as saying, "My body physically hurts all the time, and mentally I'm in a really dark place. I've been through foster care, and this is arguably worse. I can't sleep anymore because my anxiety levels are through the roof." Joining me now is Hugh Sun, CNBC.com banking reporter. Hugh, the way Wall Street can churn through young entrants into the space is kind of legendary. So put this into context for us. How much of this is because of the pandemic? How much of this is what you would expect during a booming time?
Hey, John, nice to be with you, man. So it's true that it's both. Okay, so this has always been the case on Wall Street, certainly for the decade plus that I've covered it, which is that, you know, it's sort of a meat grinder, which is you think of it as this pyramid in which thousands of junior analysts start, you know, they graduate from college, you know, hopefully, you know, do well in academics and be seen as a promising person on Wall Street. They get sucked into these programs, and it's an indoctrination, sort of a winnowing out process in which, you know, if your pain tolerance isn't high enough and you can't survive 100-hour work weeks, then perhaps you don't get to the next level of associate and, you know, and so on, and hopefully climb that ladder. And so some aspect of this is timeless and is indeed sort of the hazing process that happens on Wall Street. And some aspect of this is, you know, the SPAC boom. And as we just updated our story on CNBC.com, you know, the epicenter of this first-year analyst revolt, as I call it, is really the TMT group. So that's tech,
technology,
media, and telecom. Yeah. And that's sort of, as you would think, the epicenter of this IPO frenzy.
Well, it makes me wonder, too, though, how much of that old system is still relevant? Do they need to revamp it? Because, I mean, programmers in Silicon Valley don't get treated like this. I mean, the work is hard, but, you know, there's a little more pampering that might happen in Facebook or at Google, at least during normal times. I mean, is this necessary, or is it some throwback to, like, fraternity culture that just filtered through to the banks?
Perhaps a little bit more of the latter. I think you're getting to a really good point, John, which is that some of this is just momentum from the way things have always been done. And particularly if you're a first-year analyst with Goldman out sitting on the West Coast on this TMT team, and, you know, you are in a culture where VC money is free-flowing, you can go to a startup and, you know, spend some of your day playing foosball or paddleball or whatever. You know, it certainly feels as though, you know, and you're sitting in this spot waiting for emails to come in from New York or from Asia. You know, if you're this first-year analyst, it certainly feels unnecessary. And I think the real difference is it's always been that way. But, you know, now that Goldman Sachs has a CEO who's on social media and who leads by example by being on social media, you know, it's harder for them to say, you know, okay, we can't really, you know, we can have our CEO on social media and on Instagram, and yet, you know, when people complain, it eventually leaks onto Instagram that we can ignore it. You know, they know they can't do that, and so hopefully they've been working towards making their lives better.
Hugh, I would never say things should exist because that's the way they've always existed. I'm just curious, though, what is the internal reaction to this? I would imagine there are plenty of people at Goldman Sachs who rose through the ranks, who went through that meat grinder, survived it, came out of the other side, making a huge paycheck now, saying, you know what? That's the price you pay to be at Goldman Sachs and to get to the next level. And these guys are just being too soft.
That's certainly, you know, look, I've reached out to people, and if you're in a certain cohort, if you're in your 40s or 50s, certainly, and you are maybe at the peak of your career on Wall Street, this is how you rose. You rose through the meat grinder, as you say, Melissa, and it's, you know, it is just a part of the process. And, you know, like a fraternity, you know, they pass that on year after year. You know, I think it's reverberated certainly through Goldman. They hear it. Look, the quotes that John read at the start of this segment, if you take them on face value, you really have to, you have to be hearing that people are potentially risking their health. And, you know, as we talked about it, February was an incredible year, an incredible month. It's almost equivalent to a real full year in SPAC activity. And so there is some element of this, which is just an incredible frenzy, perhaps a misallocation of bodies in areas that needed it, that they need to adjust. And hopefully they can, you know, through a combination of moving people around and just, you know, doing things more sensibly, just relieve the pressure on these poor people.
Yeah. Yeah. And in this economy, talent still has options. Hugh-san, thank you.
Thank you, John.
We did get a statement from Goldman on this. It reads in part, we recognize that our people are very busy because business is strong and volumes are at historic levels. A year into COVID, people are understandably stretched pretty thin, and that's why we are listening to their concerns and taking multiple steps to address them.
And speaking of SPACs, check out Lordstown Motors hitting the skids today. The stock is down another 10%, now down 30% in March after a probe from the SEC. We'll hear the shocking comments from the CEO next. And March is Women's History Month, and we are spotlighting some of our CNBC contributors. Here's Loop Capital Markets President Courtney Gibson on getting more women in leadership roles.
In the U.S., more than 50% of the college-educated labor force is made up of women, yet women still only hold 25% of leadership roles, and less than 5% hold the title of CEO. As leaders, we all need to demonstrate that this is a business priority by not only what we say, but what we do, what we measure, and how we lead.
Shares of Lordstown Motors down more than 10% today, 11% right now, after confirming an SEC inquiry into the company following a short seller report from Hindenburg Research. Hindenburg saying it believed the EV maker misled investors about demand and about its production capabilities, calling Lordstown's claim that it's got 100,000 pre-orders fictitious. Here's what Lordstown CEO told Phil LeBeau today about those pre-orders.
We queried them. We have very robust interest. And that's just what they are. They're letters of interest. You can't do any more of that in this stage. So I don't think anybody thought that we had actual orders, right? That's just not the nature of this business.
The company is saying it is cooperating with the SEC. It expects to begin production of its electric truck in September as scheduled. Shares are down more than 40% in the past month during the time in which the Hindenburg Research report was released. John.
Yeah, not everybody can be Tesla. Lordstown, just one of many companies trying to capitalize on growing demand for electric vehicles, but some people still love those loud, gas-guzzling supercars. So is the road big enough for both? Robert Frank joins us with the latest numbers from Lamborghini. Robert?
John, Lamborghini out with its results this morning. Record profits in 2020, over 7,400 cars delivered last year. That despite the fact that they had to shut down the factory for 2 months during COVID. All the supercar makers right now going gangbusters in this global wealth boom. You look at prices, shares of Ferrari up 50% just this year. But the big question hanging over all these cars and their profits is what their future looks like in an EV world. Lamborghini does not have a single electric vehicle in its lineup, and its CEO told me that that shift to electric is going to be a big challenge.
At the end of the day, we have to look forward to what is going to happen in 5 to 10 years from now, and how this will change our way of looking at these type of cars. And we have to anticipate also a change of mind of our customers and the enthusiasts.
Now, what Lamborghini does have is this. It's its first ever hybrid called the Sion. It is the most powerful, fastest Lamborghini ever produced. And the reason is because in addition to the classic V12 engine, it's got a lithium-ion supercapacitor that charges and releases energy faster than a battery, which means this car goes 0 to 60 in under 2.8 seconds. But guys, it'll also cost you, this car's starting price is $3.6 million. And John and Melissa, I know you're about to order one, but sorry, it is already sold out.
Well, Robert,
back to you.
I mean, is that your living room? It doesn't quite look like, they actually let you out of the house to do this? That's great. That's got to be a bullish sign. But I got to ask, like, does everything have to be electric, or are these supercars, are they like watches? Like, maybe people don't really want all of the Lamborghinis to be silent and electric.
It's the law, John, and it's going to be the law. You look at California, you look at Europe. The challenge is, yes, people love these cars. They love the sound. They love the roar. They love that sort of feel of a classic engine. But the laws are changing, and that's why Lamborghini and all these companies are going to have to change and put in a lot of money into R&D to something that, at least right now, their customers don't want, but eventually they will. And, you know, you look at Teslas, those 0 to 60 in under 2 seconds. This is the fastest Lamborghini at 2.8. How do you compete? And so that's going to be the challenge. The world is changing, whether some people like it or not.
All right. Robert, thank you. Robert Frank. Ahead on Power Lunch, we're watching the markets. The Nasdaq is down at the lows of the session here, while the Nasdaq has given up the bulk of its gains. We are watching oil as well, sinking into the close. We'll have much more on that straight ahead. And Shake Shack is going digital. The burger chain launching a delivery service with Uber Eats. The CEO will join us next. And a professional basketball league for high schoolers, Digital Sports Network Overtime, paying players $100,000. We got all this when Power Lunch returns.
Welcome back. I'm Rahel Solomon, and here is your CNBC COVID update at this hour. One region in Germany will resume using AstraZeneca's vaccine now that Europe's drug regulator deemed it safe and effective. Meanwhile, 4 million doses of that vaccine will be shipped from the U.S. to neighboring Canada and Mexico as part of a loan agreement. Dr. Anthony Fauci pushing back against Senator Rand Paul's claim that people are no longer at risk of COVID-19 after recovering from the disease or being vaccinated. During a heated exchange earlier today, Fauci told Paul, quote, "I totally disagree with you."
What studies do you have that people that have had the vaccine or have had the infection are spreading the infection? If we're not spreading the infection, isn't it just theater?
No, it's
you had
not.
The vaccine and you're wearing 2 masks. Isn't that theater?
No, that's not. Here we go again with the theater.
And starting April 12th, all Illinois residents outside of Chicago will be eligible to receive the COVID vaccine as long as they are 16 or older. Now, Chicago receives a separate allocation than the state and currently has a lower supply, so that's the difference there. John, I'll send it back to you.
All right, Rahel, thank you. Let's take a look at the market. The Dow was up 200 points, hitting an all-time high, and now it has given up all of those gains. The NASDAQ sinking. It is at the lows of the session, down 2.25%. You can check out some of the laggards. Tesla down 5%. Peloton, Zoom Video, both down 4%. And oil is sinking as the commodity is closing for the day. Let's go to Dominic Chu again at the CNBC Commodity Desk. Dom?
John, a confluence of factors here, a higher value of the U.S. dollar that always hits commodity prices. You had some more bearish inventory data earlier on this week, and the International Energy Agency saying that their world is amply supplied with oil, doesn't expect maybe a super cycle for prices. All of that hitting WTI crude off 7% right now, $59.58. ICE World Brent crude futures, $62.81, off 8%. Gasoline also taking a hit, and energy stocks, the worst performers by a wide margin so far today. If you take a look at some of the action within the cross currents of this particular market, take a look at what's happening with crude, of course, over the last year. Negative prices at one point, a big move higher over the last year, so giving up those gains today on some of those headlines for sure. On the energy stock side of things, check out what's happening overall with some of these really laggards in the energy sector. Occidental Petroleum is off 6%, Marathon off 6%, Valero off 5%, and oil major Chevron outperforming, if you will, only down about 2.5% at this stage here. And remember, over the course of the past year, to put some of these moves in context, remember that the energy sector spider, ticker XLE, has more than doubled over the last year. Meanwhile, Diamondback Energy is up 400%, and ExxonMobil on the oil majors up 73%. So keep an eye on energy, a real outperformer, Melissa, giving back a lot of those gains today. Back over to you.
Yep. Dom, thanks.
Sure.
Shares of Shake Shack down about 3% today, but it is up more than 250% in the last year on surging digital sales amid the pandemic. The burger chain adding 2 million new customers to its digital channels in 2020, with digital sales making up nearly 60% of total sales in the fourth quarter. And it's looking to expand that growth, announcing it is partnering with Uber Eats on a new delivery service within the Shake Shack app. Kate Rogers joins us now with Shake Shack CEO Randy Garutti. Kate.
Melissa, thanks so much. And Randy, thanks for being here. Great to see you.
Good afternoon, Kate. Great to be with you.
So Melissa just ran through, you are launching this in-app delivery service in partnership with Uber Eats. You also work with all of the major delivery aggregators. Why was it important for the company to bring this in-house?
Well, you know, it's been quite a year, obviously, right? It's a lot more fun this week, finally flipping the switch on what this year has brought. A year ago today, our business was probably 20% digital, 80% in person. And overnight, that flipped to 80-20. And today we're about 60. And it's all about what we're calling Shack Track. You know, for a long time, Kate, Shake Shack has really been known as the great burger experience, coming together with human beings. We love that, and we can't wait to get back to that. But we also know we haven't been terribly convenient. And launching delivery as a service in our own app today, great partnerships throughout Shack Track, our other third-party delivery, and new ways to add convenience to what has always been that great Shack experience is really the path we're headed on today. And it's really been an acceleration and amplification of the evolution of our brand, which has been incredibly exciting, and really the thing that has kept us on track, regaining momentum every month since the pandemic started.
And Randy, you mentioned Shack Track, which is, of course, your digital fulfillment service. It's something that you think will be a part of the company's business, even as people return to eat on premise. How will that work?
Well, we believe that people are going to come back. You know, I'm here in New York, and every day we're seeing things get a little bit better in New York City and great urban centers. There's no doubt that's going to take some time, but we believe people will gather again. But what's been amazing this year is how many people have said, you know what, I want to use your channels. I want to pre-order. I want to get it there at Shack Track. Pick it up outside, convenient. We'll even do it a curbside delivery for you. And later this year, we're going to open our first ever drive-thrus, which we're really excited about. And it's all about really just adding that digital convenience. Our digital sales this year are up 3.5 times just on our own channels, not including delivery channels in the last year. As you said earlier, we've got 2 million new guests using those channels. And I think what we're aiming towards is having people get out all the friction of what was hard before, ordering and paying and kind of the annoying stuff of the restaurant legacy experience, but still be able to be there with friends, come together, or take it to go, get home with your family, or back to the office, or wherever you're headed. It's a game changer for us. We're really excited to keep building this out and keep showing our guests the easier ways they can use Shake Shack.
Randy, it's Melissa. I wanted to ask you about what analysts are concerned about, and they're calling margin headwinds. And when you reported your quarter at the end of February, you talked about near-term increases in cost of goods sold, whether it be packaging costs or labor costs. How are you thinking about these costs? Are you passing them on to the consumer? And how limited do you think they are in nature in terms of time? Are they really near-term, or are they for the rest of the year? Because inflation, that is really the focus of the markets these days.
Yeah, Melissa, it's year 20 for Shake Shack, and that's for good reason. Everything we do with a long-term lens. We took just about 2% price this year. We probably could have taken a lot more, but we've been very conservative about that for a long time. We're actually testing on third-party delivery, a 5% raise on prices within those, which is part of why this delivery through our own app is now going to be set at the same in-Shack prices. So the best value will happen in our channels every day. I think there's going to continue to be margin pressure. Look, delivery is an expensive business. There's part of living with COVID and working through COVID that it remains expensive and will for some time. But I'm really proud of our team. You know, as we announced in the fourth quarter, we've regained nearly 3/4 of our profitability, and we have not come close to regaining our sales. Every day that's got a little better. You saw, we announced we had a really strong January, a little bit harder February with all the storms and everything that we saw. But you can feel spring coming. You can feel vaccines getting out there. You can feel people moving about the country. Certain Shacks, you can start to see them pop a little bit from time to time. Weather's getting people in a good mood. So, you know, we're hopeful for what will be a better summer. We've got a long way to recover yet. But I think these tools are what's going to set Shake Shack for the long term. Just giving people, you know, I think all of this sums up to putting the power back in the guest's hands. You know, however you want it, whenever you want it, wherever you want it, you can get your Shack. And that's what we've been trying to build for this last few years, and it's really come to fruition now.
Randy, quick last question from me here. We know the suburban Shacks were outperforming the urban-based Shacks. You told me you want to be everywhere. Which market do you see as the bigger potential for growth in the future for the brand?
Okay, we want to do it all. You know, next week we're going to open in the heart of Midtown near Bryant Park. That'll be our first New York City Shack. We believe in urban right now. I think there's going to be an urban renewal to a point that'll be super exciting. But we also have learned a lot about our suburban Shacks, which represent about half the company, that have done quite well. You know, we've shared that those have recovered much more quickly. We expect that to continue. And I think our suburban business will be really buoyed by these new formats where you can really get there with a lot more ease. Our first few drive-thrus will be in Orlando. We're going to do one in Kansas City and suburban Minneapolis. We're going to learn a lot through that. And when you think about what is all that after, it's about increasing the addressable market opportunity for Shake Shack over the long term. We think all these tools, all these formats are going to meet people where they are, but continue to be, you know, we fully expect New York City Shacks and those urban brands where we come together to be busy once again soon. We're looking forward to it.
Great. We look forward to it as well. Randy Garutti, the Shake Shack CEO, thank you so much for joining us today.
Thanks, Kate.
And thank you, Kate, as well. And now let's check out the Dow turning lower, now down about 100 points. The Nasdaq sinking to the lows of the session. You can see it there, down 2.5% almost. Plus, we are watching shares of Nike as it is getting ready to report earnings after the bell. We're going to have more on that and the markets coming up on Power Lunch.
Stock sinking to the lows of the session. Let's get to Bob Pisani for more on what is driving this action. Bob.
You know, Melissa, a lot of this looks technical to me. Remember, we're in a paradigm shift this week from COVID being the primary worry for the markets to now interest rate rises being the primary worry. And that's creating a lot of moving around in stocks. So when I say it's technical here, 39.45 about a half an hour ago was the lows of earlier this morning. When we hit that level, there was a volume spike in all of the ETFs that trade a lot, like SPY, and we just took another leg down. I think a lot of intraday traders were sort of involved here and said, we're not going to be rallying at this point, so we might as well just essentially get out. I want to show you some of the tech stocks, the big tech names. I follow semis and mega cap as a sort of general area for where the mega cap tech is going, and you can see sort of weakness here. Surprisingly, most of these big cap tech names were flattish on the week. There was not huge selling. This is one of the first times this week we're seeing some notable sellings that's going on. What we are seeing selling this week is in that thematic tech ETF area. Investors love putting money into thematic tech. I'm talking about ARC funds. I'm talking about cloud computing, clean energy funds, cloud computing ETFs. Investors think along these lines, and when they start thinking, I'm going to not put as much money into certain areas, it's in these thematic tech areas that they tend to go into very quickly. And these have all been weak throughout the week, and they're especially weak today. Energy, oil has essentially stopped at 65 and has come down from there. It's down again today. So there's a little bit of game out there that this is the top for the energy play. It's had an incredible run. It's been the market leader all throughout the year. But there are some people trying to bet that this might be the top in energy for the year. That's a very hard game to play. Remember, it's only 3 to 4% of the S&P 500. I'll note the banks here still holding up very well. A lot of new highs in the banks. Of course, that's the interest rate. And the reopening trade in general still doing very, very well. So just a lot of confusing trading this week as the essential narrative, COVID, switches to interest rates. And that's got a lot of people trying to figure out where we should go next.
Yeah, it's
Melissa,
interesting to see financials hold up with the 2s10 spread. It's actually the widest since 2015, so maybe no surprise at all. Bob, I'm wondering, going back to the idea of the thematic ETFs selling off, there's a lot of overlap in a lot of these ETFs. There's overlap with the NASDAQ 100. There's an overlap with the types of people who invest in these ETFs and the types of people who invest individually in the stocks underlying them as well. Are we at a point now, you think, where we're in sort of a vicious cycle where selling begets selling? We saw this a long time ago with the biotechs and the biotech ETFs, and it feels almost like here we're seeing that again when people are getting out of tech stocks. It's triggering more selling in these with these ETFs with those stocks as components, and with a lot of these ETFs that overlap in components.
Yes, you can get the ETF tail wagging the dog. That is, investors don't so much, I'm going to buy Micron, I'm going to buy the ETF associated with semiconductors. And if you really look at the volumes in terms of overall stock trading, you'll see that's the case. ETF volumes, it varies, but it could be 30 to 40% of overall volume that you're getting. So yes, there is a component of the tail wagging the dog, but don't kid yourself. Ultimately, at some point, values matter. And investors have been pushing up any kind of thematic tech, particularly clean energy tech, for 8 months now.
Right.
And it's at some point, people will just say, I'm not sure that these prices really reflect any future value.
Hey, Bob, you watching the VIX today? It's quite a little spike there, now above 21. Is that something to keep an eye on?
I wouldn't worry about a VIX over 21 at this point. In fact, I'm rather surprised, given the quick spike down, it's not 24 or 25. No, I wouldn't worry about that right now. I think what we're seeing is a really beautiful little rotation, and there's a little bit of a question about value in big tech. Trading desks are telling me, you know what I'm hearing, Bob? People want big tech with multiples under 30, guys, and that's a lot of big tech ain't there.
Yeah, not really close. All right, Bob, thank you. And we're going to have more on the markets right after this quick break.
Welcome back. Nike out with earnings after the bell. The company emerged as a powerhouse in e-commerce during the pandemic. Digital sales climbing more than 80% in the 3 months to November. Can Nike continue to deliver in its recent quarter? The Trading Nation team today is Matt Maley and Miller Tabak, Nancy Tengler of Laffer Tengler Investments. Nancy, this has been a big winner in 2020, but can it continue to outperform in an environment where the economy is reopening and consumers could potentially pivot away from athleisure?
That's the question, Seema. It's the perfect question. I think that, the margins in this company have been improving. The sales and demand in China has been solid. And so one of the things that we'll be watching is, will the margins continue? How is e-commerce doing? Nike Direct was up 30%, driven by the Nike Digital that you cited at 80% last quarter, and overall the company was growing at about 9%. So for us, it's a bit lofty at a multiple of 47 times 21 earnings and a relative price to sales ratio near historic highs. But the flip side of that, it's in the sweet spot of where robust consumer, well-heeled consumer meets digital. So we'll be watching closely on pullbacks. It becomes more interesting, but I wouldn't be chasing it here as you mentioned, it's up over 100% on a trailing 1 year basis.
Matt, Nancy mentioned valuation. Is that a concern for you, trading at 143 a share here?
Yes, it is. I mean, it's the stock is expensive on a PE basis, price earnings, and also on a price to sales, more importantly. However, I got to admit, on a technical basis, it does have some potential here. I mean, the stock, if you look at the chart, it's bumping, or it has bumped up against the 147 level, right around in that area, 4 different times. This is the 4th time, actually, that it's bumped up against that level. So if its earnings report can be a catalyst for a further upside movement, that'll give it a nice higher high, and the stock should see another leg higher. And the reason why I highlight that is that even though the stock is not oversold, it's kind of in a neutral area, maybe slightly above, but it's not overbought, and certainly not as overbought as it has been at recent highs in the last couple of years. So it's kind of a key technical juncture right now. A break above 147 and it'll run, but wait for that move.
And shares are trading down 1% right now. Matt and Nancy, thank you. And we also break down the big moves for banks online. John, I'll send it back to you.
All right, Seema, I'll take it. Thanks so much, Seema Modi. And just taking a check on the markets, we had taken a leg lower here, so we're watching very closely as we enter the close here with rising rates really having an impact, particularly on the tech trade here. The S&P 500 down by about 0.9% right now, but of course it is the NASDAQ which is really feeling the pain, John, and the high valuation stocks are the ones.
Yeah, some of the ones that have run amazingly, most amazingly over the past 12 months. I'm looking at Twilio, Square, Snap. They're suffering the most today. And even a name like Roblox, which just went public at kind of a crazy valuation, maybe down 8%.
Yeah, even in not so high valuation stocks like an Apple's down more than 8% this year at this point. But I was taking a look at 2 stocks which really sort of, I think they're really at the cross-section of the markets right now. General Electric and Netflix. General Electric, the outperformer, as we've seen this rotation into industrials in anticipation of the reopening of the economy. It's up 24% this year. Netflix is down for the year. But take a look at their forward PEs. They're very similar. So at this point in time, you're reaching this critical decision in the marketplace. Is it worth it still to buy General Electric at this price? Because we've seen that strong rotation into industrials. Have we pulled forward a lot of that? Or does this rotation continue as interest rates keep going higher, hitting tech stocks? So I think that sort of captures it all in terms of the dilemma.
Interesting bets on a day like this. I like to look at what's bucking the trend.
Yeah.
And then in tech stocks or, connected to tech, Verizon, Oracle, IBM, Viacom, right? So a little media, a little old database, that's what's higher.
That's a motley crew of stocks, that's for sure. John, it's been fun.
Yeah.
All right. Thank you all for watching Power Lunch. Closing bell starts right now.
Our thanks to the great John Ford and the great Melissa Lee. Welcome to the Closing Bell, everyone. I'm Wilfred Frost, along with Sarah Eisen. A rates-led divergence in the market today. Dow almost flat, NASDAQ sharply lower. Let's have a look at what is driving the action. A Fed hangover. A spike in bond yields is once again fueling a sell-off. And tech, Apple down 2%, Tesla down 5%. On the other side, we're seeing a rally in bank stocks, value outperforming growth, but energy is down big. Actually, the worst performing sector as we speak. And jobless claims came in a bit worse, than expected, but some reopening plays in retail, entertainment, industrials are holding up all right today. 59 minutes left in the session. We are down 2.4% on the NASDAQ, Sarah.
Anything higher on the S&P and Dow would be a record. Looks like we're losing momentum. Coming up on today's show, Signet Jewelers has been a surprise winner over the past year, up more than 700% from the lows and jumping today on earnings. We're going to ask the company's CEO if the return of in-person weddings and the flood of stimulus checks will drive more upside. Plus, are people ready to go back to gyms? We're going to get a read on how consumers are feeling when we speak with the CEO of Planet Fitness, another reopening play. And some big earnings coming after the bell, including FedEx. We'll bring you those numbers and instant analysis as soon as they hit, as well as Nike, the Dow component. Let's focus, though, on the big stories we are watching today in this final hour of trade. Mike Santoli tracking the market action and joining us to break down today's big pop in Treasury yield, which is driving everything. Kathy Jones from Charles Schwab. But Mike, set the stage for us on stocks.
Yeah, so, we mentioned yesterday sometimes there's a little bit of a reassessment on the day after, the morning after a Fed meeting. And today, obviously, the fact that Jay Powell said long yields have to kind of do what they're going to do, and we're just going to worry about the short end and the asset purchases, obviously testing the tolerance of equity investors, especially growth investors. And that rotation was disturbed by that sloppy trading in energy, I would argue, too. It's why some of the value has not held up. So here you go. We're sort of going back to last month's highs. We're kind of kicking around that area for a while, the mid 3900s. That's been something of a pattern for the last several months. We have these testing periods that go back. So we'll see if the S&P as a whole can kind of hold together. Take a look at the 30-year Treasury yield over the last 2 years. We always look at the 10-year for good measure, but basically hitting 2.5% earlier today. As you can see, we've been here before, but it has been a while. And there's also a little bit of a significant area right there where you kind of broke down going back into the latter part of 2019. That's when the yield curve was flattening. So you haven't seen it in a while. We've gotten a big move in a short period of time. And if you want to look at equity valuations relative to the 30-year Treasury, this is based on forward earnings. This is the so-called equity risk premium that people sometimes use to sort of figure out if stocks or bonds look more attractive. I think we have this chart in here. It basically has gotten compressed, and it's the lowest level, meaning the smallest cushion of equity valuation versus bond yields that we've seen since basically the year 2000. We've been in this low range, or at least since the global financial crisis. But there's nothing magic about the absolute number here because, look, we spent the entire of the 90s below that. In other words, with stocks more expensive versus bonds. So I think it's more psychological. It's more about the trade-offs. It's more about whether you want to rebalance out of equities and into fixed income. But clearly, you're kind of stretching the valuation regime that we've been in for something like 12 years now, guys.
It's a really good chart. Mike, I do think we have to home in on energy. Worst performing sector. Crude oil, WTI is down almost 8% right now. You've got a stronger dollar, I guess. What else is dragging the price of oil lower?
As far as I can tell, first of all, crude oil, just the price, just on the chart, was more extended than it has been in 22 years in terms of just how far it came in a short amount of time. So you're giving back some of that. I don't know if you also have a rates effect here. I don't see why you necessarily would, except that there are leveraged players all over the place. But it seems right now that it's a little bit, it's a risk asset. I mean, let's be honest. It has traded like a risk asset, and you're seeing some of that just cool down today. I don't really think this is about a growth reassessment for demand. It's much more about the market mechanics.
Impressive to see gold and silver hold up today in light of that and a stronger US dollar. Mike, thank you. Lots more to come, of course, on the equity market picture throughout the final hour with Mike. We are down a full % on the S&P now, and the Dow is negative, accompanying the NASDAQ. Let's talk more, though, about bonds and yields and bring in Kathy Jones, Chief Fixed Income Strategist at Charles Schwab. Good to see you, Kathy. Thanks for joining us. So let's go short term, first of all, if we can. And this latest leg up for bond yields to 172 on the 10-year, as Mike was pointing out. Is that all because of the Fed, or are there international factors playing into this over the last day or two?
Well, I think there's a combination of things, but one of the big things that happened overnight when we sort of saw yields trip up pretty quickly past the 170 level was that we got rumors out of Japan that the Bank of Japan may be cutting back on its ETF purchases and widening the band for its bond, where it will allow bond yields to go. And that could have triggered some selling in treasuries as investors there decided to raise some cash. So the timing of it certainly looks like it's consistent with when that talk came out. And we saw like an 8 or 9 basis point move in a very short period of time. So I think that contributed. along with maybe whoever was positioned the wrong way at the end of the day, the international accounts coming in and deciding to square up their positions.
And what is your expectation from here, Kathy? Do we continue to march higher, closer to 2%, for example, on the 10-year? And what are the key factors that will drive that? Is it purely the fundamentals, or will technical factors start to take hold?
Well, I think the direction of travel is towards 2%. We came into the year expecting 1.6 on the 10-year, but we underestimated the amount of fiscal stimulus that we would get. We thought it would be less than $1 trillion, and here we're almost at $2 trillion. And of course, the reopening of the economy has been faster because the vaccinations have rolled out faster. So 2% seems like a reasonable target on the upside. I do think we've gone an awful long way in a short period of time. Some consolidation seems likely. But what we really don't expect is to see much action from the Fed to offset this. So real growth is up. Real rates are up. We've come from 50 basis points at the trough of the pandemic to 175-ish. Although that's a big move, think about how much the economy's improved in that period of time. So to us, it's mostly about it's partly about positioning and hedging and all those things, but it's also really a reflection of the economy shifting gears very fast.
But if it continues at this rate and we start to see a sharper slide in equities in the NASDAQ and it becomes what the Fed would deem disorderly, Kathy, what would that look like? How fast? It seems like the levels aren't the concern here. It's the speed at the moves and what that does to overall financial conditions, which the Fed has to be taking note of.
Yeah, absolutely. And I think Jay Powell mentioned financial conditions a couple of times yesterday in response to questions. So the key there is credit spreads, right? So what the Fed really wants to do with financial conditions is make sure that companies, individuals, whoever is borrowing money has access to capital at a reasonable price. And so what we're seeing is credit spreads are still low. So anybody who wants to borrow money in the capital markets isn't having too much trouble. If you want to refinance your mortgage, you're not having too much trouble. If you want to get an auto loan, you're not having trouble getting it. Yeah, the rate's up a little bit from where it was 6 weeks ago, but the capital's available. So unless we see tightening in those financial conditions and access to capital being reduced, I don't think the Fed will step in.
What's the outlook for the dollar from here, Kathy?
Yeah, I'm more in the camp that there's room for it to go down than up. People have made a big deal about the rebound in the dollar, but you think about it, we came from down 15% on a trade-weighted basis to up 4 or 5%. That's not a lot. If the Fed continues to keep a really, really easy policy and we see any improvement in what's going on in Europe in terms of the vaccine rollout, and stabilization in EM, I think the dollar can actually drift a bit lower from here.
Just in terms of the message for the bond market, Kathy, I know obviously higher growth is something that everyone, including the Fed, welcomes. But a day after Fed Chair Powell said, we're not looking to talk about tapering, not yet, not talking about higher interest rates, not talking about liftoff. Is the market testing the Fed here? Is it sending a message that we don't believe you?
Well, it is interesting. I mean, this is the new world, and I think the market's having trouble adjusting to the Fed's reaction function. The Fed believes that they can keep rates low for a long time, even with all this stimulus going into the economy, and not really ignite long-term inflation. And that is completely upside down from what most of us have lived with for the last 30 or 40 years. And I think the market's having a lot of trouble adjusting to that proposition. We'll see who wins here. And I do think the move up in yields will be self-limiting because at some point it'll hit other asset classes enough probably to slow things down. But I think the market's got to get used to the new Fed. It is a different world.
Kathy Jones, thank you for joining us. Story of the day, 10-year note yield, 171, got as high as 175. Thank you. Much more on the market straight ahead. And after the break, shiny returns. Shares of Signet Jewelers have climbed more than 700% from last year's lows. The stock is jumping today on the back of strong earnings. We'll talk to the CEO about how to keep up the momentum. You're watching Closing Bell on CNBC. Dow's down 39 points. NASDAQ down more than 2%.
Welcome back. Rising rates hitting tech stocks hard today. Here's a check on the NASDAQ heat map for you. Pretty much at session lows for the NASDAQ. Also at session lows for energy, though financials still hold on to more than 1% of gains. But the NASDAQ comp is down 2.5%. Oil's down 8%. The energy sector within the S&P down nearly 4%, Sarah, with, 45 minutes or so left.
Shares of Signet Jewelers Wilfred higher today following earnings just before the bell. Along with a beat on the top and bottom lines, the company also reported better than expected same-store sales and offered very strong guidance for the year ahead. Today's gains come on top of a huge rally, the stock skyrocketing more than 700% in the last year. Joining us now for a closing bell exclusive is Signet Jewelers CEO Gina Drosos. Gina, great to have you back on the show. Welcome.
Good to see you, Sarah.
So the numbers were a beat and the outlook was very strong, double-digit growth expected. Where's all this demand coming from?
Well, I think the jewelry category in general has been an important one to customers during COVID. I think everyone has taken stock of what's most important to them and wants to express that. And of course, that's what our products allow people to do, is to celebrate life and express their love to those who matter. We've been very active in helping our customers do that in new ways. With targeted marketing, we're reaching new customers that we couldn't before. It's a very data-driven approach, and we've launched a lot of new capabilities on our websites, from conversational messaging to virtual try-on. We're connecting those now to flexible fulfillment with buy online, pick up in store. So I think in a time when there hasn't been as much to celebrate, customers have been able to find those opportunities with us.
E-commerce sales spiking 71%. So that's proof of the strategy right there. How does it change the way, Gina, you think about the business going forward, and how much of that is going to come from online and how much from stores, as you are in the process of closing a lot of those stores?
Well, I think we can continue to grow our business online. I was very pleased to see that in the third and fourth quarter, even after our stores reopened, we still saw e-commerce growth north of 60%. That's a real testament not only to the e-commerce capabilities that we've built, but to our store teams. They've done a terrific job creating what we're now calling connected commerce. I mean, really making these technologies make a difference to customers, whether they're shopping online or in our stores. So I couldn't be more appreciative to our Signet team. They've learned new things in a very agile and flexible way, and they're bringing new experiences to customers. We are continuing to optimize our store footprint. We've significantly reduced our exposure to lower traffic malls. We're more off mall. We're seeing better sales transference when we close a store. And that's really, again, this, what I think is an enduring competitive advantage for Signet is a strong store footprint, a very strong banner portfolio, the best experts in the business who are working there. And now we've brought a digital capability to that to connect it all together.
What is the outlook for weddings? You've got a good front row seat on the engagement business. Is there a lot of pent-up demand now that we can hopefully start to have weddings again toward the back half of the year?
Well, engagements have been flat to down. For us, obviously, bridal has been a growing business, so we've been getting a disproportionate amount of that share, and I'm very proud of the team for doing that. I think weddings, or the event itself, yes, certainly there's a lot of pent-up demand for that, and we may see some of that flow into additional engagements as well. We've moved now over a year ago to an always-on marketing approach within our business. So we're talking to customers who are pre-engagement 18 months before they make that decision to get engaged. We can see the signs of what they search online and things like that. So we're able to understand what they're looking for. And now we're seeing some really interesting trends. Colored stones, fancy shapes, and new designers are trending right now in the bridal category.
What about stimulus checks, Jenna? Do you see a direct link there? People spending those checks on jewelry, on your products?
We usually see a benefit from stimulus checks, both as people decide how they're going to spend those, but just also as they're able to meet more of their basic necessities. I think the other potential tailwind, Sarah, in the front half of the year is, and in the next few months, is tax refund checks. Those are behind. They're at least two weeks behind when we would normally see those. So we've seen very strong sales to date in our first quarter. Globally, we're up 16% quarter to date. North America, that's over 20%. I think we could also see that flow through into a strong second quarter. But we're very cautious on the back half of the year as the vaccine rolls out and more people are more interested in traveling and entertainment, things like that. Again, we think that could potentially have a negative impact on categories like jewelry.
Finally, Jen, I wanted to ask about your recent move to increase your minimum wage to $15 per hour for all of your part-time and full-time associates. My question is, why now? Was it because of the Biden administration and the push there for federal minimum wage, or Walmart's move? What factored in?
No, it's because it's the right thing to do. We actually started increasing the minimum wage for our employees during fiscal 2021. So we started with our distribution center workers, our customer care team. Many of our in-store associates already make above a $15 wage. That's because their salaries are based both on a base salary and also a commission. But we felt it was important to elevate everyone. We know that the customer experience can never exceed the employee experience, and we want Signet to be an even better and better place to work.
Jenna Drosos, thank you for joining us. Appreciate it.
Thanks.
Off a strong
quarter.
Thank you, Sarah.
CEO of
Signet.
Thank you.
We have 40 minutes left of the session. We're near the session lows, particularly on those tech and energy stocks, which are the worst performers today. The Nasdaq's down 2.5%. After the break, Lordstown's bumpy road. The EV stock lower on disclosure of an SEC inquiry, and following a newsmaking interview earlier on CNBC, we'll hear what the CEO said that may have spooked investors, down 12% today. As we head to break, check out some of today's top search tickers on CNBC.com. The 10-year yield remains on top, followed by Tesla, Apple, GameStop, and the Nasdaq. We'll be right back.
Another big sell-off at the NASDAQ led by more tech weakness. Higher valuation companies getting pounded today. Here's a look at some of the biggest losers on the NASDAQ today. Okta down 8%, 7%. Tesla right down there, almost 6% lower. Tesla's about 26.7% off its highs. Semiconductors have been dragged into the selling, as well as some big cap tech like Google, Netflix, Nvidia, PayPal, Microsoft, Amazon, all under pressure today. Wilfred, on those rising rates.
Yeah, and small caps, Russell's down 2.3% as well today. Shares of Lordstown Motors are hitting the brakes today after the company said it received an SEC inquiry relating to short seller accusations. Our Phil LeBeau made some news in his interview earlier with the CEO, and he joins us now with some of the key takeaways. Hey, Phil.
Hey, Wilf, the interview that we had this morning with Steve Burns from Lordstown Motors basically focused on a couple of key things. And really the most important is what the company mentioned yesterday during its financials report, that the SEC is looking into claims made by Hindenburg Research that the company's past indications about interest in its first vehicle, what they have termed at times as serious orders. Well, according to Hindenburg, those are fictitious orders. So we put the question to Steve Burns this morning. Are these truly orders or just indications of interest?
We queried them. We have very robust interest, and that's just what they are. They're letters of interest. You can't do any more of that in this stage. So I don't think anybody thought that we had actual orders, right? That's just not the nature of this business.
Maybe the nature of the business in terms of people expressing interest, but they were termed as orders at times by Lordstown Motors in the past, and that's at the heart of this issue. Now the focus is this pickup truck right here. This is the Endurance, an electric pickup truck. They are scheduling production starting in September, and they believe that there is a robust market out there for the Endurance.
So, to find out, would fleets buy an electric pickup truck? What price would they pay? Would they buy it from a new OEM like us? What sort of warranty they're charging? We've gone out and queried fleets and people that talk to fleets, and we have got an unbelievable reception.
Lordstown, along with really all of the EV stocks, under pressure today. And we should point out for Lordstown, just within the last couple of hours, Morgan Stanley analyst Adam Jonas, who really is one of the key analysts that a lot of people follow on the street when it comes to electric vehicle manufacturers, he came out with a note and he has cut the price target on Lordstown from $18 down to $12, citing the fact that they're going to have increased spending on capital expenditures. So a bumpy day, to say the least, for Lordstown Motors. Guys?
Ouch. Phil, thank you. Phil LeBeau. Still to come on the show, earnings from two stocks that have more than doubled over the past year. We'll preview what to watch for from FedEx and Nike in just a few. Plus, shares of Live Nation getting a pop today following an announcement from New York's governor. Those details next. And as we had to break, another check for you on bonds. Center of the action today, yield seeing a big pop. The 10-year note yield climbing to a 14-month high, touching right above 1.75%, off those levels now at 170. We're going to actually, instead of a break, go take you to Washington and the White House, where President Biden has just taken the podium. Let's listen in.
Some even suggested it was somewhat audacious. Experts said that the plan was, quote, definitely aggressive, and distribution would have to be seamless for us to be successful. One headline simply put it, quote, it won't be easy, end of quote. Well, it wasn't. When we took office, there was a lot that had to be done. We needed more vaccines, more vaccinators, more places for people to get vaccinated. And we needed a whole-of-government approach. So I directed Jeff Zients, the coordinator of our COVID-19 response, to put us on a war footing, and I meant that in a literal sense, to get us on track to truly beat this virus. And I'm proud to announce that tomorrow, 58 days into our administration, we will have met my goal of administering 100 million shots to our fellow Americans. That's weeks ahead of schedule, and even with the setbacks we faced during the winter storms. And there's another big step on the path to putting checks in pockets and shots in people's arms. When we cross the 50 million doses, just 3 weeks ago, I told you that every time we hit the 50 million mark, I'd update you on our progress. So here's where we are today. 8 weeks ago, only 8% of seniors, those most vulnerable to COVID-19, had received a vaccination. Today, 65% of people aged 65 or older have received at least one shot, and 36% are fully vaccinated. And that's key, because this is the population that represents 80% of the well over 500,000 COVID-19 deaths that have occurred in America. We have nearly double the amount of vaccine doses that we distribute to states, tribes, and territories each week. We have gone from 1 million shots a day that I promised in December before we were even sworn in to an average of 2.5 million shots a day, outpacing the rest of the world significantly. And here's how we accomplished this. Using the power given to a president under the Defense Production Act, we expedited critical materials in vaccine production, such as equipment, machinery, and supplies. We work with vaccine manufacturers to speed up the delivery of millions more doses and brokered a historic manufacturing partnership between competing companies who put patriotism and public health first. These steps put us on track to have enough vaccine supply for every adult American by the end of May, months earlier than anyone expected. And we stood up or supplied more than 600 community vaccination sites that are administering hundreds of thousands of shots per day. We launched the federal pharmacy program, which has allowed millions of Americans to get a shot at one of 14,000 local pharmacies in this country, the same way they get their flu shot. And for folks who aren't near a pharmacy or mass vaccination center, we've supplied more than 500 mobile clinics, like pop-up sites or vans, meeting people where they are. We deployed nearly 6,000 federal personnel, including FEMA, active duty military, and Department of Health and Human Services to support vaccinations and serve as vaccinators, putting the needle in people's arms. We're also supplying vaccines to community health centers to reach those who have been the hardest hit and suffered the most, especially Black, Latino, Native American, and rural communities. This is really important because we believe that speed and efficiency must be matched with fairness and equity. Now, when President Harris and I took a virtual tour of a vaccination center in Arizona not long ago, one of the nurses on that tour, injecting people, giving vaccinations, said that each shot was like administering a dose of hope. A dose of hope. That's how she phrased it. Behind these 100 million shots are millions of lives changed when people receive that dose of hope. Grandparents can hug their grandchildren again. Frontline workers who can show up at their jobs without the same fear they used to have. Teachers with the confidence to head back into the classroom. These milestones are significant accomplishments, but we have much more to do, much more to do. And the American Rescue Plan will help us do it. In addition to the cash payments it provides to you and your families, it also provides the funds to add vaccinators, to supply more community vaccinations, support more community vaccination centers, and increase testing. It'll help us accelerate nationwide efforts to reopen our schools safely. And as I told the nation last week, I've directed all states, tribes, and territories to make all adults eligible to be vaccinated no later than May the 1st. I'm glad to see that several states are already taking that step to make more and more Americans eligible even before May 1st. Tomorrow, we will hit 100 million doses our administration has administered. But I've always said, that's just the floor. We will not stop until we beat this pandemic. Next week, I will announce our next goal to put shots in arms. This is a time for optimism, but it's not a time for relaxation. I need all Americans, I need all of you to do your part. Wash your hands, stay socially distanced, keep masking up as recommended by the CDC, and get vaccinated when it's your turn. Now's not the time to let down our guard. In the last week, we've seen increases in the number of cases in several states. Scientists have made clear that things may get worse as new variants of this virus spread. Getting vaccinated is the best thing we can do to fight back against these variants. While millions of people are vaccinated, we need millions more to be vaccinated. And again, I need you to get vaccinated when it's your term and you're able to do that. I need your help. I need you to help. Not just the country, but your family, your friends, your neighbors. Get them vaccinated as well. If we keep our guard up, stick together, and stick with the science, we can look forward to a 4th of July that feels a bit more normal, with small groups able to gather for cookouts in backyards, and where we began to declare our independence on Independence Day from the virus. Look, together we're going to come through this stronger, with renewed faith in each other and our government that fulfills its most important function, protecting the American people. Let me be clear again. Wearing this mask in the meantime, making sure you wash your hands, making sure you socially distance, listen to the CDC. We've got to reach the point where we have herd immunity, meaning where we have a vast majority of the American people have been vaccinated before we can stop wearing these. So please, please, don't let what you see happening in Europe and you see on television. Keep the faith. Keep wearing the mask. Keep washing your hands. And keep socially distanced. We're going to beat this. We're way ahead of schedule, but we got a long way to go. So I just wanted to bring you up to date. I thank you very much, and may God bless America. May God protect our troops. Thank you so much.
Mr. President, Vladimir Putin wants open talks. Would you agree to that? Your reaction to the photo of children in the border?
Not stopping for questions there. President Biden, along with Vice President Kamala Harris by his side, giving an update, a progress report on the state of vaccinations in this country, saying we are going to get to his goal of 100 million Americans getting vaccines administered, COVID-19 vaccines, by tomorrow. Let's go to Kayla Tausch, who covers the White House for us, for more reaction, Kayla. That and a plea to stay safe and get vaccinated.
That's right, Sarah. President Biden saying that the U.S. will hit his goal of 100 million vaccines administered since inauguration on day 58 of his presidency. Last week in his primetime address, he said that the U.S. would hit that on day 60, far surpassing his 100-day goal, which some critics said was a low bar to surpass, especially given the glide path that the U.S. was on with regard to vaccine distribution in the early days after inauguration. But nonetheless, President Biden taking a victory lap and saying the U.S. is far ahead of schedule in getting Americans vaccinated, pleading with people who are eligible to go out and get the shot, and suggesting that Americans will be wearing masks until there is herd immunity, which is something that medical professionals have said won't happen until later this fall. Of course, it also comes at a time when, as the U.S. ramps up its own vaccinations, the U.S. has tapped into the federal stockpile to lend 4 million AstraZeneca AstraZeneca vaccines to Canada and Mexico, which have been asking the U.S. for help in this regard and promising to pay the U.S. back later this year when they receive vaccine doses that they have been promised. And today, the White House confirmed that it would, in fact, be doing that, and it is finalizing plans to do so. President Biden again reiterating that he wants to stay on track for that July 4th timeframe for getting Americans back together for backyard gatherings, and saying he will lay out his next benchmark for vaccinations next week. Sarah and Wilf.
Kato, I'll pick it up there. Thanks so much for that. The AstraZeneca vaccine, of course, as well, which was confirmed by the EU today to be safe and effective after a kind of back and forth past week or so. We've got 21 minutes left of the session. Here's where we stand near the session lows, which were hit just moments ago, down 373 at the moment on the NASDAQ, or 2.75%. In fact, that is the new session low as we speak. Up next, Planet Fitness has jumped 200% from the pandemic lows. But how many people are really ready to head back to the gym? We'll ask the company's CEO what he's seeing next. And here's a quick check on the FANG stocks. Big tech hit hard today. Not quite the worst performing sector. That's energy down 4.7%, but tech is down 2.6%. The NASDAQ, of course, the laggard of the major averages. We're back in a couple of minutes. Welcome back. Very quick look at the market. Session lows down now 2.8% on the NASDAQ composite. Even the Dow is now down 140 points, or 0.5%. The S&P is down 1.4%, just under 20 minutes left of the session. Shares of Planet Fitness up 200% over the past 12 months. The company saw memberships plummet in 2020 as gyms were forced to shut down, but now starting to see a comeback. As of January, the company has 13.8 million members, but will the at-home fitness competitors weigh down their recovery? Joining now in an exclusive interview, Chris Rondo, the CEO of Planet Fitness. Good to see you, Chris. Thanks so much for joining us. I mean, clearly you guys had a jump in memberships in January, the start of this year. To what extent is that the bottom over the next couple of years for you versus a kind of New Year's resolution, small-time bounce?
Yeah, it was definitely great, Wilfred. And thanks for having me on. Last year was a troubling year naturally for us and a lot of businesses in the country. And, our franchisees really worked hard throughout that year to stay open. And we've had no closures because of COVID. And it really felt like December was really hitting that final trough of cancellations and the turnaround of us starting to rebuild our members back. And we, for the first month ever, January, we had positive member growth since the time we closed. We reopened our stores, a majority of them anyway, and we added about 300,000 net members in January. So it was great to see us finally have the nose come up and begin to start adding members to our stores. And happy that as of today, we've got only 50 stores closed out of the roughly 2,100 stores in the system, and hopefully those next 50 will be open shortly. So a lot of good momentum going on.
Chris, I'm curious how you are making customers feel safe. What sort of measures you've implemented, how you're doing social distancing. Are you requiring your staff to get vaccines, that sort of stuff?
Sure, yeah, we're not requiring the staff to get vaccines. We are requiring them to wear masks naturally when they're working their shifts, and in our members as well while they're walking around the facilities. And in some states while they're working out if that's required in that state. So we're following local guidelines in that sense. We also put in social distancing guidelines, and we have sanitization stations scattered throughout the fitness centers with paper towels and cleaning solutions. That we have the proper etiquette in our clubs is to clean the equipment before and after every use. And we also implemented a crowd meter in our app, which the members absolutely love. So real time, you can see how busy your club is before you leave the house or work, so that you're able to figure out a time that's more comfortable for you to come in the club. So we've done a lot of digital work in our app. Naturally, while we're closed, there's not much else to do. So we've actually learned a lot through this past year.
Chris, we'll have you back on soon. Thank you for the snapshot. Good to hear about it. Chris Rondeau, the CEO of Planet Fitness. This is the last commercial break we are going to take before the close. Up next, a preview of Nike and FedEx earnings and what's driving oil's sharp snapback down 8%. Those stories and more when we enter the market zone. And take a look at Hartford Financial, up 15% right now, confirming an unsolicited takeover from Chubb. We'll be right back.
All right, guys, let's get a quick update now. Let's see. Sorry, I've been in and out of meetings all this afternoon, and then, of course, taking a lunch break. You guys probably have not gotten to see much of me, just watching CNBC on the screen, but that's okay. Sometimes they might be more entertaining than I am. Anyway, so let's look at the overall market. I know I have been watching it on the sideline while other things are going on. It's just an overall not a great day. NASDAQ especially leading the way downward with another 3% down day, down 3.03%, and it's turned down even farther in the afternoon. I wasn't completely sure what was going to happen today, just because, we have, with what happened yesterday, late yesterday,
12 minutes
what
left
happened
in the
late
trading
yesterday
day.
with the talk from the Treasury. I think there was a little bit of gloom and doom beforehand, and then when they were after he came out and didn't necessarily say there's a bunch of doom and gloom to worry about, that basically don't worry about it, it's going as expected, and we're keeping our inflation goals 2%, and that's actually going well, and inflation's not going to be crazy like some people are suspecting. I think everyone was like surprisingly optimistic, or like breath of fresh air, whatever you want to say. And so things actually looked really good after he spoke yesterday, Jerome Powell, and I think that was surprising to a handful of people. But it didn't last that long. There were a couple of things that looked really good into the after hours yesterday, like TQQQ went up to 95 after hours last night. I think it closed at 91 or 92. It just shot up to 95 after hours last night. And I think everyone was thinking, man, this is going to be a great day. Futures looked up last night, and they looked up this morning pre-market. I think, I had it here on the title and thumbnail that AMC was ready to lift off today, and it absolutely was. Had all the cards fallen in the right direction, it absolutely should have. It absolutely should have. And and then the market opened up, and it's like everyone just went, yeah, but now that we had time to sleep on it, with what Jerome Powell said, we now think it's not all that great. And so we're just gonna sell off everything, and the Treasury yield's gonna go through the roof, and we're just gonna go back to how we were a couple of weeks ago when it was panic, and because the yield went up slightly, so we're gonna panic, and the yields next thing you know they're up 6% to 1.7, and everyone's just saying what the hell just happened? Because it was going super well before that. And I think everyone just was like, all right, time to get out. Everything is overvalued. So this is now like the third very largely negative day, or I guess maybe not largely negative day, but the third very largely negative occasion with the stock market in the past 3 weeks. We had one maybe 3 weeks ago, and then it lasted a couple of days. It was on a Monday and on a Thursday within the same week. That was a disaster week. And then I think we had another instance a week later where I remember like that following Monday, it shot back up. It was like the best day ever in the market. The next day it shut back down. It was the worst day ever in the market. And so that was kind of event number two, and that went downhill. And then last week, and for a decent amount of time, I think the Dow had 7 straight days of positive finishes. For last week and the very early part of this week, it actually was looking great. Things were looking really well. And things were trending up. They had been marching up for about a week and a half. Nothing to really complain that much about. I mean, there's a few stocks here and there, but the overall sentiment of pessimism went away. So the the treasury yield didn't necessarily go down. I mean, maybe it ticked down slightly, but from like 1.6 to 1.5, but it didn't really go down greatly. But everyone's like, all right, I guess we're okay. We're used to this treasury yield being at 1.5 something. Now let's get back to the stock business, and then it went up. And then here we are again. I think there was some fear setting in yesterday morning, some pessimism about what Jerome Powell was going to say. And then I think he surprised a few people on a few of the things he did say. And he comes out today, or he didn't come out today, but I think today, after everyone kind of gathered those thoughts, decided, yeah, now I actually am worried about what Jerome Powell said and what might happen and things like that. So I think that's sort of my take on what we're seeing now and why the Treasury yield went up and why the markets are otherwise down. So we'll see. Sorry about that. But it's tough. Let's see what I don't even know what she's talking about here. Let's turn up the volume a little bit. See what she's talking about. Nike earnings. I'm guessing Nike earnings are today. I mean, I think Nike's a decent stock, decent, great company, but are you investing in Nike after earnings now, after a day like today? I sure as hell am not. Now, let's say Nike puts out its earnings and it'll probably be positive, but like so many other odd things, they'll have positive outlook and then just still tank after their earnings. Then maybe then there might be an opportunity to buy a huge dip. And Nike compounding a terrible day today, where it's down 1.28% today, and then possibly a tank after the market or after the earnings are reported, might be a great opportunity to buy in. You know, if you want to make that bet that it's going to go up based on the quality of the stock and the presence, but also the hopefully the upward swing of discretionary income and things like that, and stimulus income. So Nike might see some good positivity in the future. This may be a good opportunity to buy it super low after the earnings are reported tonight. Maybe a good opportunity to get in on the dip and hold it for a little while until it rises back up once this equity and treasury bond market just kind of stabilizes and quits crazy roller coaster like it has for the past 3 weeks or so. Let's look at these stocks that we have on our board here. It's been a mostly red day, which sucks. Good news is we're seeing here, we got just a few minutes left before the bell. We're seeing a few green signs here at the end of the day, but I think we're too late for a rally. I was super excited about Express early in the day. If you were here, you heard me talking about that. It opened the day at like 4.8, something like that, went up to 5 very quickly, and then it was just shooting up and ended up peaking here at 6.34. Super excited about it. I've been saying for the past week, ever since their earnings report, that this could easily shoot up to $6 or $7 a share. And it finally did. And then now it's just with the rest of the stock market, it's just fizzled out this afternoon. It's just absolutely just fizzled out this afternoon, which sucks. It's making a little bit of a run there. It bottomed out here at 4.88, something like that. It's a little over 5.04 right now. So it's still at a good price, still positive, still up 5% today, but not what it was. It was up 35% at this point earlier today, and it looked like there was an opportunity to keep going up. Despite the rest of the market going down, it was going up. So again, these are meme stocks. They have no correlation to what the actual fundamentals of the market are doing. They are completely on their own trajectory. So sometimes they swing with the market, sometimes they swing opposite of the market, sometimes they swing exactly against the market and in no relation to the market. So that's what we saw from Express this morning. And then it just completely air got let out of it, just like most of the rest of the market here in the afternoon. Tesla is down. Tesla's down to 650 again. That's the lowest it's been in a few days, down 6.7%. I think overall Tesla, I'm very bullish on it in the long term, but at the same time, I do think it's slightly overpriced right now. So if it goes down into the 4s or the 5s, I think it's a great opportunity to buy. But if it stays at and that's why we've seen it go down from the 900 peak down to 650. Not because it's just doing poorly, but just because it was overpriced, and so that's really what we're seeing. There's a little bit of a correction, and it's a correction that's been lasting for like 3 months now. And every now and then it'll peak back up to the 700s, show it's still got some legs, and then it'll fizzle back down. So that happens a lot with Tesla the last maybe 3 months. GameStop down 4.5%. It was up slightly early in like right here in the session, but it's just falling back. Hold on. Sorry about that, guy. I just realized I had muted myself, but didn't turn the volume up on
Are
NASDAQ.
sometimes
So we'll watch closing
duopolies
bell
or
for a few
monopolies.
minutes,
In some cases, I guess
see
we're
what
getting some of that from
happens.
Washington in the coming months.
Market
But
did just
when you
close 5 minutes
have
ago. Sorry, I
a
had to make a phone
sector
call, but
that has on the
uh,
other side of the pandemic,
we'll see what happens here after market. Surprisingly, actually seeing some positive moves from what you guys are seeing here on the board after the bell. AMC's riding up, which is cool. Tesla is on its way up slightly, which is great. Express was on its way up into the bell and looks like it's continuing. Let's zoom in. It's continuing a little bit. Cost has just done nothing this afternoon. Oh, geez. It went from 26 down to 25 and it just hovered there. So screw them. They're doing nothing for me. Come on, man. So I don't know. We'll see. We'll see if I ever get to these sellers or not. I may never. GameStop not doing a whole lot at all today. Down 3%. Nothing crazy, but nothing great. But let's keep an eye on GameStop or AMC. It ended up closing at 14. Still a positive day. But look at it after hours. Just it's going from 14 to 14.2, and it's rising after hours. Not completely sure yet what to make of that. It could just be due to that, the pent up demand that they've had over the past couple of days, and now that the market's closed, sometimes that volume's down, which leads to sometimes some higher gains or losses in volatility. So that could be all it is. Might not actually be increasing in value, but just the volume is so much lower that sometimes those increases and decreases of volatility by dollar amount swings greater. And so we might be seeing that with AMC, and then also we see it down here with Express. So don't necessarily take this to mean that these two are greatly taking off and will spike up after hours, because they very well easily could go right back down to where they were or worse, because of the low amount of volume after hours could make those swings much more dramatic. Let's see. Tesla's going to continue to do the same thing here. Let's zoom in a little bit on GameStop. It looks like it's kind of arced and is going back down. So let's see what some of the big winners and losers from the watch list are today. Just overall, Nasdaq got slaughtered, down 3%, which probably means TQQQ is down 9. It's down 9.18%, down 85. Remember, 85 yesterday after hours, so it's what 11-ish% loss from that peak after hours number. So that really sucks. And it's slightly up after market, but nothing substantial at all there. Same with QQQ. It's down for the session 3% and slightly up after the market. But yeah, I mean, Nasdaq down 3%, Dow down about 0.5%, 153 points, and S&P down 1.5%. Crude oil is going down quite significantly today. It had been trending down for the past 4 or 5 days, and then it just has the bottom falling out of it today. They were talking about it just a few minutes ago here on closing bell, very briefly, about reasons for that decrease, and they're citing some of the demand decreases in Europe due to some newer travel restrictions and such. I'm not sure if that's completely going to change the global price that quickly. There might be more factors to it. I also think one of the factors that could be, which again, I hate these large, very fast gains and losses, but one of the factors I see going into it is because I think that oil has been in a little bit of a bubble. Going back to December, it was in the 40s, and then it so quickly went up to the mid 60s. It went up not just quickly, but it was at its highest price at nearly $68. That's the highest price it's been in more than 2 years. A barrel of oil, the highest price it's been since late 2018. 2.5 years since that little micro recession in late 2018, from October to December 2018. We had a really, really bad correction there. There's not been a gallon of oil, a barrel of oil more than that until now, until just a few days ago when it hit $68, $68 a barrel. That's what's crazy. That is why I think there's a, quite a bit of a bubble, because oil, after it hit that big dip, the big extreme dip where it actually went negative back in April, and really oil's really started tanking back in early March, late February, and then it really bottomed out when the futures expired in April. I think they were June or July futures. They expired in April and it was negative, really weird anomaly. But ever since then, oil then kind of rose up and settled in the mid 40s, or it's kind of between 35 and 42, and it stayed there from May until October. 5 months where oil didn't really do a whole lot. It, it, it was kind of one of these for 5 months. And then since then, when it bottomed out there in, what was it? Let's see. What did I say? Oh, yeah, in October. Sorry, my graph changed there for a second. So it bottomed out there in October, early November. It hit $40 again on November 13th. So this is post-election. November 13th, it hit $40, and which was the same price as it was on June 5th, June 8th. So that was 6 months from June to November, early June to early November, 6 whole months where oil did pretty much nothing, up and down, all the way across, $40 to $40. But since then, it has gone up 60% in a matter of just the last, 4 months. So being completely flat post lockdown to skyrocketing 60% in a matter of 4 months. That I think may be catching up to the oil market a little bit. So it might just be a correction of the extreme a little bit. And it's now the lowest, down below $60, 59.43. It's the lowest it's been in quite a while. Let's see, when did it get below to below 59? It hovered at there beginning of March, but let's see, it was back on February 19th. So February 19th, nearly an entire month ago, was the last time oil was below $60 a barrel. So that's an interesting number. I would not be surprised also this time of the month, the late to mid time of the month, I don't have it in front of me, but that may also be coinciding with the futures expiring. Sometimes those future contracts expire and nothing changes on the price. Sometimes it's a giant inflection point because they've got to liquidate those contracts. But man, let's look at some of the others. I got sidetracked there. VIX volatility index also spiked, not to what it was, a few months back, but spiked today. But let's see, gold is up, gold's down, but it trended up through the day. QQQ and triple Q, both we were down significantly. We talked about that. Really, any of the index funds were down. Tesla's down nearly 7%. Peloton down 4.5%, almost 5%. Zoom down 6% to 316. Zoom is at $316. I mean, it went down to 311 2 weeks ago? That was super low. Should have freaking sold it up to 420 back on in early March. That's killing me because of the stock I own in Zoom. Let's see what else. Ford was looking great early in the day and ended up terribly bad. Norwegian has not had the greatest past couple of weeks, although it's a decent recovery stock in my opinion. It's not had the best couple of weeks. It was down as well. EXPI is getting slaughtered. That is such a highly volatile stock. I think it's a good stock. I like the stock, but it's a tough one, huge swing. Sometimes it's down 10, then it's up 10, then down 10, then it's up. Today was a down 10 day. I guess down actually 14.7% down to 47. They did a split a few weeks ago. It's also one of those that's just been a massive winner of COVID, if you want to call someone a winner of that. In the last year, 1 year ago today, it was selling for $30 a share, and now it's up nearly $50 a share. That's not really what it was because they did a split, but let's say it was in today's money, $3 a share versus $48 a share. So that's a very big difference. So if you got in right now, or if you got in a year ago, you would see a 2,000% return at its peak of what today's money is about $90 a share. But even right now at $47 a share, you'd see a pretty good return. But I think that EXPI is a good one, not just for the real estate business that it's in, but some of the technology holdings that they have is actually really cool. But it bottomed out here at $38 a couple weeks ago, which was, a third of what it was nearly at its peak of 90. So big opportunity there maybe to get in and ride it up into the future. But Snowflake was down. Palantir is down. Palantir is down to 23 again, which is, other than earlier this month, the lowest it's been in a while. Let's see, Blink's down 8%. I don't own anything in Blink, but I have been watching it also for a while. Kodak started the day super well, ended the day super bad. Let's see. Neo down 7%, Bumble down 9%, Churchill Capital down nearly 9%, BlackBerry down 7%, Cost down 7%, Nokia down 8.5%, Riot down 7%. Weird day in the crypto market. Roblox, who I've been looking at Roblox, I've been watching Roblox on the sideline because I knew that at one point it wasn't going to be this super great honeymoon forever after its launch. Usually those IPOs will drift down over time and after the first week, and it really didn't until the last couple of days. It peaked here at 79 a few days ago and is now down to 67. It went down 12% today, so they lost a very large amount of market share just today, considering it's such an early IPO. But that's not completely abnormal for some reason. ARK Invest down nearly 6%. Oh, it's a killer. Man. There's an article here. I'm not going to read the whole article, but just the headline here on Apple Business News, the Business Insider. It says Cathie Wood's ARK ETFs load up on Teladoc despite Amazon's threat. So that might explain also why Teladoc's done pretty poorly the past couple of weeks is Amazon's encroachment into the medical space, which they've been talking about for a while. I've so many good intentions with Amazon stuff, with their intentions of wanting to improve the pharmaceutical business and all those things. But I always wonder what's the underlying business move with Amazon, and I don't mean that in like such a bad way, like Jeff Bezos is trying to take over the world, like some people think. Yeah, that's not really the way I mean that, but I do think he's not just doing everything for all good. He is wanting to make money in these things. So that's kind of how things rounded out today. Just a pretty crappy day. Pretty crappy day all around. The only thing I have on my list that was positive, the only stuff I have on my list that was a good day, relatively good day. Wayfair finished up despite being way down from its early highs. It was up like 6% at some point earlier today, barely finished positive. And Viva Partners finished up slightly. And then AMC and Express, which we've been tracking here on the screen. That's it. That's the only thing that I have tracking or own that was positive today. Everything else was a bloodbath of red. And Alibaba was up 1.3%. Sorry, I missed them. Alibaba up 1.3%, which is not bad. Obviously, I wish it had a better day, but it's not. I only have a few shares of that. So overall, not a great day in the market for my portfolio and most others, especially most others like me that have a lot put into tech stocks. Good news is I did actually get out of some of my oil-related holdings a couple of weeks ago when I saw it peaking around 58, 59. So I didn't hit it at the very, very top, but I still got out at a decent point. And now, like UCO, for example, ETF that tracks the market. I think I got out when it hit 59. It is now tanked back down to 53. After opening the day, it's 62. So that ETF by itself was down 13%. That's a great ETF to be into if you believe the oil market's going up. I got in that back in April and held it for a long time and finally got out of it, sort of doubling my investment. So I rode that bubble up and then I sold it because I just knew it's absolutely bubbling. Another one that I got into early, I kind of got dangerously into it, was XOP, which is oil related, but it tracks the oil producers, not necessarily oil itself, producing companies it's an ETF of. And I got in it very early back in June, but I got in it on a little bit of a pre-bubble back in June. So I actually was down on it for a very long time, for a few months. Good news is it has decent dividend, which I took advantage of. But then I finally sold the majority of that as well back when it was, I think, at $89. And now today it tanked down to 81. So, you know, sometimes you just got to wait for that bubble, sell on the bubble, buy back in when the bubble bursts on some of those stocks that you like. And today was just one of those days. So if you have an opportunity to buy back in on some of these, find the ones that you think have the best fundamentals and the best future ahead of them. Buy back in if you can. Asana was down 8%. I think that's another one that might have a good future to bounce back. Has a market cap of only $4.8 billion, $5 billion. I think Asana's got a good future. Just based on what I know about some of these other companies, I think it's worth more than $5 billion. That's just my take on it. Not really a technical analysis, but just my take on it based on what some of the values are of some of these other stocks. Zoom's down to $92 billion, but I think that's a multi-$100 billion stock or company in the coming years. Roblox, $37 billion. I mean, think about that. This is why I think. Listen, I think Roblox is going to do okay from the standpoint of being an IPO, being a little bit of an IPO darling here. But you can't tell me Roblox is worth $37 billion and Zoom is only worth $92 billion. Zoom should be worth an enormously more amount of money. And you can't tell me this is worth $37 billion and Asana is only worth $4.5 billion. What are we missing? That's why I think something like Asana, who has a very long-term enterprise grade business proposition, is a way better investment. To me, has way better value than someone like Roblox, who I'm not saying they aren't going to make a lot of money, they won't be around for a while, but I just think of enterprise grade business software, I think is going to be a better investment, in my opinion, than what Roblox does with gaming. It's just my opinion. I might be wrong. It's just my opinion. So who knows? Anyway, let's see what we got here on the board. Not tons and tons of stuff going on, but GameStop's slightly up after the market. Express is doing pretty well. It's bounced back up to 5.33. That's good to see. AMC went up to 4.2, and now it's trickled back down to 14.1. So nothing special for AMC. It looks like if anything's going to happen after market, it might be from Express, which is similar. Had a good afternoon yesterday and a good morning this morning. So we might be able to get something good out of Express if everything keeps trending up. So let's watch the market for a few more minutes. Usually we'll sign off around 4, but just considering today's been such a you might even call it a day early. It's not what I want to do to just get up here and showcase the bad stuff. I'd much rather showcase the good stuff. So we might have to save that good stuff for another day. But for now, we'll turn it back over to Closing Bell. Feel free to watch if you like. If you're still here, you're still watching, comment, subscribe, tell me you're here. Give me a like button just to tell me you're here. We are at a total of, how many views have we had today? We're down a little from yesterday. We're at 11 playbacks right now. So not bad. But yesterday we got up to 22. Oh, look, hey, hold on. I've got some comments and I didn't even see these comments. Hell man, Sticky Art, if you're still here, then Let's look at it. I completely forgot. I was looking at Thinkorswim rambling and I wasn't looking at my chat box. So I apologize. EARI. Let's pull them up. EARI. Oh man, hold on. What am I looking at here? Entertainment Arts Research. 0.13, so 13.5 cents. What is up with this chart? Forgive me. It's a very low volume penny stock, it looks like. Let me pull it up on something else. Let me pull it up on Apple, see if it gives me a chart that's slightly easier to read. EARI, there we go. All right, so it's up 21% today, but that doesn't mean a ton to me. So here's the thing. I'll tell you this. Here's my opinion on it. Just looking, I know nothing about the company. I don't believe, I mean, you can absolutely correct me if I'm wrong. This is not the same EA as in the video game company. If it is, then I might be completely off base here because EA, the video company, unless it's a bankruptcy legacy of that company, which I don't think it is, I don't know anything about them. You know, it's a company that has a market cap, an overinflated market cap of only $9 million. And it was, you know, stock is at 13.5 cents right now. Just 2 months ago, it was less than a penny. So think about that. I mean, if let's look at it this way. It's up 2,000% right now from where it was, right? So let's say it's worth, let's say $10 million, right? $10 million. Do my little swift calculation here. 2,000%, $5,000. So a few months ago, this entire company was only worth $5,000. So that should tell you how I really feel about the company. I know nothing about the company. I know nothing about the stock. Looking at just the charts, it's had a hell of a good run in the past 3 months. But I could not tell you what the fundamentals of that run are. If you made money on it, great. I am definitely not going to, I mean, I don't want to advise anyone to invest in anything. You got to make your own decisions and do your own research and invest your own money. But I personally would not invest in this stock. Not saying you won't make a ton of money, because you very well could have, because it's gone up 2,000% in the last 3 months. But I don't think they have enough shares in them for you to make a lot of money. It's not like you could tell me, well, if you had invested $10,000, you'd be at $20 million trade. They don't have that many shares to sell. and I mean, the volume on it is, what, 16,000? So in the whole day today, 16,600 times, and it's selling at 0.135. $2,000 worth of shares is all that was traded all day today. $2,000. That's less than one share of Amazon. So if you made money on it, great. If you lost money on it, it doesn't surprise me. I'm not saying there isn't money to be made in penny stocks. I am not going to advise someone to get into a certain penny stock. There's a handful of very cheap stocks I have gotten into, and I don't disagree with getting into, such as Naked Brands, which is under $1 a share. But that's at a completely different level. So, I mean, if you look at this, Naked Brands is NAKD. It has a market cap of $587 million. So even though it's also gone up greatly from its low of 0.78 cents to now 91 cents, it also was worth a lot more a long time ago, the cost of the shares. So it's, you know, if you have just because you have a cheap stock under $1 doesn't mean I wouldn't say that I would invest in it or not, but I definitely would not make any sort of recommendation for you to for a stock that the entire company is only worth a few $1,000 or a few $1,000,000, because it's not even worth the few $1 million that the stock is trading for right now. So the $9 million right now is totally bogus. It, if anything, is worth no more than $5,000 a few months ago. And I don't believe this is related to the old Electronic Arts video game company. If it is, feel free to correct me. But even going back to 2011, looking at the chart, I don't know what happened to the chart in 2010, but even back to 2011, it was never an expensive stock, less than $1. So anyway, you want to know, can I look at EAR? You asked me to look at it. I'm looking at it. You didn't ask for my opinion, but I gave it to you anyway. Those are very scary, sketchy stocks. So that's my unfortunate opinion on something like that. If you do it at your own risk. I am not making any sort of recommendation on a stock that is that cheap and that volatile at the same time. That's super, super scary. That's how people lose tons and tons of money. So if someone much, much smarter than me advises you to buy it, then good on them, good on you. I would never do so. Let's see. We're going to send, what do we have? We had AMC up here first, so we'll send AMC back. Oh, that beautiful late January run. You can see I've got these sell orders in. This one's at 24.9. Yeah, 24.99. This one's at 14.99. And then I got one way up at the moon at 39.99. Will it hit that? Who knows? If it does, great. If it doesn't, not a big deal. So that is my long-term move here with AMC. Anyway, we'll turn it back over to the news. I'll keep the chat window open, so if someone does come in and ask something, then I'll have there. I apologize again for not having that, but we'll turn it back over to the news, and you guys can listen to talk about breaking down the VIX.
Fairlead Strategies managing partner. Katie, before we get to the VIX, I want to go to Bitcoin because you say that's an important sentiment tell right now. Why? What is it showing?
I mean, I think it's a read on retail sentiment. So the retail investor is really very interested in Bitcoin. We just published a weekly report featuring it because of that. There's definitely an appetite for research around Bitcoin. And I think technical analysis is really the best way to look at it. And it's really important to differentiate between short, intermediate, and long term because of the inevitable volatility there, right? So we look at the short term. It has an upward bias from a momentum perspective. However, there is about 16.5% downside just to the 50-day moving average alone. And that just tells us that we can expect one thing, which is volatility. And that does also suggest that perhaps over the intermediate term that Bitcoin will come off of its highs, will leave its intermediate term overbought condition before then resuming its long-term uptrend. So I think we really need to pay attention to time frame there. And also, it's been a little bit of a read in terms of risk on, risk off from the retail investor. As mentioned, if we come into our desk in the morning and see Bitcoin trading off 20%, probably a good chance that the equity market's going to be under pressure as well. It'll maintain a strong positive correlation, but their correlation has increased over time this year. So I think that's pretty interesting, and perhaps that correlation breaks up as it sometimes does. But we're looking at it for cues as to how the retail investor feels about things.
So can we just pull up your Bitcoin compass, which is good. We made a graphic of it. So are you saying it shows in the short term Bitcoin's a buy? Let's just pull up the graphic if we could. Long term, it's a buy. Medium term, not so much, and the same applies for stocks. Explain this.
Well, right, not exactly the same would apply, but for Bitcoin, we wanted to try to isolate it in a way that's easy to digest. Sometimes the technical indicators can get kind of complicated, but we wanted to isolate those moves over the different time horizons. For us, short term is days to weeks, medium term is sort of weeks to months, and long term is months to years. So we want to be a holder here in the near term to take advantage of that short-term momentum, but probably a better seller into strength to avoid that overbought digestion phase before the long-term uptrend resumes. We really believe in the long-term uptrend in Bitcoin, which of course completed a massive base breakout just a few months ago. Now, the same comments wouldn't exactly apply to the equity market. We actually have a neutral to lower short-term bias for the S&P 500. We saw, of course, some weakness today, and that came off of a short-term overbought reading. We'd already seen a nice oversold bounce or relief rally for the major indices. The S&P 500 was at new all-time highs. So really that pullback doesn't impact the charts in much of a negative way, but it does remind us that there is an overbought condition that needs to be worked off. But when we look at something like the VIX, which is of course a gauge of market sentiment, especially on the institutional side of things, we saw the VIX take out that 20 level, which was a very important support level for the past year since the COVID-19 correction hit the market. So that floor of 20 has now been taken out today, irrespective of the rally. And to me, that suggests that we've moved from a high volatility regime that's naturally associated with a global pandemic to perhaps a low volatility regime that beyond the very near term should allow the market to kind of uphold its long-term uptrend.
Albeit volatility obviously up again by the end of the session today. Tell us what you're thinking, Katie, about cyclicals here, and specifically between the two recent outperformers, banks and energy, which moved in opposite directions today.
That's right. I have a bit of a contrarian stance in the near term on the cyclical sectors. It's because in relative terms, when you look at the likes of energy and selected area of financials, they have signs of short-term upside exhaustion. They're sort of losing upside momentum when you look at the ratios versus the S&P 500. And at the same time, we've actually seen some rotation that's come to the benefit of large cap technology stocks. And of course, growth has really significantly underperformed value recently. I think that's kind of here to stay for this year, but in the near term, those ratios are extremely extended to the downside, and it favors a little rotation back into growth at the expense of some of these overextended value-oriented areas of the market.
So back into growth. Do we have to see Treasury yields stop rising for that to happen?
I don't think we have to, but I think we probably will. So Treasury yields, again, here I have a bit of a contrarian view. They are, as you can imagine, somewhat overbought, if you want to use that label. But I'm looking for consolidation on the back of the latest breakout that we've seen there, but within the context of an upside target that we can arrive at of about 2.1%. And that's based on what we call a Fibonacci retracement level. A very important one was cleared recently, and that's the next targeted level over the intermediate term. And by that, I mean maybe 3 to 4 months or so. I don't think that's going to be a major drag on the equity market. The market seems very willing to look past this really parabolic rise in Treasury yields, at least for now.
Katie Stockton, thanks for joining us. Some of your predictions, we appreciate it. When we come back, targeting taxpayers, details of a new scheme by hackers this tax season, and how you can prevent them from taking control of your computer. And as we had to break, here's a look at shares of Nike and FedEx following their earnings reports this hour. Nike keeps going back and forth. Started down, traded higher, now lower again. Top line miss on the port congestion and European lockdowns. FedEx now trading near the highs after hours, up 3.5%. We'll be right back.
Welcome back. Time for a CNBC News Update with Rahel Solomon. Hey, Rahel.
Hi, Wolf. Hello, everyone. President Joe Biden wants Americans to stay vigilant and keep up safety measures against the spread of COVID-19. But he also says that tomorrow the U.S. will meet his goal of 100 million vaccine shots since his inauguration, weeks ahead of schedule.
This is a time for optimism, but it's not a time for relaxation. I need all Americans, I need all of you to do your part. Wash your hands, stay socially distanced, keep masking up as recommended by the CDC, and get vaccinated when it's your turn. Now's not the time to let down our guard.
Only 4 more jurors need to be seated in Derek Chauvin's trial for the death of George Floyd. That's despite 3 jurors being dismissed earlier in the week. And government forecasters expect warm and dry weather for much of the country this spring, which will worsen drought conditions in many areas and also increase the chance of wildfires nationwide. Dry weather also raises the likelihood of water use restrictions in California and the Southwest. Now, Sarah, if there is any silver lining, those same forecasters say they're not projecting any major spring flooding. So there's that. I'll send it back to you.
All right, Rahel, thank you. Rahel Solomon. Up next, bank burnout. A new Goldman Sachs internal survey shedding light on how junior bankers are feeling amid the SPAC-fueled boom in Wall Street deals. That story straight ahead. And as we had a break, a look at the biggest winners and losers in the S&P 500 today, which did fall 1.5%. We'll be right back.
Welcome back. It looks like Goldman Sachs's junior investment bankers are speaking out, saying they're suffering from burnout from 100-hour work weeks, as well as the demand during the big SPAC boom. That's according to an internal survey. One analyst said, quote, "My body physically hurts all the time and mentally I'm in a really dark place." Here to discuss is CNBC.com's banking reporter Hugh Sun, Mike Santoli joining the conversation as well. Hugh, this is a great story. It's got a lot of buzz to it throughout the last day. So tell us exactly what this survey is and how we all came to know about it.
Yeah. So it appears as though you had fairly disgruntled first-year analysts. And Wilford, you know better than most. First-year analysts, they're fresh out of college. They probably have some impression about what Wall Street's like, and then they go into the buzzsaw of the reality of what it's like, which is working, potentially 100-hour weeks, working on pitch books, and being at the beck and call of your betters on the desk. And so what appears to have happened is, a bunch of first years on the TMT group, the tech, the tech media and telecom group out in the West Coast, decided to basically protest, but to do it in the most classically Wall Street way possible, which is to create a 11-page pitch book, essentially, about why conditions are so bad and why ultimately they should be allowed to work, perhaps 80 hours a week, which is one of the, the slides in this presentation. And so this got circulated around and started to actually get published, on social media and leaked in full. And once that got out, it became inevitable that Goldman had to deal with it.
It's interesting, Hugh, because as you said at the top, I guess what's not new here is the idea that first 5-year even investment bankers are feeling a bit of burnout. What is new is that these junior workers felt kind of emboldened enough to speak out in a way that was probably meant to come back and bite Goldman, to create it in the fashion you said. It's likely to get leaked one way or another. And also what's new, I would argue, is that the bank would respond in the way that they did, which is sort of warm and friendly and sort of saying, yes, we acknowledge that things need to change. 20 years ago, I don't think either of those things would happen. The only pushback I'd put, and maybe Michael weigh in on this point as well, is that, we're not talking about people that are struggling to pay the rent. We're not talking about people who are on basic minimum wage. This is someone that's probably earning $150,000 or over $100,000. So your pushback's probably like, well, if you don't like it, quit the job. I mean, it's sort of hard to kind of sympathize in total, Mike.
Yeah, I agree with that. I mean, there's certainly the reflex, cynical response, which is this is the job, always has been the job, and has always been really known to be, almost intentionally weeding people out. I mean, are you really somebody who's committed to this type of life? Do you see enough of a reward at the end of this, career-wise and financially, to stick with what is a grind? It's grueling. Now, I could also see there being the case where this generation of people coming into Goldman, the actual upside, arguably, the guaranteed or likely upside in terms of what you're likely to earn in your career is less than it used to be 25 years ago. I'll tell you that right now, at least in terms of the median performer who stays at Goldman. So maybe there was an idea that you could have more work-life balance, or maybe it was a different bargain you were striking. Also, wouldn't surprise me if it's even more busy because of SPACs, because of the deal-making boom right now, than even the firms anticipated. And therefore, even in this context, these folks are stretched pretty thin.
Well, that shouldn't mean higher bonuses. Hugh, question. Oh, I just wanted to ask if Goldman is unique here. I mean, I know you're spotlighting them because you got your hands on this survey, but is there any reason to think that Goldman is any different than any of the other investment banks?
No, absolutely not, Sarah. No, that's a great point. And no, I think this is a slice. This is pulling back the veil a little bit from Wall Street, but it's happening everywhere. And specifically, Goldman, they're the #1 M&A advisor. They've been doing gangbusters, and probably number one or number two in SPAC specifically. So, there's a reason why they're at the sort of the center of the storm, and particularly TMT teams would be at the center of the storm. So they're perhaps, an exaggerated form of this, but no, this is pretty standard, operating procedure. One thing I would point out, Wilfred, you said at the start that, this is not the type of thing that would be, allowed in the past. And I think that's such a great point. 10 years ago, 15 years ago, in a previous, time, everybody associated with this deck would be fired. That's just a fact. And now this is sort of a warmer, gentler time in Wall Street, or it's supposed to be. And so that, once this is out, they can't really do that anymore. And, as you know, their CEO is on social media, and they can't really be seen as that brutal.
No, and one definitely questions whether, if you're putting it into a PowerPoint like this, whether the intention, of course, was for it to be leaked. And that would raise, potential need for further repercussions. The only other final point I'd just add, as well as Mike's more kind of long-term perspective versus 20 years ago, which is absolutely right, where today there's other options to hopefully make millions future careers if you want to go into tech, and tech might have more perks to the job as well, is on the short term. And this is where perhaps you can understand a bit of a gripe is that last year, all of these investment banks, and again, to Sarah's point, not just Goldman Sachs, had record years, but bonus pools didn't go up by the same multiples. You can also understand the bank's perspective on that. Do they want to be paying out huge amounts in a year where lots of people have lost their jobs, where while banks hadn't been directly bailed out this time compared to 12 years ago, they benefited from government support more broadly and Fed support more broadly. So there's an understandable trade-off in the short term from both sides of the bargain, but you can understand perhaps if there's a record year for your bank and your department and you're working crazy hours that you might have expected a bit more of a boost. But I come back to the final concluding point, which is if you don't like it, you can quit. So it's hard to get out the small violin for some of these people, I would argue. Hugh, thanks very much for that. It's a really good debate, as it's been throughout the day on CNBC. Do check out the full write-up, cnbc.com.
Up next on the show, tax season is officially upon us, but there's a new cyber scheme that everyone should be on the lookout for. Details when Closing Bell comes right back. A quick look at this afternoon's biggest earnings movers. Two of them. FedEx shares popping after beating on both the top and bottom lines. The company also raising its full year guidance. And it's up now at the highs of the after-hour session, 4.3%. Nike stock lower, mixed results. The company's earnings were hit by supply chain issues in North America, port congestion on the West Coast, European lockdowns, though China grew 51%. Wilfred.
Yeah, Sam Poser kind of talked it up for a bit. It got back to flat, but now back down again, just a couple of percent, though, after a great run. Up next, a new cyber campaign targeting U.S. taxpayers, the details and what you need to do to protect yourself coming up.
All right, guys. Well, it's almost 4 o'clock. They are at a commercial break, so we're going to use this opportunity to sign off for the day. Overall, pretty crappy day. That's about it. It's not been the greatest day in the market. Most of the markets, most of the main indexes are down. Um, just not great for any of the stocks. Now Treasury bonds were up. The yield was up six something percent, which really led to a lot of the equity markets going down. Of course, we're also watching these meme stocks which have nothing directly correlated to any technical fundamentals of the stock market, so they are on their own. So they're an interesting one to watch. AMC, I mean, you look at AMC's last, what is this, 6 days, and it's been trending up, tick, 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 from 9.5 to 1488 here, a couple, and it's like it went down, and every morning it's going to go up, it's going to go up. Today, I just felt with what was going on yesterday afternoon and today, it was going to be great. I thought we had a great chance of it taking off this morning. That is not what happened. I don't know what happened here. This was a weird situation early in the day, like mid-morning right here. It literally was hovering at 14.4 from 9:30 to 10:47 for almost an entire hour and 10 minutes, just up, down, up, down. It would not get past 14.40. Super bizarre. I've never seen anything like that. This type of barrier that is not like to me a psychological barrier at all. So this resistance that was happening for more than an hour, not going above, it just didn't make sense to me. It's really, really weird. And so AMC never took off today. It finished up today 3% because it should have had a great day, but because the rest of the market was down, people were selling stuff all around. It ended up not doing what it wanted to do. Express, kind of the same thing, also was ready to go. Actually did take off over 25-30% spike early in the day. Let me see if I can zoom it out for the day so you can see it. Huge spike right here, went up to 6.34. And then just all the air got let out of it. Finished down to below 5. Finished the day right at 5:05. Now it's trading at 5:32. So a little bit of an after hours recovery, but nothing special. Tesla's not doing a whole lot during the day or after hours. GameStop slightly up after hours, but overall a down day at 384. Cost terrible day down 7. Most of our other stocks we track here were down today. Very, very, very few were up, with the exception of AMC and Express. So we're signing off today. Not the greatest day all around. Again, they're talking right there about the Treasury yields. You can see they're all up. 10-year, which is the biggest one that really drives a lot of the equities. It's up to 1.72. It was at 1.6 yesterday. It was 1.5 a few days ago. Remember, it was at 0.9 just a month ago. So quite the big difference. I think that number's in a little bit of a spike bubble now, and I think there might be a pinhole that out. Once we see that, I think the real estate market is going to make a downturn because supply is still really low, but we're also going to see this a little bit of a slightly lower demand now since interest rates have gone. And there could be a situation where here going into Q2, once we get like a Q2 result back, if people are still not completely comfortable throwing their house on the market, and so then the supply is still super low, and then the demand starts to go low because interest rates are going higher and prices are still high, we could actually see a greatly underperforming Q2 in the housing market, which then could lead them to want to reduce rates. We'll see. It was a very knee-jerk, non-technical analysis of mine, just based on what I've seen in the last 2 or 3 weeks. So I think it could be completely off base, but that's just my uneducated observation. So anyway, we're going to sign off, guys. Appreciate you guys that joined today. Let's see what our numbers were today. 17 playbacks, a little down from yesterday. 21 yesterday. That's okay. 7 likes again. We had 6 or 7 yesterday, so that's good. Had a couple of comments. They're from Sticky Art Lake today. Sorry if I didn't get back to you while you were still here, but I appreciate you commenting anyway. Otherwise, I hope to see you guys back tomorrow morning. Until then, adios.